Northwest, but the wind causes problems in Boston and New York City with some delays. To help you make the best decisions and be more in the know, download the AccuWeather app today.
All right, welcome back, everybody. Lululemon CEO Calvin McDonald is going to be stepping down on January 31st. On a call with analysts, he said the timing was right for a change, and it seems like the stock market agrees with him. Right now, it looks like Lululemon shares are up by about 9.3%. Part of that was because the company came in with better than anticipated earnings. But Lululemon's board said that it is working with a leading executive search firm to try and identify the next CEO. So this is happening fairly abruptly. McDonald said that he will stay on as an advisor through the end of March. Since he took that job in 2018, the stock is up about 44% as of yesterday's closing price, although this chart says up by about 57%. So a gain over the time since he took over. Let's take a look at maybe versus the S&P 500, which we did the other day with Coca-Cola shares too. I do believe the S&P 500
is up more,
is up quite
for sure.
Substantially more, 142% over that period of time. The company says that the chief financial officer, Megan Frank, and the chief commercial officer, Andre Mastrani, are going to be serving as interim co-CEOs until they determine who the next CEO will be.
All right, well, coming up, follow the money. We'll talk to a fintech company that offers bank-like services to startups. And then later this morning, don't miss our interview with Chicago Fed President Austin Goolsbee. He'll join us live at 8:30 Eastern. Stay tuned. You're watching Squawk Box on CNBC. AI startups like OpenAI and Anthropic are notoriously capital intensive, but where does all that money go? Joining us now is Imad Akhund, co-founder and CEO of Mercury, a fintech that offers bank-like services to many of those startups. So Imad, interesting spot in the business here. Just set us up though and talk about exactly what your firm does, where you come into the picture, I suppose, once these startups get funded.
Yeah, we started the company in 2017 and we provide radically different banking to startups. So, as soon as you have a business, one of the first things you need is a bank account to receive your VC funding, pay for your services, give your employees corporate credit cards. We've gone beyond banking. We have cards, bill pay, invoicing, and it's all integrated in one place. And we provide it to startups and small businesses, small to medium businesses. We have about 200,000 organizations using Mercury.
And what is the advantage that you saw, and I suppose see, for doing it as a specialist in this area? I'm sure there are many large integrated banks that want this business as well.
It's a pretty easy question. Like, do you like your banking? I think most entrepreneurs, most consumers as well, just don't like their bank. It's a really painful product, lots of fees. I've been an entrepreneur since 2006, and I was always super frustrated. Actually, yesterday we just launched Mercury to consumers as well, so I've been using it as my personal bank account for the last year, there's just a lot of features that we have on, I can describe some of the personal features that will help describe the business features as well. Lots of collaboration features. So, my nanny has a credit card, a card through Mercury Personal, and I can set controls so she can spend this much per week on kind of kids' food and travel and things like that. And then we have all your money in one place, and you can auto transfer between your different accounts and yield on savings account, things like that.
Talk about the trends now in startup spending. I guess where it's principally going and how that may have changed recently.
Yeah, so 1 in 3 early stage startups use Mercury, so we see a lot of data in both the banking and cards in terms of where they're spending. AI is obviously a big spender, so we did this report where we looked at these startups to see where the spend is going. It's a pretty broad set of AI services. You can kind of, if you look at the top 10, obviously OpenAI and Anthropic are in there, but you also have these kind of vibe coding and coding assistant type things like Replit and Cursor. And then there's a bunch of productivity things, like whether it's Fixer that does email productivity, or Notion, which has like kind of productivity across all your kind of, I guess, docs. So yeah, it's definitely been, what we're seeing with AI is startups are obviously very early adopters of AI, but both AI companies themselves, but they're also big users of AI and providing services that increase their productivity and also give AI kind of features to their tools.
Does it feel as if the incumbents, though, have an advantage in some respect? I mean, you mentioned obviously kind of the big names are the ones that are the recipients of a lot of this business.
I mean, OpenAI and Anthropic are, now they're almost incumbents, but these are very new players. We did this list of like top 50, and I think I'm just looking at this list now. Basically, nothing in there existed 10 years ago. So there's a couple of players that have done a good job of kind of rotating into AI, such as Replit and Notion. So, neither of those services had any AI, I guess, 3 years ago, and now that's the main thing that they do. But yeah, I don't think incumbents are really playing very much here. I think Google with Gemini is probably the one that's made the most headway in terms of incumbents having a large presence in AI. But that's very new. I think even 6 months ago, Google was really struggling with AI.
It's probably overdone to compare this boom with the internet boom in the late 90s, but there was a criticism there that, we were funding all these VC-backed companies and IPOs, and that was creating the revenue for all the companies that were building out the internet and doing the web services and things like that. And then all of a sudden, the funding kind of shut off, and it brought a lot of those businesses down. I mean, are we at risk of having that repeat?
I think the biggest difference is right now we're very supply constrained. So, back then we built a bunch of fiber out, and there was just not enough internet usage to justify that. Right now we're building data centers, and as soon as we build them, they're maxed out. And I don't see that changing in the next year. There is just still so much demand for AI. I mean, even if I look at Mercury, we're doing a ton of things, but in the back office and in terms of user features that just require more AI chips and more energy to fuel these data centers. So I don't think it's changing for the next year. I mean, we're all kind of concerned about the, whether this hype cycle turns into the bubble. I don't think we're there yet.
Yeah, all right. Encouraging. Imad, thank you very much.
Yeah, thanks for having me.
Andrew.
East Coast, you're watching Squawk Box right here on CNBC. I'm Andrew Ross Sorkin along with Becky Quick and Mike Santoli this morning. Joe is off. We got a lot going on, though, on this Friday. Our top story right now, AI names under pressure again this morning. Broadcom shares, they are dropping. This despite better than expected quarterly results. Take a look. The company's CFO said margins will fall by about 100 basis points due to AI's higher mix of AI revenue. Meantime, President Trump signing an executive order issuing a single regulatory framework for artificial intelligence. Major tech companies have been lobbying to limit the power of states when it comes to regulating AI. And we're going to talk to the senior White House policy advisor for artificial intelligence. That's going to happen this morning at 8:40 Eastern Time. You do not want to miss that conversation. And the Federal Reserve's Board of Governors has unanimously appointed 11 of the 12 central banks' regional presidents to new 5-year terms. Now, Atlanta Fed President Raphael Bostic is retiring, and the move settles concerns we've talked about on this program many a time that President Trump was seeking to install allies at the Fed board who might object to reappointments. And on the topic of the Fed, don't miss our newsmaker of the morning, Chicago Fed President Austin Goolsbee. He's going to join us live at 8:30 Eastern Time this morning. Becky.
Andrew, thanks. Let's take another look at the futures this morning. Right now, the Dow is still in the green. It's indicated up by close to 60 points. Remember, the Dow closed at an all-time high yesterday. So did the S&P 500. It closed above 6,900, 6,901. It's indicated off by about 14 points this morning. The NASDAQ was lower yesterday. It's now indicated down another 165 points this morning. Again, some concerns on some of the AI names. This morning, it's Broadcom that's really in the spotlight for this. Yesterday, it was Oracle. Let's get over to Dom Chu. He's got a look at this morning's big pre-market movers. Dom, happy Friday to you.
Happy Friday, Becky and Michael and Andrew as well. Let's start, though, with a non-AI name, and that's Costco. Those shares are dropping right now by just about 0.5% after beating Wall Street expectations for sales and, of course, overall just for the quarter. On the company's earnings call, Costco CEO highlighted strong e-commerce gains and strength among some of the younger consumers in its mix. Those shares are still down about maybe 11% over the last year, so keep an eye on Costco. Speaking of, to Becky's point, that AI trade, Broadcom shares, let's get a check there. They're right now falling by just about 5.75%, despite reporting earnings and revenues that beat estimates and a current quarter forecast that actually came higher than expectations. So the stock initially rose, but then fell during the call after the company's CFO said that margins will fall by about 100 basis points due to a higher mix of AI revenues. And then another earnings mover, of course, to watch and keeping a close eye on there, as well as Oracle dropping about, I don't know, maybe another few percent on yesterday's decline of nearly 11%. The stock fell after revenue and earnings missed estimates, raising questions about AI spending plans. And then lastly, we'll check big tech, Amazon and Google Alphabet. You can see those shares down marginally for Amazon and up fractionally for Alphabet. JP Morgan called the two companies top picks for 2026. Those analysts say that Amazon is the most diversified mega cap across its revenues and profits. Meanwhile, JP Morgan highlights Google parent company Alphabet's strength in search and AI with Gemini and Nano Banana. So keep an eye on Amazon and Alphabet. And by the way, for more on those and other top analyst calls of the day, just head over to cnbc.com/pro, where subscribers get all the context and detail around some of the day's notable upgrades and downgrades. Becky, I'll send things back over to you guys.
Tom, thank you very much.
You got it.
We will check in with you in just a little bit. Thanks.
Okay.
All right, coming up, Chip War author Chris Miller on why he thinks giving China access to some technology is putting U.S. national security and the American AI industry at risk. And then fintech platform Wealthfront is going public today. Company CEO will join us live. Stay tuned. You're watching Squawk Box on CNBC.
All right, welcome back, everybody. Our next guest argues that allowing China access to advanced chips puts national security and the American AI industry at risk. Joining us right now is chip war author Chris Miller. He's an associate professor at Tufts Fletcher School. And Chris, you've got some pretty strong feelings about this. Do you think that national security is taking a back seat to profitability?
Well, I think that's the concern in the administration's decision to allow more AI chips to flow to China. Right now, the U.S. has a really commanding lead in the production of AI chips. That's been one of the key drivers of the U.S. leadership position in AI. That's why U.S. firms are out in front. And by selling more AI chips to China, it risks giving a shot in the arm to China's AI ecosystem.
China has had an interesting response to some of the chips that they've been allowed to purchase. The H20 chips, they basically said we don't want, and even in the instance of some of these chips, they're saying if Chinese companies want to buy these chips, they're going to have to make the argument to the government there why they're buying those chips instead of ones that are made domestically. What does that tell you?
I think the Chinese government is dead set on trying to build out its own fully self-sufficient domestic semiconductor ecosystem. It's been trying to build this up for now over a decade, and it believes that it can't rely and doesn't want to rely on the US for cutting-edge technology. So in the short run, it's going to keep buying small volumes, maybe even medium-sized volumes of AI chips from the US. But the vision that she has, and the vision that the entire Chinese government has, is to be completely self-sufficient in everything that their computing and AI industry requires. And that means, first and foremost, the advanced AI chips they can't today make at home.
I mean, it's not that different than how we're feeling here in the United States. We don't want to rely on China for rare earth metals or anything else that we've come to rely on them over the years. Is it different when it comes to AI, to these chips in particular?
Well, I think that the key difference is just the difficulty that China's had in making them. Today, China can produce relatively small volumes of AI chips. Best estimates are that the US plus its partners in Korea and Taiwan are going to produce many, many times the number of AI chips that China can next year and for the foreseeable future. And so China's really struggled to ramp up its manufacturing here, which is why the government's pouring more money in every single year to try to build up its ecosystem. But it's also why the US has a kind of unique advantage in this space, because there's not much that we can manufacture that China can't. But AI chips are a unique example of this, and they also happen to be this critical driver of technological progress, which is why I think we've got to be very careful when deciding which countries and which companies we sell these to.
Look, the H200 chips are not Blackwell. They're not the next level beyond Blackwell. Is that enough of a protection factor in terms of making sure we're not giving them our very best chips?
I think the question should be, what can China produce domestically and at what value? If China can build something at home, there's no reason to stop our firms from selling that product to them.
Well, if they can build it at home, they're not going to buy ours.
Oh, that's it. You're exactly right. You're exactly right. And the reason they want to buy these H200 chips is because they can't build enough at home. Exactly.
Well, okay, let me just go back and echo what the industry has said. Jensen Huang and many others in the industry who say, look, if we cede, if we don't sell these chips to them, it is going to force them to have to figure this out even more quickly, and we are going to no longer be the dominant player, not just in China, but beyond. We cede our world dominance if we start to pull back like this. What's your argument against that?
Well, I think that assumes that China's not going to try to become self-sufficient on its own. And the reality is, in every other sector of the economy, and including in even lower-end chips, China's racing towards self-sufficiency. So there's, I think, no world in which we sell them a bit more and Chairman Xi decides, oh, I don't need to be self-sufficient in this product, despite that I've been trying to do so for the last decade.
They're getting some of those chips illegally through other countries anyway.
They're certainly getting some.
Can we really shut it off?
I think it would be unrealistic to think you're going to completely shut it off. But the fact that you got big, successful Chinese tech firms relying on disassembling servers, smuggling them into China, reassembling them, shows how dependent they are.
I just wonder, how long can we maintain that sort of advantage that we have over them? With rare earths, it's probably going to take us 5 to 6 years to where we can get to be self-sufficient. How long will it take them in any event? to become self-sufficient with semiconductors if they continue to pour so much money into it?
You know, nobody has a crystal ball and can say for certain. What we know is that right now, even in China, the most advanced chip making facilities rely on chip making tools that were imported from the US, from Japan, from the Netherlands before our controls were in place. So when you look across the chip technology stack, there's still a lot of dependencies China has on US or other imported Western technology. And it's going to take them time to figure out how to do all of that themselves.
Okay. Chris Miller. Chris, thank you for your time this morning.
Thanks for having me.
Mm-hmm.
Okay, coming up in just a moment, fintech platform Wealthfront going public today. Company CEO is going to join us live. And a programming note, make sure to tune in on Monday morning. New York Mayor Eric Adams is going to join Squawk Box for an exit interview on the city's economy. And yes, his thoughts on his successor and what's next for New York. We're coming right back.
Time now for today's AFLAC trivia question. Who was the first president to attend the historic Army-Navy football game? The answer when Squawk Box returns. And now the answer to today's AFLAC trivia question. Who was the first president to attend the historic Army-Navy football game? The answer, Theodore Roosevelt in 1901.
Fintech platform Wealthfront going public on the NASDAQ today under the ticker symbol WLTH. It priced its IPO at $14 per share. That was the top end of the expected range. Joining us now, first on CNBC, is Wealthfront CEO David Fortunato. David, good to see you.
Thanks for having me.
Big day for you. And I was saying we kind of remember this industry, as we used to call it, the robo-advisor industry, the sort of automated investment services from 15 years ago. Well, at the time, it seemed like, hey, this is the next thing, right? Because it's going to do a lot of the things for you. Talk about where Wealthfront sits in the business now and what your customer profile is. I mean, obviously, the Schwabs, the Vanguards offer similar things. Where do you fit?
Yeah, so we serve more than 1.3 million customers across a range of products, so savings, investing, borrowing, and planning. Really what's happened over the last 15 years is that we've grown with our clients as they've grown. So when we were getting started 15, 16 years ago, it was a lot of 22-year-old software engineers, and now it's a lot of mid-30s, early 40s software engineers and a much more diverse range of careers. We try to meet all of their financial needs, and we've grown with them over time.
In fact, I remember that the company used to talk about how they, clients were a huge percentage of like Twitter's employees or something. So like a lot of employee stock option wealth was there. A few years ago, you had a deal to be sold to UBS. The deal didn't go through. I guess at that point, you had some kind of sense that maybe as part of a larger institution, you could do more. Where do you sit now as you're going to be an independent competitor, or still are?
Yeah, I mean, I think we'll look back on that deal and the breakup of that deal as one of the best things that's ever happened to us.
Right.
It was a tough process at the time to get through, but we talked to the company. We talked about the road we had ahead. We knew we'd be profitable a month or two after the deal broke up. We've been profitable since then, grown our EBITDA margins to more than 40% every month since then. We've really focused on building a sustainable long-term company that can grow with our clients, and I think that deal helped us build the maturity that we needed to get to and where we are today.
One of the talking points I recall from back, let's say in the early 2010s, was that generation, the younger investors that were just getting into it, they bought into the low-cost indexing philosophy, right? Burton Malkiel was like,
Our chief
investment officer. So this efficient market theory, in other words, they sort of got it, that maybe that those long-term principles made sense. We now have a market where, like, Robinhood has a $100 billion market cap because of high turnover, low-cost trading. So, I mean, has the market changed in terms of the customer needs or desires?
Well, the last time I talked to Bert, he's still writing articles about how long-term, diversified, tax-efficient investing is the best way to invest. And I think the data supports him. There are people that want to speculate and want to trade a lot. Those aren't our clients. Those aren't who we attract. And there's a lot of people with a lot of money that are growing their wealth quickly through passive investing.
Look, I agree with you. I think that is the best way to invest. Everything else feels a little like gambling instead of investing. But you do have this much younger generation. You guys used to have the youngest generation. There are cohorts behind them that maybe aren't as steeped in that same school of thinking, that buy and hold is the way to do it.
Yeah, our median client age joining the platform over the last few years is 23, 24 years old.
So they do exist.
They do exist. They're a little quieter than the folks that are more interested in speculation, but also they're focused on their families, they're focused on their careers, they're focused on building their lives, and so they spend a little bit less time being interested in the market.
And you're okay with that. That's the clientele you want. You're not looking to add a bunch of bells and whistles to make things look sexier, to make it look faster for any of this stuff?
I think that's exactly right. We're focused on building for the long term, and we're focused on serving more of their use cases over time.
What is the advantage? I know you guys, in all of your materials talk about being kind of a tech platform first as opposed to kind of coming out of finance. How does that practically matter to a customer, to the experience, to the kind of services you offer?
If you look at the products that a 20, 30, early 40-year-old wants across their entire lives, they want digital products that work on their phone, they work the same at midnight as they do at noon, they want a great digital experience, they want it to be fast and easy to use, and that's true for how they get their groceries, and it's true for how they get their finances. And so we're trying to deliver a product experience that makes them feel comfortable and ultimately confident in building their financial futures.
David, great to talk to you. Thank you, and good luck as you start trading today.
When we come back, a crypto player looking to get into the predictions market. We've got the details right after this. And then in the next hour, we will talk AI regulation and much more with Senator Dave McCormick. Stay tuned. You're watching Squawk Box, and this is CNBC.
Welcome back to Squawk Box this morning. Making some headlines. This is an interesting one. Coinbase reportedly planning now to announce plans next week to launch prediction markets and tokenized equities. Bloomberg saying that the crypto exchange will unveil the new products at a showcase that's going to happen next Wednesday, December 17th. Rival Robinhood, of course, released prediction market products earlier from Kalshi earlier this year. And this week, crypto exchange Gemini receiving approval that's going to let it play in the prediction markets. And Mike, I had talked to Brian Armstrong at the DealBook Summit just last week about prediction markets. I don't know if you remember, he famously trolled a whole bunch of folks who actually were trying to predict the words he was going to use on the last conference call, earnings call that they had. But he was very bullish on prediction markets and very bullish on the idea of tokenizing assets and the like. Of course, there are questions about how some of these tokenizations work and who's going to ultimately regulate them. Also questions about tokenizing private companies and bringing those into the public market context, if you will. So we're going to probably have to watch a lot of it, but it's going to be...
Yeah, even some pushback among the private companies who maybe were going to have their equity listed, right? I mean, it's a little bit of a friction point, I think.
For sure, and that's actually what happened with Robinhood in particular. Yeah. They were tokenizing assets really on their exchange in Europe. But you know, it related to OpenAI and some others. Typically, these private companies are effectively limiting who owns them, right? They want to know who their shareholder base is. Once you tokenize them, technically, can you effectively start to, which is basically chopping them up and selling them to different people? You know, how does that work? And again, where do disclosure rules come out? We've talked to the chairman of the SEC about a little about this, but you've not seen any real regulatory effort on that front.
They're taking advantage of the light regulatory touch with this administration.
Right.
And I get it. You got to play while you're allowed to with these things, but you do wonder if there's a change down the road, if any of the stuff ever gets rolled back, too, the complications that might cause. But it's been interesting to watch.
Yep, we'll stay so. Well, before we do head to a break, a quick check on the markets. Indexes have softened up a little bit. You see the NASDAQ is indicated down about 130 points. That's where the pressure's coming from. Broadcom's reaction to its results yesterday. You see the Dow positive. That's been the trend. It's been cyclicals and non-tech and banks working, trying to absorb the pressure from tech. Take a look at Bitcoin. Really has not had much of a sustained rebound, although we are now above 92,000, up a little under 1%. Coming up, it is supposed to be the most wonderful time of the year for retailers, but is it? A new exclusive read on the state of the consumer is next. And in the next hour, don't miss our newsmaker of the morning. Chicago Fed President Austin Goolsbee will join us live. Stay tuned. You're watching Squawk Box on CNBC.
Welcome back, everybody. The CNBC NRF Retail Monitor is out for the very important shopping month of November. Our senior economics reporter, Steve Leisman, joins us right now with the exclusive results. Steve, what's the verdict? Are they shopping?
Good morning, Becky. November holiday shopping getting off to a lackluster start, according to the CNBC NRF Retail Monitor. But the results, it battled some calendar issues that hold out hope that a season-saving spending rush could come in December. Let's take a look at the data. Retail sales powered by real credit card spending data that we get from Affinity Solutions rising just 0.12, and that's ex auto and gas. And what we call the core, that takes out restaurants, was flat. Both come off decent gains in October. Year over year, a little bit better, up 4.5% and 4.7% for the core, as you can see right there, down a little bit from the prior months year over year gains. But big spending months like November, they're very sensitive to changes in the calendar. This month, no exception. Take a look at these two issues here. Cyber Monday fell or landed in December this year. It's normally in November. And you have these strong seasonal expectations from the pandemic spendings because the seasonals go back about 5 years or so. So even a big unadjusted change gets wiped away. NRF economist Mark Matthews makes note of this, points out on a month-over-month basis, November didn't hit the ball out of the park, but we lost one of the largest trading days of the year, Cyber Monday, to December. The more relevant story for November is always the year-over-year number, which is well above most forecasts for the holiday season. So that's a pretty good way to think about it. Unfortunately, 7 of the 12 sectors on a month-over-month basis, they saw declines, including electronic and appliances. And I wonder personally if people might have waited for Cyber Monday to make those purchases, so we'll have to wait till December. Building garden supplies down, general merchandise also down. Digital products was down as well. Food and beverage and restaurants, people seem to go out. Didn't necessarily go to the mall, though. All of that leaves the big question when we get in November, that's week. Will December shopping save the day? NRF says their Thanksgiving weekend survey found shoppers said they had only done more, they had more than half of their shopping left to go. That's the highest percentage of 2019. So stay tuned, and tune in Monday, by the way, for the much-loved holiday edition of the CNBC All-America survey, in which we asked the question, did you AI shop this year? And then, of course, coming up in an hour or less now, we'll ask about the consumer, the Fed, and the rate outlook with Chicago Fed President Austin Goolsbee right here from the Chicago Fed. Becky?
Steve, I think that's the issue. I think the shopper may be down but not out, and I think the timing is everything about that. I mean, Thanksgiving was so late this year. I didn't start my holiday shopping until much later. I'm way behind the curve at this point. It's you don't panic until after Thanksgiving.
Yeah, and actually, Steve, in support of what you're suggesting there, American Express did say that they counted from Thanksgiving through Cyber Monday, which was in December, and up 9% in terms of their business. Now, they're not representative, broadly speaking, but they wanted to kind of capture that window.
Yeah. So if we
So I've been waiting all morning.
Go ahead.
I've been waiting all morning to give you this statistic because I used Perplexity for this last night. 71% of the time, the Black Friday through Cyber Monday lands in November. Okay? So that means the last 2 years, have been the anomaly. As you point out, late Thanksgiving this year, late Thanksgiving last year. So those two are kind of the anomalies we've been living through. And then we won't have this problem again. I guess this is what AI is good for. We don't have this problem again until 2030. So we got the next couple of years are going to be normal. We'll get them all in November. We won't have to make these kind of funky calendar adjustments. But even more interesting to me is we went back and with Mark Matthews, we looked at the numbers from 21 and 22. People hanging at home, getting checks from the government, nothing to do. They spent like crazy during the November and December holiday season. So with our 5-year seasonal adjustments, that all wraps into it now. So we're still battling these tough Novembers. And I think you're right. There's the CNBC NRF Retail Monitor, and there's the Becky Quick Retail Monitor. And I like to follow that one as well.
It's just my own panic level of what I don't have done at this point. There's not enough weekends between Thanksgiving and Christmas when it happens this late, and that's bad news for all of us. Steve, thank you, and we will see you with Austin Goolsbee in just a little bit. We're very much looking forward to that conversation.
Thanks, Becky.
Thanks.
Talking about the economy and maybe what the Fed's going to do, we're going to talk about that, the markets, and everything else. I'm going to bring in David Zervos. He is Chief Market Strategist at Jefferies, a CNBC contributor. Good morning to you. We'll talk to Austin Goolsbee later. I'm curious what you thought of what you heard earlier this week from the Federal Reserve and what you think it portends. And were you surprised that the equity markets actually moved up on the back of this news?
You know, Andrew, I'm not, because I think the forecast that the Fed gave us in the SEP was actually quite remarkable. We saw growth revised up across 25, 26, and 27 by 0.7. So they're much more optimistic on the outlook for growth. Almost no change in the unemployment rate over that same horizon. And the inflation rate was marked down 0.3. So I took away this look that the overall committee, the 19 members, actually are really embracing the supply side, Andrew. They're embracing this productivity story. They're embracing this idea that we can grow without creating a lot of inflation risks. And I think that's much more dovish than the setup we had, which was for folks to think that this was going to be some sort of hawkish cut by Jay Powell and by the committee.
Well, let me ask you then, how do you think about the employment piece of this? And also layer on top just the idea that come May, Jay Powell's not going to be in this role. I don't know which Kevin or whom you think is going to be, but do you actually think ultimately that they're going to be lowering rates even more than what they've indicated thus far?
So I do. I think this committee is going to turn dovish. I don't think it really matters that much who's coming in. They're going to have to do some convincing, whoever they are, on the other 11 members of the committee. They probably have some easy convincing to do and some harder convincing to do. Your guest coming up after 8 o'clock sounds like he needs a little bit of stronger convincing that the inflation risks are less of a worry. But you know, I think everybody that's on the list has a pretty good ability to do that convincing. But kind of your question on the employment side, Andrew, is an important one. We've seen the employment picture weaken for 3 years now. You know, back in the beginning of 23, we had an unemployment rate of 3.5%. We've been growing at 2.8, 2.9, almost 4% for the last couple quarters over this last 3 years at extraordinary rates, well above what people thought was the natural rate. And we've actually seen the unemployment rate rise almost a full percentage point. So there's something going on with productivity. There's something going on with AI, with whatever you want to call it, these jobless growth gains that we're getting. And I think the Fed recognized that in its latest forecast. And that's good news, because they're not going to get caught up thinking it's demand-driven growth that they need to get in front of and stay extraordinarily restrictive because of the inflation risks that might be coming around the corner.
Right.
So I took it as very dovish. I'm pretty excited about the new committee as it gets made up, and I see a lot of tailwinds coming for 2026 on monetary policy and on the economy.
David, personal question. Your name was on the list. We talked about it earlier this year. Is your name? You still feel like you're even? Are you in the mix anymore? Or are you not? Do they call you and say, "Hey, you're not," or you are? What's going on here?
I think the story is that they whittled down from 11 to 5, and I think some interviews are still happening with those 5. You never know what happens, Andrew, with the makeup of the committee and who's coming and who's going. This is the Trump administration, and it's very dynamic. I was very happy to be in the mix and very honored to be in the mix. And if you get the call from the president and his cabinet members that they're interested, you go and you get involved with them. And I think it would be a wonderful opportunity. But for now, I think the mix has got down to just a couple people, and the markets are forecasting that pretty well. And again, I think all of the candidates, all 11, and many of my ex-colleagues and clients as well, I think would make great Fed chairs. And it's exciting to watch this makeup go to a more supply-side driven thought process that doesn't get too bogged down in this constant belief that there's inflationary consequences around the corner from excess growth. And I'm excited that those are the people that will be populating. And I hope that we can convince the Austin Goolsbys of the world that that's the proper lens to be thinking about this economy through.
David, we will talk to Austin Goolsby, and we'll see whether we can convince him or not in just a little bit. By the way, I like the view behind you, so you're a good place to speak.
Thanks. We're hanging out in Chicago with some clients today, doing the last bits of marketing for.
Thanks so much.
It's Switzerland? That's beautiful.
Yeah, it's nice here. It's beautiful.
It is. I couldn't take my eyes off the river the whole time. Thanks, David. When we come back, we're going to talk to Chicago Fed President Austin Goolsby. As we've been talking about this, we'll find out why he argued that the FOMC should have held rates steady at its meeting this week. He's going to join us in about 45 minutes at 8:30 Eastern Time. A reminder for you, you can get the best of Squawk Box in our daily podcast. Just follow Squawk Pod on your favorite podcast app, and you can listen anytime. We'll be right back.
Welcome back to Squawk Box. Making headlines, UBS shares trading at a 17-year high. Among the reasons, a group of Swiss lawmakers have proposed watering down capital demands that Switzerland has been looking to impose on the banking giant. You see right there, up 35% on a one-year basis. Coming up, Disney investing in OpenAI and opening the door to a whole new frontier for Hollywood. We'll talk about the possibilities and potential pitfalls with Variety's Cynthia Littleton next. And then, in the next hour, the senior White House policy advisor for artificial intelligence will tell us about President Trump's executive order on an AI regulatory framework. That is at 8:40 Eastern. Stay tuned. You're watching Squawk Box on CNBC.
Welcome back to Squawk Box. Disney's $1 billion investment in OpenAI and its move to let fans make AI videos with its characters, opening the door for other studios to consider similar deals or risk potentially falling behind. Here's Disney's CEO Bob Iger on CNBC with David Faber yesterday.
We've been extremely impressed with OpenAI's growth and what Sam and his team have been able to achieve. And of course, on top of that was their appreciation for our content and their willingness to license it and their willingness to help us protect it and to protect value. So we're very excited about what we see. We also think there are great opportunities for our company to license other product from OpenAI to make our company more efficient, to grow the top line, to essentially accomplish a lot of what we feel we need to accomplish in the years ahead.
And joining us right now is Cynthia Littleton, Variety's co-editor-in-chief. Good morning to you, Cynthia. How is Hollywood taking this, and what does it portend, and not just for other IP characters, but how is the creative community, actors, and everybody else thinking about it?
Well, I will tell you that this is the first thing that got people not talking about Warner Brothers and Netflix and Paramount and HBO. So it did rise to the level of it's something that people were definitely talking about. I made some rounds last night, and people were definitely kind of trying to, is this a good thing? I think people at other studios and in the creative community are still trying to evaluate sort of what Disney's motivations here are, but it has definitely had a big impact in Hollywood, where it's been a very tough season, and any potential source of revenue and profits is going to be eagerly investigated by anyone. And Disney, no surprise, it feels like they're making a market leader move here.
Do you have any sense of what kind of revenue this is ultimately going to look like? I mean, and how much of it really drops to the bottom line? Also, how long-term this kind of money really is?
In a word, no. I have to be honest with you, unpacking the financials of how this is going to work. Is it a pay per character, pay per use, how they're going to track all of that? I have to admit that is what we're pursuing and trying to figure out what the economics of this are, because it's very clear that this would seem to be Disney trying to set a floor, Disney's trying to set some parameters for the use of their content in this sort of new medium, with the new AI tools that you can make all kinds of things. They're even going to they've even committed to putting some user created shorts to screen on Disney Plus to be available for streaming. So it seems like they're really trying to embrace this as a new medium that could have creative potential. But this deal, which I'm sure has all kinds of interesting parameters, could potentially be a template for others. But I did not hear, oh my God, we've got to get and do our own deal. I think a lot of other Hollywood is going to take a wait and see as to see how this plays out for Disney.
Well, let me ask you about that, and let me show you another clip from that interview, Sam Altman talking about trying to make this deal and how important it was for them.
We always have wanted to respect IP. When we launched Sora initially, we had a lot of blocks in place, but we knew that if there was one company that we wanted to start partnering with, Disney was the obvious one. And so we have had a long discussion going with Disney, and we found them to be a sort of open-minded partner as this technology's evolved. And it was very clear to us that we really wanted to find a deal to do here.
So, Cynthia, I think the question is, what do other studios do? Also, is there going to be a battle? Is Google, for example, and Gemini, are they going to try to take out the IP of another company? And does there become an arms race for this IP, and therefore how much value can ultimately be extracted? It sounds like Disney just did this deal on an exclusive basis, and that's the other question. How exclusive are these things, for now, and what does that look like longer term?
Well, and I think you got to think about all of this in the context of litigation that is already existing. Disney and Universal are suing an AI firm, not nearly as large as OpenAI, but there's a lot of existing litigation out there, and how this plays into that will be very interesting. I think in terms of what Disney wants to get out of this, I really feel like it's setting a floor and setting some parameters. One aspect that was raised to me by somebody at another studio is the sort of, even the images that you're showing right now, like where is the line between what is an actual authentic clip from a Disney movie or a Disney TV show and when the user generated, generative AI user created content gets out there in the internet and on TikTok, how are you gonna untangle what is the quote, what is the authorized legitimate clip from a movie or a TV show from what's out there? When you start unpacking this, the mind reels as to the potential. In terms of the financial, and there is a sense that there's a gold rush out there for content creators. We're hearing, people with much smaller libraries are, getting offers to license content for tens of millions of dollars. But I think there has to be a note of caution here about whether this is all whether are we in an AI bubble and will this pay off? I think Disney's $1 billion investment in OpenAI is also that's a bet on the future. So interesting to see how this all plays out.
Hey, Cynthia, let me throw other one at you. And I heard this last night from an actor who was asking me the question. I did not know the answer. There are certain characters like Darth Vader, for example, that clearly, there's an actor underneath the costume, but that's clearly the IP, if you will, of Disney. Is it more complicated to think about, Harrison Ford playing Indiana Jones and what that, maybe the hat is Disney's, but is the character itself, should he be able to participate in that in some way? If you're thinking about Pirates of the Caribbean, that obviously is IP that's Disney, but Johnny Depp played that role, and where does he, does he capture any of it if somebody's going to be putting themselves into the role that he played as the captain? Do you see what I'm saying?
I totally do, and the long list, Disney had a long list of characters that will be licensed for this, and most of them, maybe not all of them, but the vast majority of them were animated for that exact reason. The Writers Guild of America was quick to come out and basically say that this is a form of copyright theft for their members, for their creations. So yeah, that is a whole other avenue of potential. That's a whole other avenue that the industry is going to have to step by step and perhaps legal case by legal case figure out what the parameters of that are. There have been in recent months a lot of activity at the state level about name and likeness usage, especially for dead celebrities, but for living celebrities. In New York and LA, obviously big creative hubs, there has been a lot of activity at the state level to get tougher legislation around just the ability for any AI firm to do exactly that, to take an Indiana Jones image with Harrison Ford's face and allow people to manipulate it. Very much so.
It's an interesting one, and I'm sure we'll be talking a lot more with you about it. Cynthia, thank you very much this morning.
Thank you, and congrats on your book.
Oh, thank you.
It is 8 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Andrew Ross Sorkin and Mike Santoli. Joe is off today. Among our top stories this morning, Senate Banking Committee Chair Tim Scott says that there is real progress, in his words, on a major cryptocurrency bill. His update comes after meeting yesterday with top bank executives. Lawmakers say that the Senate is moving forward on a sweeping plan to regulate digital assets, including the Genius Act. The goal is to clarify who oversees what. The big question, of course, is which agencies, the SEC or the CFTC, will police different types of cryptocurrencies. Lululemon says that CEO Calvin McDonald will step down next month. The founder and major shareholder Chip Wilson has been pushing for changes after a year of underperformance. The company also reported third quarter earnings that beat expectations. And as a result of all that, the shares are up by 10% this morning. And cannabis stocks like Tilray, Aurora, and the Advisor Share ETF are soaring on reports that President Trump will move to reclassify marijuana as a less dangerous drug. You can see those stocks, Tilray up by about 28%, Canopy up by 23%. The White House saying it has no final decision that has been made at this point. Andrew?
And Tom, let's take a quick check on the markets. Right now, we got the Dow up about 80 points, but the Nasdaq looking to open off about 143 points. The S&P 500 off about 9 points. I'm going to get over to Don Chu. He's got a look this morning at the pre-market movers. What's on tap?
All right, happy Friday morning, Andrew, Becky, and Michael. Broadcom shares right now, let's check on those because they're the big mover, falling by about 6% in the pre-market trade. That's despite reporting profits and revenues that beat analyst estimates. That stock initially actually rose, but then fell during the conference call after the CFO there said that margins will fall by about 1 full percentage point due to a higher mix of AI revenues. Deutsche Bank analysts still think there are positives, though, that outweigh the negatives. They raised their target price on Broadcom shares to $430 from $400, so keep an eye on those. And Oracle shares, by the way, just a quick check there, down about 1% on top of yesterday's near 11% decline. Revenues and earnings missed estimates that raised some questions about AI spending plans at Oracle, so keep an eye on both of those tech giants. Next up, you got shares of American Airlines, which are higher by just about 1.5% after UBS upgraded that stock to a buy rating from a neutral. Analysts there say the market is underestimating American's ability to expand profits over the next few years as corporate revenues grow and loyalty income starts to expand as well, so keep an eye on AAL. And lastly, we got shares of Citigroup rising by just about 1.5% after JP Morgan upgraded the bank to an overweight from neutral. Those analysts see improved profitability relative to its peers over time. Factors include Citi's concentration of revenues and improving efficiency ratios as well, so keep an eye on those major money center banks. Now, for more on those and other top analyst calls of the day, subscribers can head over to cnbc.com/pro for more of the detail and context around some of those notable upgrades and downgrades. Andrew, I'll send things back over to you guys.
Okay, Dom, thank you. You got it. And now I'm going to flip it over to Mike.
All right, Andrew, thank you. Fed speak just hitting the wires. Steve Leisman has some highlights for us. Hi, Steve.
Hey, Mike. Yeah, the blackout lifting on the Friday after the meeting and Fed folks talking. Austin Goolsbee, we're going to have him on about half an hour. He has a statement explaining his dissent. He says the Fed should have waited for more data, especially about inflation, before cutting. Waiting did not, he said, entail much additional risk. Inflation, he says, inflation progress looks to have stalled for several months, while the labor market is cooling only moderately, in his opinion. He's optimistic interest rates can come down significantly over the next year. We're going to ask him more about this just about a half an hour now. Meanwhile, Cleveland Fed President Paulson saying she's on the other side of this, a little more concerned about labor than she is the upside risk to inflation. She's a voter next year, so we'll be following her carefully as well. A decent chance, she says, that inflation will come down as we go through next year and tariff inflation comes off. The current funds rate, she says, is somewhat restrictive, and that's going to help, she says, bring down inflation to the 2% level. Take a very quick look right now. The big mover this morning, none of the stocks, this to the stocks Don was talking about, the 210 spread ratcheting up to around 64, maybe adjusting to the new financial moves the Fed is making, buying those bills on the short end. And so what you see is this a surge right now in the 210 spread. That's probably, Mike, you would know better than me, good for the banks.
It's generally good for the banks, yes. And while it's wide for this cycle, it's not particularly wide historically. So who knows, where that ultimately gets to.
Is this the new normal?
We've had many new normals. Yeah, we're horseshoeing around to the old normal at some point. Maybe we'll see.
What does that mean for anybody who has been waiting for rates to come down to either refinance or buy a house?
Look, it's not really moving very quickly in that direction in terms of mortgage rates.
And the opposite.
Honestly, you almost wonder, how far would you want longer-term rates to come down if the economy is, in fact, going to be growing and real rates, therefore, have to stay kind of higher? Even if we're going to get a productivity boom, you don't really want long-term rates to collapse.
No, it's just that you have business models that are based on lower interest rates. You have more concerning, like consumers waiting for this. We've been waiting for the housing market to kind of get moving again and to maybe bring affordability down so that people can buy a home before 40, I think, is the median age for the first-time home.
I mean, look, you'd have to see a real disinflationary move that brings the 2% destination for short-term rates into sight, which nobody's talking about except for Stephen Myron, basically.
Right.
And so, yeah, you have to have that proved out.
So never mind, maybe we don't want that because that's a scary scenario to find out what the economy looks like.
Well, unless we get a magical productivity boom and inflation goes down and growth stays high. We'll see. That's the hope. That's the late 90s scenario. All right, coming up, Senator Dave McCormick of Pennsylvania will join us. We'll talk about everything from AI regulation to fixing the nation's healthcare system. And then later this hour, Chicago Fed President Austin Goolsbee, he was a dissenter at this week's FOMC meeting. We just heard him elaborate a bit on that. He's arguing for no rate cut this past week. He will make his case at 8:30 Eastern. Stay tuned. You're watching Squawk Box on CNBC.
All right, welcome back, everybody. Dueling healthcare bills failing to pass in the Senate as the Obamacare subsidies expiration date inches closer. And joining us right now to talk about this and much more is Republican Senator Dave McCormick from the state of Pennsylvania. And Senator, thank you for being here today.
Good morning.
I'm actually a little shocked that we are getting this close to the deadline for the subsidies being renewed, where most people have to, the deadline for signing up is Monday.
Yeah.
And nothing's been done to this point. It seems like a bit of a cliff to fall off. And I realize full well that you and a lot of other people would like to see some reforms done to this. But we came so close to the end, it seems like it's hard to believe there's not going to be an extension while that reform is taking place.
Yeah, it's a scary thing, I think, for a lot of Pennsylvanians, a lot of Americans, because a lot of working families, their premiums are going to go up pretty dramatically. If you make $50,000 a year, you have a $200 a month premium, it could be $400, and that pressure is going to be a real problem. And you got to start by saying, where are we? I mean, we've had Obamacare for 15 years. Mm-hmm. It promised lower cost, improved quality, better access. It's failed on all fronts. And what this subsidy is an extension from COVID subsidies. Yeah. And these gave subsidies to people that are making $500,000 or $600,000 a year.
I understand all of that. Look, Obamacare did do one thing very well, and that's get a lot more Americans insured, people who had been uninsured before. I understand that these are subsidies from COVID-era that are extended and going through, but it's also so abrupt and seems like it's yanking the rug out from under 22 to 24 million Americans.
Well, first I say two things. One, part of the reason we're in this mess is we had a 42-day shutdown that didn't resolve anything. So we're getting pressed at the end. The Democratic proposal was essentially a 3-year extension.
Oh, I looked at it. Both of these bills, it was very clear that neither of these bills would get anywhere near the 60 votes they needed to pass. What I don't understand is why there doesn't seem to be any sort of bipartisan work or talk across the table where you get something that maybe extends it for a year instead of 2 or 3 years.
Well,
3 years was what they were asking for. If you
Well, they were
extend
asking
it
for 3 years without any reforms.
Without any reforms, right?
What
Which was a non-starter.
The Republican alternative was putting money in the pockets
HSAs.
through the HSAs.
But it just seems like neither one of these took into account reality.
Well, there's, listen, I'm hopeful. I agree with you on the crunch of time. You see Senator Shaheen and some others on the Democratic side that appear to be recognizing that the current subsidies in their form cannot be extended without reform. And so I'm hopeful we'll get some reform. For me, I think the Republican proposal was a good proposal, but I'm worried about the working families in Pennsylvania who are really having the pressure on it. So,
I've been reading some of the town halls that you've been having and what people have been saying to you. You're going to face a lot of pressure.
Yeah, listen, I do town halls every 2 weeks, teletown halls. I get 10,000 people that show up. The questions are totally unscripted. And healthcare, housing, healthcare, energy prices are the big things. We're making progress on energy prices. We're making progress on housing. But the healthcare is a real challenge. And listen, here's the reality of it. We pay 3 times per person for healthcare than any other country in the world. Our health statistics, our longevity, our lifespan, infant mortality is terrible relative to other developed countries. And still, 25 million people don't have access to healthcare. So Obamacare has been an abysmal failure. We can't go forward without real reform. So there's sort of 2 agendas. One is near term. How do you deal with working families that are going to be crunched? And then in longer term, we got to do reform that gets cost under control.
Is there a movement afoot? Do you think that there will be something that comes through, or do you think this is it? What do you tell your constituents?
I think there'll be something. I hope.
You do.
I'm certainly going to be advocating we've got to do something to help working families. The current subsidies cannot be extended in their current form. We got to do something.
I hear your point about not wanting it to go to families that are making $500,000 or more, that this should be really helping out the people who need it the most.
Yeah, and listen, this is whatever we do, and I really hope we do something, it's going to be a bridge to a much broader conversation about healthcare reform. And even if you're a Republican like I am and think Obamacare was catastrophic and a real failure of the Democratic Party, we now have to deal with that problem together as Republicans and Democrats.
What specifically falls under the heading of reform that you actually think is, practically speaking, something that could be implemented?
Do you mean in the near term?
Yeah.
Yeah, in the near term, I think you got to bring down the income caps very significantly. I think you can't have an automatic extension on an individual basis without rooting out the fraud. Probably some minimum payment.
So somebody's got to have skin in the game, $5, $10, $15.
Even if it's a tiny amount. The key for that is it guards against fraud. And then you can't have a 3-year extension. So it's got to be a less extension, it's got to cap incomes, and it's got to deal with. And I love the idea that the president put forward and Cassidy Craybill put forward, which is ideally you want to have consumers have choice with some sort of health savings account that's going to help fund part of this. So those are the parameters.
That might just illuminate how much of people's health care, though, is actually covered by somebody else. I mean, in other words, the overall cost, it can't come out of people's pockets directly, even if you give them a check, right?
Well,
I mean, the whole thing of risk pooling is
it's coming out of their pockets in 2 ways. It's coming out in premium. It's coming out of what payment they have to make up front as part of the first down. So the health savings account to mitigate that payment, where for most people it's $6,000 before the insurance kicks in, that $1,500 in their pockets is going to take a lot of pressure. And remember, what we're talking about here is, in Pennsylvania at least, median income outside the Philadelphia counties is $52,000 a year. So if somebody has to pay $6,000, or if somebody's premium goes from $200 to $400 a month, this is a huge deal. And so that's the segment of our population that I'm most worried about.
Senator, let's talk a little bit about AI. You've been looking through some of the implications on a societal basis and ethical basis for what AI is going to be happening. Overnight, the White House, the president putting out an executive order saying this is what we want. We want AI to be regulated by this policy that they couldn't get passed through Congress, and directing the Attorney General, Pam Bondi, to go after and sue states that are trying to put their own regulations and frameworks in place. I understand that federal law should absolutely supersede state law when it comes to interstate commerce, but this is not federal law. This is a White House executive action.
Well, I thought the executive order was trying to thread the needle and hit the sweet spot very well in the following sense. So first of all, it's we're in an existential battle for leadership in the world on AI. If you believe the stakes are as high as I do, we have to have an innovation policy and national posture that's going to allow us to maintain the lead. So a patchwork.
But we haven't been able to get something like that through Congress.
A patchwork of state regulation is very, very significant in terms of putting us behind in terms of China. So what the executive order says is that we want to have a national innovation strategy. It says that the states can move forward on, as I agree with, on potential cases of copyright or protecting children. It also encourages and asks the David Sachs to move forward and work with Congress on a national standard. And then it has enforcement with broadband funding, and it also has, as you note, the Attorney General essentially being able to take action against overly restrictive. That balance of things, I think, is trying to do the things you said, which states need to have some freedom to deal with the issues that matter most to them. But we've got to have a national posture that doesn't put us behind. We already, look at the front page of the Wall Street Journal today, with energy supporting AI. AI and energy go hand in hand. If we don't have a national posture for maintaining leadership, I fear we're going to be left behind in probably the most important thing to happen in our lifetimes.
Senator Andrew's got a question, yeah.
Hey, Senator, just following up on where Becky was, though, and I don't think we disagree. I think we agreed that there should be a national plan, but that national plan should come from Congress. That is the job of our elected leaders, to come up with the policy for the nation and to decide and determine how that policy is effectuated. In fact, you could argue that the CEO is ultimately going to go to court. I mean, that's what's going to happen. And then there's going to be a debate, and maybe it'll ultimately go to the Supreme Court, for all we know. But sort of using executive orders as opposed to actually having Congress do its job, especially when you're getting into the issue of states' rights versus federal government, I would think that even
I lost him in
you know, even Trump supporters would say that should be the approach.
We're just playing. I think the last thing he said was even Trump supporters would say that should be the approach.
I lost the last part of your question, Andrew, but I think I got there. It's back. I think I got the gist of it. Listen, you all know better than anybody. We are in a period of unprecedented change, the pace of change. So I agree with you. Congress needs to play its role and act. And what the president's done, which I think is a real contrast to the last administration, is laying out a pro-innovation framework for how to pursue that. And you know, I'm a strong believer the national strategy needs to be a very aligned one. The executive order lays out what that balance should be, and it also, as you suggest, lays out a path and goal of collaborating with Congress to put that national standard in place. So, you know, we're at a pace of change here where I think the president needs to step up and show leadership, which is what I think he's doing. And I agree with you that Congress needs to do the same.
What, aside from the copyright protections and protection of children in a state law, is the industry and the administration most concerned about being added in terms of regulation? I'm just curious what the stakes are.
Well, I'm not sure. You know, there's a lot of different variations, but I would just point to this energy issue, which I think is a good analog. Right now, we have a patchwork of regulations and permitting across the country, across America and the different states. We have a challenge to meet the energy demands of the most transformative technology in the world. That battle for AI energy leadership versus China is critical. And it's very hard for America to be the energy dominant country it needs without a very consistent permitting approach across. So I think these national imperatives, we got to think about having the right national standards. One of the things I think we need to focus on in the Congress is permitting reform on the energy front, national permitting reform. So I think it varies by states. Look at some of the standards that California or other states are thinking about in terms of AI restrictions. And I think it poses a real risk that if those frameworks, regulatory frameworks go into place, that we're going to lose the leadership battle in terms of technology innovation.
Senator, you are a former captain in the Army, a West Point graduate, and we have the Army-Navy game coming up this weekend. I take it you'll be there.
I'll be there. It's one of the great traditions. As I was telling you earlier, we used to take our 6 daughters with us, and Dean and I would do the Rocky Run, which they would always complain about. It'd be cold. We'd run up the steps in Philadelphia. It's in Baltimore, and what my wife Dean always says about it, which is true. It's always a great game. It doesn't matter who's predicted to win, but no matter who wins, America always wins because it's really representative of 2 great institutions and great commitment and service to our country.
So you'll be rooting for the Navy?
Oh no, I'll be rooting hard for Army. Yeah.
Senator McCormick, thank you for coming in today. We
Thanks
appreciate
for having
it.
me.
Good to see you.
Thank you.
Andrew?
Okay. Still to come, we've got Chicago Fed President Austin Goolsbee. He's going to join us in just a little bit. Don't go anywhere. But up next, Reddit challenging Australia's ban on social media for those under the age of 16. We're going to read details about that after the break. Squawk Box returning after this.
Welcome back to Squawk Box. A couple of corporate stories for you. Reddit is challenging Australia's teen social media ban, calling it ineffective and disproportionate. The ban, targeting Facebook, Snapchat, and other services, went into effect yesterday. Reddit argues the law goes too far by limiting teen participation in political discussion. OpenAI launching a new ChatGPT model yesterday, saying the new version is better at building spreadsheets, presentations, and coding. OpenAI's CEO Sam Altman telling CNBC yesterday how important the compute ramp is for the company.
It's obviously unusual to be growing this fast at this kind of scale, but it is what we see in our current data. The model's ability to do really increasingly valuable economic work in larger and larger chunks. I think you'll start to see this with our next model, and then more of the next one after that. We are confident we can continue to drive the revenue growth to meet this compute ramp. Without the compute ramp, of course, we can't drive the revenue growth.
Later in the program, we'll be speaking to the AI policy advisor for the White House about the executive order the president signed yesterday to create a single federal AI regulatory framework. All right, up next, Chicago Fed President Austin Goolsbee on the FOMC's latest decision and where he sees rates headed in 2026. Take a look at futures on this final trading session of the week. NASDAQ due to be down close to 0.5%. The Dow still positive by almost 100 points. Dow is up 1.5% so far this week. Squawk Box will be right back.
Welcome back to Squawk Box this morning. Take a look at futures right now. We got 83 points on the board on the Dow, but NASDAQ looking down about 126 points. Looking at the S&P 500, about 3 points. Show you Treasuries. I'm going to show you the 10-year note and the 2-year, 4.1 on the 10-year. The 2-year is sitting just at about 3.5. And then Bitcoin, our indicator of risk on, risk off, we're sitting just at about 92,289 bucks. Becky.
Thank you, Andrew. Right now we want to get over to Steve Leisman. He is at the Chicago Fed Economic Outlook Symposium this week with Bank President Austin Goolsbee. Steve, take it away.
Hey, good morning, Becky, and thank you. Just before I go, I start here. Jeff Schmidt, the Kansas City Fed president, another dissenter, out with a statement at this hour saying the reason he dissented, inflation is too high, the economy showed continued momentum, and the labor market, he says, is largely imbalanced. So we can talk about all that with Austin Goolsbee, professor, president, and now dissenter. That's another moniker we have for you now.
Indeed. Welcome, though, Steve, to the beating heart of the Federal Reserve System.
Are you kidding me? What a beautiful place. So let's talk about the dissent and why you decided. I guess this is your last vote until the next cycle comes around for you. Why was it important for you to vote against the rate cut?
Well, look, Steve, you know I've been saying for months, I'm pretty optimistic that for 2026, rates will be able to be a fair bit lower than they are today, but I've just been uncomfortable front loading too many rate cuts and assuming that what we've seen in inflation be transitory. It's all amplified by the data being shut down, and so I just felt that we ought to wait, that we don't lose a lot, we don't take a lot of extra risk, in my view, to just wait to Q1 2026 and make sure that we're back on path to 2% inflation.
The big pushback here, though, comes from the job market data that we do have, which suggests that the labor market is weakening pretty substantially.
I don't know that I see it exactly the same way, in that most of the measures of the job market have been pretty stable. And the chance that things in the job market would fall apart rapidly within 1 to 2 months before we would revisit this again feel relatively low. We're in this environment where anything measured in rates, like the unemployment rate, the layoff rate, the vacancy rate, etc., those have shown stability. Where you've seen the number fall off has been raw aggregate monthly payroll, but that's the one with the biggest question mark because of immigration, because of retirements. We don't know what the break even is. So as we look at an environment that's been characterized, I would say, as this low hiring, low firing,
right,
it's worth remembering that's not what the business cycle looks like. You have low hiring, high layoffs, or you have low layoffs, high hiring. For both to be low at the same time, to me, that says more like uncertainty than it does slowdown.
So it could pick up, you think, on the backside. Before you answer that, though, you have to deal. I'd like you to answer this issue with Fed Chair Powell, who said that when you figure in what could be revisions, the really substantial revisions to the job numbers, you could be minus now.
You could. The only thing is we don't know what the break even is on the monthly payroll. And we saw in 2023 and in 2024 on the inverse side, we're getting these big numbers. And there were a number of people saying, how could the economy not be overheating if we're getting 150, 180,000 jobs a month? And the answer was, that's a false reading of where you are in the business cycle because the break even was higher. So I think looking at these rates is a more effective way to figure out where you are in the business cycle. And they've been basically stable, cooling mildly. The hiring rate is low, but the layoff rate is also low.
But they're just putting up, Austin, you're right there. There's the unemployment rate. It's ticking up. You were at 4. When was that? Back to the beginning of the year. And then, as we're looking at it right now, it ticks up to 440, 40 basis points. Okay. Who says you know where this stops?
We don't, and that's my only point. Like I say, I am not hawkish on rates for next year. I think that we make progress and that by the end of next year, if you look at the dot plot, I'm one of the most optimistic folks about how rates can go down in the coming year. I'm just uncomfortable with front loading the rate cuts, assuming all of the inflation that we've seen be transitory. There's no way around. We've been 4.5 years above the inflation target. And the last 6 months have shown no progress. And right before the lights went out, you saw a couple of relatively disturbing readings on services inflation. I just want to make sure that if we believe that this is transitory, Let's not just put all our eggs in the.
So I have not been sent here from New York, Austin, to get you with the program. But let me tell you what the program is.
Okay.
The program is you got these tariffs on. They're coming off next year. Inflation's going to fall. Don't you worry your pretty little head about inflation.
That's what I want. I want to not be worried about
Is that what's wrong with that theory?
There's nothing
but that's
wrong
what
with the
you were
theory.
acting
I just want some evidence that that is in fact happening, because that's disturbingly sounds like exactly the argument of 2021. It's about to go away.
Transitory.
Team transitory. And there were many of us, private sector, I wasn't in the Fed then, but Fed, private sector, academics, buying that logic. If you look at the forecast, if you believe that the inflation is coming primarily from tariffs and it's going to roll off and be transitory, that is supposed to start showing up in the data in Q1 of 2026. As long as we get some data showing that, as I say, I'm one of the most optimistic people for 1 year from now, how far rates go down. Look, I don't, the dots are anonymous for a reason, but I'm more than the median in optimism.
For 26.
For 26, for the end of 26.
Okay. So one other argument that's out there, and I asked Chair Powell about this, was this idea that, hey, you have this, it was interesting, they raised the growth forecast. They didn't really lower the unemployment rate, and they lowered the inflation rate a little bit. Tells me that there's a productivity thing happening there.
Well, look, we've been noting the productivity, that there's been strong productivity growth, but I took from the forecast, not just of coming out of the dot plot, but if you look at the private sector too, they view the unemployment rate in the coming year to not be much higher than it is right now, that it's pretty stable. And so that's why I just want to get evidence that inflation is going to be temporary. Because as I say, before the lights went out and we stopped getting official data, there were some disturbing readings on services. And as you know, services is historically a much more persistent type of inflation and is not likely caused by tariffs. So let's just make sure when the lights go out, let's just wait a second. I always say, I have only ever aspired to be one of the data dogs. And the first rule of the data dogs is there's a time for walking and a time for sniffing. And we need to figure out the difference of those. And when there's no data, that's the time for sniffing.
Let's leave the building and the ivory tower and talk about what we're hearing from the American public, which is that they really having trouble with prices right now. How does that
motive? Look,
you're thinking about policy.
As you know, I travel around and talk to everybody here, heart of the Midwest. The district in Chicago is Iowa, Indiana, Michigan, Wisconsin, Illinois. At the least, prices are one of the main factors, concerns that both businesses and consumers have about the economy right now. So that's why we can't ignore that inflation's been above the target for 4.5 years and it's rising. Let's just I do have some confidence that it will come down, and a year from now rates can be lower. I'm just uneasy with front loading because of that.
Becky, go ahead.
First of all, Austin, you never fail to disappoint. I love your analogy. I just wonder, what are the dogs
I never
sniffing?
fail to disappoint.
You never disappoint, I should say. You never fail to keep us interested. I misspoke. You never fail to impress. That's right. What are the dogs sniffing, first of all? Second of all,
what are the dogs sniffing?
Yeah. Where?
Look, you sniff the data. Sniff everything that hits the floor. It might be food. You know, that's the other rule.
That too. Okay, let's talk a little bit more broadly about the Fed. You all made the early move to reappoint a lot of these Fed presidents yesterday, and that kind of cut off some concern people had about whether the Trump administration was going to get more hands-on with moving the Fed around, maybe trying to replace some of the presidents that are there. Do you feel like the Fed is trying to prepare for an onslaught coming from the Trump administration?
I don't think so. I've been on the Fed on the FOMC for about 3 years, and I'm struck, and you can see in the minutes, and you'll see when the transcripts come out, and you can read word for word, the way the interest rate decisions are made have nothing to do with anything other than the economic outlook and the economic data. People take the job extremely seriously. It's not a partisan, you're out of the elections business. That people take the job seriously, and that's fundamental to Fed independence. And I think everybody understands how important Fed independence is.
Austin, you told me before we went on air that in fact, and I may have this wrong yesterday, the vote took place just at the same time it always takes place, as when it was announced earlier.
I think that's true.
Okay.
My understanding, I wasn't here
Right,
5 years ago,
right.
but the way I had heard it, there was a vote in December, it was announced in January, and the official appointment is at the March 1.
I mean, there's no doubt it was sort of an end run on some possible, you don't have to say this, but it seems like an end run on some possible influencing or changing that the president might have had if he had the majority on the Federal Reserve Board. But if it's the same timing, then it's only a matter of announcing it rather than actually.
That's my impression. I know the process is a very robust process. We have to submit a lot of documents. What have you done? What are your successes? What are your weaknesses? How each of the banks has
And
been
did you say
operating.
your problem is you care too much when let's talk about the Fed balance sheet, which seems to be influencing markets these days. You guys made a decision, as far as I can tell, earlier than the market expected to come back into the market and larger than expected. Why isn't this new $40 billion of purchase of bills? Why is that not QE?
Why is it? This is a technical adjustment. It's not QE because the intention of doing this is just to allow rate control. It's not to try to influence monetary policy. We're not at the lower bound. You remember the QE was about trying to do monetary policy when you can't adjust the interest rate. And this is.
But you are growing the balance sheet, right?
We are growing the balance sheet, but as I say, the balance sheet, when you're operating in an ample reserves regime, is supposed to be a share of something, a share of bank deposits, a share of GDP. So over time, it's got to be growing. The timing of that, in this case, I think is just a technical adjustment. You've seen, if you go look in repo markets, felt like we're getting pretty close to the point where they're not ample, and if reserves are not ample, we're not going to be able to set the rates how we need to set them.
Mike Santoli has a question.
Yeah, Austin, a couple times you've referred to some of the inflation data we got before the data stopped as disturbing on services inflation, things like that. Have you taken any comfort in the market signals about how it feels about inflation, whether it's market implied inflation expectations or even longer term treasury yields, which have not really broken out of a range?
Yeah, I take a little comfort that it's an important issue to raise, that these market-based measures of inflation expectations, let's call it in the near term, have looked better than the survey measures when they ask consumers. And I do take some comfort in that. And that's part of why, as I say, I'm optimistic that a year from now, rates can be a fair bit lower than where they are right now, if the path of inflation goes how we want it to go and how people anticipate, that it will be transitory, that what we've seen will go up and then come down. And when it's supposed to start coming down, it's supposed to be detectable, observable in Q1 of 2026. So I don't view that there's that high of a risk of just waiting a very little bit to make sure that inflation is starting to come down.
Austin, we have to go, but a real quick question, because we're going to get a lot of data next week. What's your sort of upper tolerance for the unemployment rate? Where does it start to get worrisome to you?
Look, it's always worrisome whenever it's rising.
Yeah.
It's been rising a little bit. It's been rising gradually. If the unemployment rate is 4.5 or under and stays there stably, as long as it's coupled with some of these other rates, the vacancy rate, the hiring rate, the layoff rate, if those show stability, we're not in the space that I'm.
But Waller says that hey, the unemployment rate or the job market, the way it looks now, is not going to be a source of inflation. So that's the reason why he's not worried about it.
You know, I'm only allowed to speak for my own views.
Yeah, I'm just throwing out another view.
I'm friends with Governor Waller, and I respect him quite a lot. So when he says things, I'm going to go analyze it. My read of the data, and we've got Chicago Fed research that backs it up, is wages are stickier than prices. So when things happen in the economy, you tend to see the prices go up first or go down first, and then that is followed by the wages. Wages are not a great leading indicator of prices. So I'm a little wary of over concluding from wage growth what you think is going to happen.
Austin, thanks for having us at the Chicago.
Yeah, it's great to see
the conference later on. Guys, back to you. Just a very quick correction. President Paulson is from Philly, not from Cleveland, but she's ex of Chicago.
Ex of Chicago.
That's not got all messed up. Anyway, back to you guys. Andrew.
Steve, thank you for a great interview, and Austin, thank you. When we come back on the other side of this, President Trump signing an executive order to have a single regulatory framework for AI. We're going to discuss the framework and what it means for big tech next. We're back after this. Welcome back to Squawk Box. President Trump signing an executive order issuing a regulatory framework for artificial intelligence at the federal level.
We want to have one central source of approval. I spoke to all of the big companies, great companies, and they won't be able to do this. This will not be successful unless they have one source of approval or disapproval, frankly. You could have disapproval too, but it's got to be one source. They can't go to 50 different sources.
And joining us right now, first on CNBC, is Sriram Krishnan. He's the senior White House policy advisor for artificial intelligence. He was inside the Oval Office yesterday for the signing of the executive order. We're thrilled to have you on the broadcast. And you've been working on this for a very long time. Tell us about the path to yesterday and how you've been thinking about the various issues at play and trying to balance them.
Andrew, thank you for having me here. Yesterday, President Trump signed an executive order that essentially gives us a bunch of tools to push back against onerous state legislation on AI. To paint a picture, right now, there are over 1,000 different pieces of legislation in all of the 50 states that are trying to legislate AI. And in this moment, when we are trying to compete with China in this all-important AI race, we cannot have the people building AI try and comply with over 1,000 laws in 50 states. President Trump recognizes that. He knows we need to win this race with China, that we're ahead in this race with China, and we need to keep it that way. And that is why this executive order was signed, to make sure that there is one national framework and not a patchwork of legislation.
Speak to how it's going to work in practice. And I ask because there was comments made yesterday that there were certain things that certain states have put into law around protecting children, for example, that you wouldn't necessarily go after. But some of those laws are attached to other things that you might feel less comfortable about.
You're absolutely right, Andrew. So the way the executive order works is it gives the White House a bunch of tools, starting with the DOJ, the Department of Commerce, to go after what we deem to be onerous laws. And over the last few weeks, we've spent a lot of time with Republican governors, a lot of time with the American people, and we are very clear that we will make sure that children are protected. Like anything to do with kid safety is absolutely not touched on by this executive order. Anything to do with, for example, copyright is a federal issue. But what we really want to go after, if you want to take an example, is something like what Colorado is doing, which is essentially trying to have every AI developer encode DEI into their applications. And we have Colorado doing this, we have California doing this, we might have New York doing this, and we just can't have this if we want to win this race with China. So you're going to see us start to use these tools, and eventually we know that this needs to be legislation passed by Congress. So we'll be working with Congress in the coming weeks and months to make sure there is a single national framework which makes sure we can win this race.
Well, that's where I was going to go with this, and we talked to Senator David McCormick about this earlier. I would imagine ideally you'd prefer Congress to enact a law as opposed to doing it via an executive order. And just what do you think it would actually take to get some kind of agreement on a national approach to all of this?
Well, I think this executive order really kicks off the conversation and really plants a flag in the ground for what we stand for. One, we want to make sure a bunch of equities are protected. We want to make sure kids are protected. We want to make sure communities are protected. We want to make sure copyright holders are protected. But at the same time, we want to reject some of the doomer thinking that the Biden administration had that was embedded in things like California's SB 53, which are essentially destroyed open source around the country. So the way we see it is the White House is now taking a firm stance where we want to push back on doomer laws that exist in a bunch of states around the country. And at the same time, we want to work with Congress so that there is one single national framework that protects our communities, but at the same time, make sure we win this race with China.
When you think about the phrase doomer, it's an interesting one because I know there's a lot of folks, even in the industry themselves, that have deep concerns about ultimately what happens with the technology and how it could both do fabulous things, but that maybe we are not, as a country or as a world, ready for it when it comes to jobs and job losses and what it does to society and culture. You have, you've done a lot of work in the Valley. What are your concerns?
Well, it's interesting, Andrew, because I think, I hear two schools of thought. One school of thought is that AI is overhyped and are we investing too much in the economy on it? On the other hand, you hear a school of thought which is that AI could lead to the Terminator and then destroy us all. And I think we sit somewhere in the middle. I think AI is a great tool. It is going to greatly benefit the American worker. Just to give you an example, the AI boom is a broad-based boom. I think when people hear AI, they think it benefits Silicon Valley tech billionaires. That's not true. The Wall Street Journal had a great piece the other day about how AI has fueled a massive rise in construction and data centers, and this leads to jobs. For example, each of those jobs for either electricians, plumbers, technicians, the people who make sure the concrete is poured, these leads to increasing wages and downstream impact. So this is a broad-based boom, and we are very optimistic about it.
Real quick, just the industry and how they're reacting, because it does seem like there's different schools within the industry about this. I interviewed Dario Modi, who's from Anthropic. They were building a super PAC, apparently, effectively that's on the other side of a lot of the issues that, for example, Andreessen Horowitz, where you worked previously, is. And so I'm just trying to understand what kind of battle and fight you're seeing, and to the extent that they came to visit with you, both sides, I imagine, to try to persuade you of their view.
Well, I think we have at the end of the day, we want American AI to win. I think we might have a slight difference of opinion in sort of the doomer views that some of these folks have. But essentially, in my view, AI is probably powering the U.S. economy. There are economists who feel that up to 2% of our GDP growth is coming from there. We are nowhere to see some of the risks that some of the doomers talk about. We are not seeing takeoff. We are not seeing AI that becomes sentient. There are no signs of that. So in our view, look, we're not ignoring the risk. If you look at the AI action plan, there is definitely, measures we have taken to make sure we're protected from the risk. But at the same time, we come at it from a space of optimism when it comes to AI.
Shroom, we want to thank you. Come on back. It's a longer conversation. We very much appreciate it.
Thank you for having me, Andrew.
You bet. Squawk on the Street begins after this short break.
Good Friday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer here at Post 9 of the New York Stock Exchange. Faber has the morning off. Bulls trying to build on Thursday's all-time highs, even without the help of AI, which gets some more curveballs today in the guidance from Broadcom. Fed speak is back. Long bond near 4.9. That's the steepest curve now on 2s10 since 2022. Our roadmap begins with the AI-driven tech slide going into day 3 now, as Broadcom becomes the latest company to fuel some worries. The president signs this EO issuing a single regulation framework for artificial intelligence, and that limits the power of the states. Watching cannabis today as well, surging in the pre-market on some reports the president will reclassify marijuana, Tilray alone, up more than 30%. Let's begin, though, with more weakness in the AI trade a day after the S&P's first record close since October, Jim. Today, it is Broadcom. Backlog a little light. Narrowing margins, no guidance on 26.
You want to buy Broadcom maybe at the opening, maybe if it's a little bit lower. And you do because the way that the conference call was set up, you found out that the gross margins on one piece of business weren't as good as people thought. So therefore, the overall projection of what they could do did not have the gross margins people want. It's almost as if these people don't know who Hock Tan is. Hock saves something. Hock always has something in his back pocket. This was just a very, very good quarter. Notice everyone raised price target. Almost everybody raised estimates. Look, if it was price target down and estimates down, then you would sell this stock down 25 as it was. But instead, it's the opposite. The numbers are real good. And you can see that, look, it was a difficult thing. I was watching the conference call. I said, okay, what the heck happened? And there were two different things that happened. One, the CFO said, hey, listen, this business basically is a rack business, meaning it's not as big. And then, you got that moment where you have, it was following us, is it, the talk says if the margin commentary was why the stock was down, it's basically it's an opportunity. We're saying at the club, an opportunity, because at the end of the day, there's more business, even a lower gross margin, maybe a new customer. So there was like new customer. You had very good business away from that one piece of business where the gross margins weren't that good, and everyone just keyed off that and sent the stock down. And it's kind of nuts. The key moment was when Hock Tan said it's a system sale. He said, boom, it's a system sale, meaning they're not selling individual chips. Now, just to go away from the weeds, this company is on fire, okay? They have Alphabet, they have Meta, they have ByteDance, they have Anthropic. It's possible, as Ben Righteous says, they have OpenAI. It's possible that they have ARM. It's possible they have Apple. They have everybody. So if you want to sell this stock, it's because you've decided data center's dead. Not because
or maybe you just wanted an AI revenue guy for 26.
Well, I just think that Hock is going to give you Hock's giving you that all the customers you wanted. He's telling you that look, business is much better than it was a year ago. He did sell one piece of business that was not a discrete unit but was a rack. I think that you get a chance to buy it because he's done this before. We've heard that things are a little conservative, and if the stock goes down, the boards of members of the direction just go buy it.
Right. One thing for sure, the year-to-date gains on Broadcom and Google are now pretty tight in contest with one another. And Hock Tan did have some comments, as Jim said on the call. Take a listen.
Now, will that mean that over time they all want to go do it themselves? Not necessarily. And in fact, because the technology in silicon keeps updating, keeps evolving. And if you are an LLM player, where do you put your resources in order to compete in this space? Especially when you have to compete at the end of the day against merchant GPU, who are not slowing down in their rate of evolution. So I see that as this concept of customer tooling is an overblown hypothesis, which frankly, I don't think will happen.
Okay, what he's saying in English.
Fear this man.
Oh my God, yes. I mean, it's almost $2 trillion company. Yeah. What he's saying is, look, NVIDIA continues to advance things. You can go with NVIDIA, it's expensive. You can go with your own, make your own. It's really expensive because you got to update every year, or you can use us, and we're the bargain. He's right. I mean, these are things that are cut and dry. Like if we had Jensen here, we'd say, yeah, at the end of the year, financial time.
Yes.
If we had Jensen here, we'd say, yeah, well, you can go with him if you want to. But what happens when we unveil the Vera Rubin? By the way, people aren't talking about the Vera Rubin or the Richard Feynman. These chips are what's going to make it so that they reason. And remember, once they get the power to reason, which right now they have the power to compile, they get the power to reason, that's when they will replace us unless we do a lot
Yes, and we're
more.
going to talk about the macro dynamics and impact on employment.
Oh,
Jim, at the
geez,
same
the
time,
Goldman guy, the new Costin?
Yep.
He's so bullish. I was like, I had to rein in my time, like, curb your enthusiasm, partner.
yeah, Goldman
Have
goes
some
to
respect for wood.
7,600 for next year. At the same time, Jim, we got the president with his new AI EO, basically one rule. Withholding federal funding for any state that tries to implement their own rules.
I just love that because it's not in the Constitution at all. Once again, what you think that the Attorney General is going to say, you know, Mr. President, that's not in the Constitution. It must be great to be president when you kind of just say what you want to say and the Constitution doesn't constrain you. Now, it doesn't constrain you because there's not someone saying, that's not really part of the Commerce Clause, Mr. President.
Well, I think the courts will constrain you, and they have constrained
Well,
him.
they do have a couple of guys in that court. They got that guy Gorsuch. He's like a thinking Republican. Not that they're not things. He's not an ideologue. He's looking at case by case, and that's your worst nightmare for a president who's trying to get whatever way he wants.
Right. Meantime, NVIDIA, there's a report out today considering ramping production of the H200 to meet demand in China, which apparently there's plenty of.
Well, that's my story, and they finally went with it.
Oh, that's good.
Yeah, I mean, I've been saying this, and people are like, no, Jim, didn't you know they didn't want it? Okay, so do you think that Jensen Huang says, I'm going to bargain with the president, put all my chips on the table, give them 25% surcharge because the Chinese don't want it? I mean, Jensen's you don't get your company to be a $5 trillion company by being stupid. Jensen has the customers. Oh, by the way, and then we see that ByteDance, well, they have to check with the government. They are the government. That's the whole point.
Yes. Then the other wrinkle, Jim, are data centers. This city in Arizona, a Phoenix suburb, rejects a data center. Evercore yesterday with a report on how MAGA opposition to AI in general and sort of progressive worries about data center, energy costs and all that are combining, and they think next year there might be some policy speed bumps in AI development.
It could happen, but there's them. But Patty Poppe, who runs, I think does a great job at PG&E, has done unbelievable work, which shows you how much the cost of electricity goes down when a data center comes. Unassailable, great work by a person who is so much more rigorous than these analysts.
Comes down for whom?
For the townspeople.
Well, why would that happen?
Because these guys pay more. They pay more than their fair share. They subsidize the rest of the town.
Then why would utility costs in data center heavy states be up 30%?
Because those states did not negotiate correctly. And they should go in and say, listen, we're charging you more. They wanted the business so badly, they gave it away. That's not what Patty Poppe wants to do. Some of these places just thought, you know what a boon for our country, but a boon for our state. But they forgot that you can't have them take advantage of your ratepayers. You have to shift it. It would have all done it, by the way.
Right, but your point is that the utility rates are like doubling CPI in large part because of the strains on the grid for now.
They have to go to the commissions and say, listen, we think that this is unfair. The commissions will go for them. The commissions take a little more time, but that's what will happen. I think 1/3 of the data centers will not be built.
1/3 of the data centers
will not be built.
Will not be built.
Our press releases. This is some work I did with Rusty Rizzo from RBN because they keep track of the actual amount of equipment that's being bought, and it's just not nearly as great as the press release.
Is that good or bad?
Well, I think that I don't want them to have to spend less money on energy because it's dead weight loss for them.
Yeah.
Look, I think that the peak was when Microsoft wanted to open 3 Mile Island. I mean, and then you start hearing about what data centers in space. Just cool it with the data center story. Let's see how hot these really do burn.
Yeah.
Next go around.
There was a lot of conjecture this week about how do you train an IT specialist to be an astronaut? What happens to motherboards when they undergo radiation?
Well, this is like when someone said if everyone adopts the GOP-1s, it's going to be great for the airlines because they won't have as much weight on it. I mean, honestly, we have to.
We had that discussion once.
Yeah, I know. It was like a substantive discussion about lunacy. Look, there are a lot of people who do work on Wall Street, and a lot of them, I don't know, they must be heavily involved with the change in cannabis. The Schedule 1 goes to Schedule 4, and they're like, you know, smoking a doobie and writing our research, and then we look at it in the morning and we say, "Ooh, wow, that's interesting."
Yes.
No.
We're going to get to the cannabis story. Pretty interesting after a long period of really no action in the space.
Right.
And we'll talk some retail as Calvin McDonald's leaving Lulu.
I had a lot on that.
Yeah.
I'm not as mean as the analysts, the first three who did not congratulate him for a good run. Have some decorum.
Yeah. We'll get some on the Fed speak we've already gotten this morning on a pretty busy Friday. There's a look at futures. More Squawk on the Street in a minute. Welcome back. With Christmas less than 2 weeks away, got a shakeup at Lululemon. Calvin McDonald stepping down as CEO at the end of January after more than 7 years on the job. Retailer has suffered from a slump in sales as well, of course, its stock price. Founder Chip Wilson did praise the change, also called the succession plan by Lulu's board a failure. Meantime, the company did post better than expected results last night. Jim, Wilson says, "It's clear to me that only under my increasing pressure did the board finally start to listen."
Well, we've heard this before from him. Look, the problem is, and by the way, just remember, he did triple the size. He went to talk more about revenue last night. The problem is that the segment's gotten very, very competitive, whether it be Costco doing a knockoff, whether it be Vuori, whether it be just a sense that the consumer will not pay their prices, so they had to do a lot of promotion. I thought Calvin did great for a very long time. In the last year, there are a lot of companies that have struggled. Look at Athleta from Gap. Every other part of Gap is turning. Atleta's going the wrong way.
Right.
This is a very competitive space, and Calvin did not have a great execution this year. And frankly, Thanksgiving was good, but right after Thanksgiving, it wasn't so good. Do you buy the stock because you think that Calvin's leaving? Because he's leaving? I don't know. I mean, those who bought Nike when they realized that John Donahoe was done destroying the franchise didn't do well immediately because the destruction was so great. I don't think Calvin destroyed the franchise at all. I think he grew the franchise. China was very good. He didn't execute well in America. There were too many SKUs, too many units, and it just seems like that it's not disarray, but it's it's down a couple, 1-2 in America.
Right.
It's just a very tough space, and it's not going to get a premium role.
So when you mentioned Nike, when you think about turnarounds and would-be turnarounds in progress, Target, Lulu, Deck, I mean, can you ladder some of those?
Deck too hard to turn right now unless you have a really cold winter like today for Uggs. Target, we have to see. That's a wait-and-see situation. A lot of people are jumping the gun there. Nike reports next week. They still had a lot of inventory, and Elliot, the new CEO, will tell you that China hasn't turned yet. We are buying Nike. I'm going to talk about it at a club meeting.
That's probably the most constructive name you're on right now.
Yes, and that's because I've met Hill a couple times, and if you're not constructive about Hill, then you should just get out of the game.
Right.
That guy's
But no, are any of them going to be like a CVS type? A rebound?
CVS turned itself from being a store to being a healthcare center.
Right.
Something that Larry Merlot was hoping that 2 CEOs ago. No, they can't because it's just too competitive. The apparel business has gotten very smart. I mean, look, I gotta say, like, I have an Eagles sweater from Lulu. And it's like, the NFL, when you're part of the NFL, that means you're kind of out of other partnerships. They did an American Express partnership, but that was a good idea. Nothing's working because it's so competitive.
Right. As for Costco, pretty good commentary from the CFO about consistency, although I did notice the sound bite's a little bit long. We have seen a deceleration in non-food, he did say.
Yeah, look, it has to be perfect with that logo. There are lots of fruit was really, really great. I mean, look, it's been lumpy. That's the word that they use. I don't want to see lumpy for a company that has a 45 multiple. We own it and own it forever. We're going to continue to own it. They're putting out more stores. I like that. But what happens is that if you're perfect and then you're not as perfect, people want to sell you. And that's where Costco is right now. I happen to like Costco, and I just want to, before people dump it, I do want to caution that this month's comfort and joy issue is so superior, including a terrific piece that talks about what you can do with grapes.
Have you ever been on the cover of their magazine?
I was in it.
I was going to say, I think I remember that.
I was very proud.
Yes.
Very proud. Jimmy Kimmel was in it too, but 'tis the season to be cozy. Well, look at this. Well, look at that. I couldn't tell that's not Lulu, that Eddie Bauer Men's Lounge. And boy, that robe is nice. Anyway, I just think that if you really want to go against Costco, again, another notice of your funeral.
Is a year-to-date Costco, Walmart a fair comparison?
Yes, because this is the year where Walmart really excelled and deserved the premium multiple, and this is the year where Costco just delivered okay. Its usual greatness. Now, the one thing that is missing, Richard Galanti hold years, but you had a CFO who was in there for 38 years, and he was magnificent.
How many straight earnings calls? Two.
Oh my God, 4 times.
Ridiculous number.
144. But I would say that that's lost. The consistency is lost, but the business is good. I'm not worried. If you want to dump Costco because of a couple of lumpy months, I suggest that you're buying Walmart at the same multiple of those, and Costco is the one that has a lot of upside, including a lot of delivery, including a lot of e-com that they haven't had, maybe even advertising, which they haven't done. They've had to add new stores. Why? Because there's so much business. But there's the hard deceleration from people who came online is visible. And the fact that there are months that weren't that great is visible. And so you can't have any flaws when you have them.
Meantime, interesting poll out of AP today. More than half of shoppers say it is harder than usual to find goods that are affordable enough to buy for holiday. B of A's also got some analyst survey data. 2/3 of analysts think that prices are probably going to rise next year, not fall.
I think that they might be wrong. Remember, I'm thinking that the consumers had it, and if you keep your price as it is and you take some margin pressure, you're going to take share. And in the end, right now, you want to take share. And we have a stock up there right now at the bottom, TJX. That is a monster share taker because they have kept prices so low. And when you go to the TJX store, which I really like to go to, or when you go to Home Goods, which I love, the prices look like the old days.
So then when you say the consumers kind of had it, you think that chart says something?
Consumers don't, you know, consumer is furious. The consumer just doesn't understand how people thought they could get away with price increase after price. By the way, the consumer packaged goods guys, holy cow, right? Price increase after price increase, we're done. America doesn't want that. Now, some of it you can rebel with Walmart, but you can also make things. I mean, every weekend, there's this giant vat of something that smells really good in our kitchen. And it's my wife making the dog food because it costs too much.
What?
Yeah, she makes
Lisa's making dog food.
She says, listen, that's how we didn't get rich not being frugal. Okay, and that's where the big savings is versus farmer's dog. All right, I mean,
wow.
I don't know. I used to feed my cats whatever Purina.
Yeah.
I was gonna be the chief spokesperson of Purina, and then I kind of wasn't in the same household. It really kind of hurt to do it.
You were a spokesperson for Purina.
Purina.
I would have liked. We got to pull some of those ads one day.
Oh, real good stuff.
We'll get Kramer's Mad Dash countdown to the opening bell on this Friday. Take another look at the pre-market. Don't go anywhere. Take a look at a split pre-market. A lot of chatter this week about the ability of the equal weight S&P to outperform thanks to banks, thanks to travel and leisure, thanks to materials.
Yeah, exciting week.
Yeah, even as the tech trade turned a little bit this week. We'll talk more about it in a minute. Get the opening bell on this Friday. And one more reminder, you can catch us anytime, anywhere. Just listen to and follow the Squawk on the Street Opening Bell podcast.
This is a market we've never seen before. Not a time to underestimate risk. Tariffs are disrupting supply chains and driving higher prices. There have been 16 different tariff announcements over the past 10 months that have resulted in significant resourcing, product delays, out of stocks, and driven multiple rounds of price negotiations and increases. I'd say it's going to be predictably unpredictable, like just what we've all had to navigate and deal with. And I mean, there's still changes, like, you know, who knows, there could be a whole new round of tariffs. I mean, the Supreme Court could say, hey, this is illegal. And then all of a sudden it's going to be, you know, if you read the news, there's going to be these things happen, those things happen, those things happen, this changes, that. Like, we'll improvise, adapt, and overcome. That's what we do.
Gary Friedman last night guiding lower on margins, takes us to a mad dash.
No, it was not a call that if you're looking for upside. I think that in some ways, and I went over this with Ben Stotis, my research director, that RH is the housing as strategy is to Bitcoin. I mean, they're linked.
You mean like a leverage play?
Yeah. And I feel like that if you're really sure that housing's going to come back, really, really sure, because if you're just kind of sure, that's Home Depot. If you're really, really sure, you buy RH because he's set up. It is a delight to listen to this man. He's got RH Paris. He's talking about how great it is. He's such a big thinker. And when you go to any one of these galleries, they are so much fun. But they got to sell more. And they got to sell more high price. And the tariffs have to stop being just so prohibitive.
A tariff skeptic would say if RH is having trouble managing complexity, what's a small business expected to do?
Well, Wayfair's done okay.
I mean small.
Business, so no, I don't want to be small.
That's the point, right?
No, and one of the things that Gary has stressed over and over again is those are the guys that he is really pushing. He doesn't do it deliberately. He's a great man. He's a great man, and I really respect what he's doing. It's really fun. His places are really unusual and terrific where they go, but they're not making enough money. And that, in the end, is the game.
Been a tough year. Has been a tough year. Let's get the opening bell here in the CNBC Real-Time Exchange. And the big board, it is Chipotle celebrating 4...
Okay.
A bit of news out of SoftBank looking to make an acquisition. Well, so all things to keep tabs on.
So those sales for Tesla near multi-year lows. We'll also have Lululemon in the news as we break and have the opening.
Well, they're going to rub that in.
Good to see you, Sam Vadas. Thank you. Here's the opening bell.
So I got a solid support at 687.29 today. Shut up. On SPY. 687.29. Yeah, I guess I'm right in time on the bell. Didn't have enough time to take off my shoes. Didn't have enough time to take off my shoes. Okay, we've got tweezer bottom. Today's the 12th. The 689 strike. Diane looks lovely today. Hammock says private credit does not appear large enough now to create systemic risk. Systemic. AVGO. God, look at AGVO. Oh, man. Well, we're still overbought. They could drop another 20 bucks. Be a little patient today. There goes the breakout. SPY broke the VWAP, and the 200s sound like a better support today. Oh, yeah. NVIDIA, Amazon, Tesla boom. We got pot stocks to watch. Okay, we're coming back down on the SPY now. We're retesting. Prepare ye in the name of the Lord. We got an ascending setup. Ascending triangle setup. So we got a new resistance at 688.56. 10-4. That's my story, and I'm sticking to it. It just looks so high, the SPX. We're at the VWAP on /ES. So let's see if we get a pullback or a breakout. Damn. Could have got a buck on SPY. They were pumping Adobe yesterday. AMD looking nice. And Lulu is getting a new CEO. That's why that stock's up. Today's losers, Broadcom. Chewy down 39 cents. Yeah, Broadcom's the only big loser today. And the winner is Lulu, Coin, Love, and American Airlines. Dang, she looks hot today. Come on, Nicole, let's get it on. I ever tell you I had a huge crush on you, baby. I gotta see what Disney's doing. Now, I thought they had a big strike about AI. Not Disney, but the movie. So you'd wonder if that would affect the Disney stock, and why Bob Iger would buddy up with OpenAI. Didn't make sense to me. But nothing ever does. I missed my chance here on the double bottom. I wasn't set up. Oracle's kind of down. Mr. China. Yesterday I called Apple out, did pretty good on it, $50 a contract. Yeah, I accept that. I'd like to check out her jewelry box. Open, I called out Open yesterday at that low. We're up about 30 some cents. Okay, here's the knife on the SPY. Prepare ye in the name of the Lord. Double bottom. SPY double bottom. SPY double bottom. 85 cents. The 689s. SPY double bottom. Tight stop on this. I don't want to be adding on to it. There's the double bottom right there. We want it to hold. Everybody's going to wonder, how does he do it? It is Friday. Dun 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 rum pum pum pum. some risk. Ooh, 85 cents. I'm gonna add 5 more and make it 10. Come on, baby. I think you know what to do. 76 cents. Do 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 da da pa pa pa. Me and my drum. Come on now. Disney moving up. AMD pulled back here. NVIDIA at a double bottom. And we got Meta at a double bottom. Apple's holding up. I'm even. We're at 82 cents now. My average is 81. Rounded up. Come on, baby. SPX. Oh. Come on. This ain't looking too hot right now. Jenny Horny. I'm going to look at SPX here too. Oh, God. They don't look good. No. Now I'm thinking I did a big mistake. Oh, there's my support level right there. Might stop out if we don't hold this support. add another 10 if I get back down there again. I'm down $200, 180. What you got to say, Kevin?
Higher, but that does not necessarily mean that the markets all automatically have to break down there. So
yeah, this ain't. SPX is going down. SPX 12th. They're not two 6900s. Still in my calls. We hit my support. So if I was to get him, I'd get him here. But we got to hold this support. Okay. My turn 73. Come on, baby. Tempting to get another 10. We got a head and shoulders kind of forming here, or we could dive down a little bit farther and hit a different one. That one or straight across. And we hit that. Right. Oh. Well, what did I see there? No. Yeah, it's going to come down and hit this one. Right there. That needs to hold. Ugh. We're at the orb on the SPX. This is it. Not looking too good for Bobo. More knife on the SPX. We got a triple bottom on AMD. That just busted. Double bottom on the QQQ. SPX is at a pivot point. The SPY just keeps going down. Down 400 on SPY, or 400. We're at the 63 on the hour. We got a triple top right here on the SPY right now at 686.49, 686.50. Triple top support. Take off my shoes. We had a pretty good run on it yesterday. A real big run on it, actually. We didn't hold the triple top. Oh. Got a new mouse padding. Throwing out 2024. Had it for 2 years and held up pretty good. There's another support. So, this is a major one right here. If I had 600 more, that would be that'd bring me down to 46.
We had a gentleman break into the dining room on our property yesterday about 8:30 last.
Let's get the reversal in. Average is 47. Come on now, don't do this to me. Tilray and Canopy Growth stocks surge on reports that Trump to loosen marijuana restrictions. That'd be a tough thing to do. Liberals would vote no just because they wanted to do it. But if they support the cartel, I don't see why they wouldn't vote yes. We got 3 black crows on the 30-minute on /ES at the 200 EMA. I think that's what I have on here. Yep. And the hour says we can pull back more. But the 30-minute, we're at the 200 EMA. And we got 3 black crows on the, again, on the 5-minute. With an inverted hammer right at support. And now we just went below the 200 EMA. On the 30, we got the 200 SMA right here, I think. Yeah. Then we have 3 black crows with an inverted hammer and a doji right now. Well, looks to me like I got on the wrong side of the tail here. 5 minute on the SPY has 3 black crows, and now we're hitting the bottom of my, what channel is this? My second support channel. Just now hit at 685.31. I'm not gonna make a coffee. Pretty good sell-off on the SPX. So Jimmy, well, he's averaged down 3 times. $685.31 is the bottom of my second support. I should load a bunch more on here. They're cheap right now. Get 30 of them, put another $900 in it. That'd really bring me down. That'd give me 38. I'd have 60 contracts. It'd been nice if we'd have held that inverted hammer right there. Start to build above it. And get it back to the top of the orb, or the bottom of the orb, and get out of it. We'll go start my water and walk away for a second. That usually helps. That or play a song. They were saying Oracle was the cause of the problem yesterday. And it's back at support right now. This morning, 192, just above 192. So we got we got a change in pattern here. We're going to see if we're consolidating. That's bullish. That's kind of bullish. But that is bullish. The tweezer bottom. It would have been nice if it went straight up from there, but it didn't. Dadgum. Come on. PLTR down today. Google's down to 310.39 with a new low. That's on the 5-minute. Well, 1 minute we're holding that support channel. Second support channel at 685.31. Well, not good. I'm down $750. I made that in one trade yesterday, but it looks like we're going to go down to the next support level. So these are getting cheap for me. I mean, I could really load up here. $750 and I get 30 of them. But I'd rather wait for 684.10. I'm down 720. I'm gonna make me a cup of coffee and just kind of relax. This is hard on the mind if you let it get to you. Because we could come down here to this next channel. And that support level's right there, 684.10. It'd probably be 20 cents. Right here. So I'm going to give it a shot. Right now. See how much that would be. $630. Yeah. $0.21. Average 34. Let's see if I get lucky. Open's back, getting down back to support. Oh, come on, Jimmy. Let's go. Right down now, down $9 a contract, and I got 60. It gives me about $2,000 in the trade. $2,040. We're at 26. I need 34. I'd like to see 40. Now we're at the 9. $480 down. Now I'm down less. Let's go. I should jump in the SPX. I'm gonna go grind some beans and I'll be right back. No, I don't know if it's a megaphone on what. Apple even pulled back. Tesla pulled back. been $7 contract. I'm at your favorite number, Randy. 420. It's a lot better than 800. Let's go. Don't stop here. I'm gonna go get my coffee made. Keep an eye on this. $29, it's looking better. Damn it. It's back to 29. Come on, baby. Right now I'm down 240. We've got a yin yang right here, right at the 63. So if it decides to shoot on up, better I take the loss at $240 and relax, but then it's going to run up on me. I'm still too far out of the money. That's my issue. That's a bear flag. Okay, we got a 1, 2, 3 triple top. Down 420 right now. I need a tweet like Adam Schiff been arrested or something.
Something we're watching as well. Thanks so much for that, Alex. Really appreciate your insights and what's driving these markets, some of the action we're seeing beneath the surface today. Let's widen our scope now and take a look at over abroad. Global markets getting a lift from Wall Street's record day yesterday. Asian stocks rallying. The Hang Seng Index leading the region higher. The Nikkei 225 and the Kospi.
Now, I'll probably be even if we can hit the 63 or the VWAP, but we're at a resistance here.
ASML remained under pressure. In international tech news, China is reportedly now weighing incentives worth up to $70 billion to back its domestic chip industry as it continues to pour state capital into getting ahead of the US. SoftBank is reportedly studying potential acquisitions, including US data center operator Switch, as part of Masayoshi Son's AI expansion plans. The two companies are said to have held talks at a time when Switch is planning to go public as soon as next year. On the macro front, the UK economy surprisingly shrank last quarter, GDP contracting 0.1% from August to October, more than expected as services and construction weighed. Sterling slipping this morning against the greenback. The numbers help build the case for a rate cut from the Bank of England next week. It's a central bank bonanza. We'll also be getting decisions from the ECB and the BOJ. All right, well, coming up, it is time for Inside Out, and we'll take a closer look at Lululemon and bring you an example trade for that name, which is rallying today when Morning Trade Live comes back.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
That could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor?
You got a rising wedge.
It breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time
Yep, I'm gonna have to break the
analysis from U.S. equities to
break the 63 for it to go up higher.
Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com. Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand. Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
We're back on Morning Trade Live. Here's a look at how some of the top athleisure names are trading today after Lululemon reported earnings and announced the CEO Calvin McDonald is departing in January. So we have Lululemon among one of the best performers on the session today. We're off the session's highs now, but still a comfortable 9% rally there. Deckers Outdoor is also higher, but the rest are lower. So it's a mixed performance across some of those retailers. Let's go inside out on Lululemon after these earnings. A pretty good report from this company. Joining us now is Sky Cannabis, who is the principal analyst at eMarket. And thanks so much, Sky, for joining me this morning. So what exactly was it in this report card and what the company has to say, which is behind this 10% rally we're seeing this morning?
The resigning of the CEO.
It's really coming down to the CEO transition announcement.
Exactly.
Lululemon has been stagnant for some time, and I think it's an acknowledgement that what McDonald was doing wasn't working. They have talked a lot about newness over the past several quarters going into 2024, so there's really nothing new about that. But they haven't realized that and been able to bring that into stores in a way that can really resonate with the customers in the U.S. That's really their core market.
Look, I mean, it's a very different quarter, particularly when you looked at the language that they reported 3 months ago. I mean, they were talking about how they were pressured by tariffs, pressured by consumers. They knew that they'd lost their edge. They talked about being too predictable. They talked about being stale. So it's been an interesting reaction as far as investors response to the expected leadership changes. But how can the market be so certain? Do they have some sort of idea of, who's going to come in next, and, how confident can they be in such a turnaround? Or is it just the fact that at least this CEO, which, has seen a performance like this in Lulu, is on the way out?
No, they don't have a set CEO in mind. I imagine that given the timeline for the transition, they will be engaging in a search. And I think they really need to look for a CEO who can reimagine what the brand represents and how it shapes and participates in culture. They really need to respond more quickly to trends in the market, and they need someone who can bring in a fresh dose of creative talent as well. I think we can look at what Richard Dixon has been doing at The Gap with Zach Posen as creative director, and that's really been working to bring back the brand heat. And that's something that Lululemon has lost over the last couple of years.
Okay. It's interesting because, I was speaking to some analysts throughout the course of the quarter about, this potential for a comeback. And there seemed to be some conviction in this outgoing CEO. But look, let's see who comes in next and whether we can sort of see a turnaround story. Let's get back to the numbers now, Sky. I'm just wondering, it's interesting because they still saw pressure when it came to revenues. I mean, particularly comp sales here in the US. It was just this, amazing outperformance that we've seen in international markets that managed to offset the softness here. So what did you make of that?
That points to the real challenge with the U.S. consumer. During McDonald's tenure, he managed to triple Lululemon sales. And a lot of that did come from expanding the customer base in the U.S. beyond the millennial consumer to Gen Z. Even Gen Alpha and tweens really sought this brand out. And those customers have now moved on to other styles, other
Well, looks like I'm out of luck on this one.
Lululemon look, and to other brands as well when they are looking for something.
We did hit my third support channel.
And so the black leggings, that's really their staple. They need to move well beyond that.
We had 3 white soldiers with a doji on the 5-minute.
Okay, a bit of a newness, innovation, perhaps is something that some of those consumers are looking for at the moment. Sky, it's been an absolute pleasure. Thanks for breaking down the earnings report for us and the reaction today. Sky Canavis, who's the principal analyst over at eMarketer. Appreciate it. Let's trade it now with George Sillis this morning, senior markets correspondent. An example trade for us this morning for Lululemon. George, good morning.
Yeah, good morning, Sam. Well, what I'm going to do is I'm going to trade what's going on with price action today. Obviously, Lululemon's having a great day so far. It's actually come off the high, so that's meaningful as well. But in the context of the trend, the intermediate trend is still to the downside because the stock is trading below the 200-day moving average. It certainly could continue higher to that level, at least in the near term. But at the same time, with that level or the stock trading below that level, we could certainly see a gap fill reversal or retracement back to essentially some levels we saw earlier this month, back to December 5th, but also corresponding to levels on the chart at that 192.50 area that go back to September of this year, where they reported their most recent last quarter's earnings. So with that said, it can go in either direction. So I'm going to play this as a continuation trade up to that 200-day moving average, or like I said, a potential gap fill back to the 192.50. So I'm going to go to January, and I'm going to structure a put spread, and it's about 36 days to expiration. I'm going to sell the 195 put, and I'm going to buy the 185 put below that. Now, altogether, you could earn about $3 a share in credit or $300 a contract in this position. So the whole premise behind the trade is for the stock to hold, at the very least, the 195 level. And if it does breach that or below that, 192 is your break even. Again, that's right below that 192.50 gap fill that the stock could certainly retrace back to. But at the same time,
SPX has a double bottom here.
Premium will roll to zero, and that's the objective as well. Now, just in case it falls below that 192 break even,
I need a good trade, a miracle trade.
Which is $7 a share or $700 a contract. Not only occur if the stock hits 185 or lower by expiration. So it's a tough position because, again, the stock is trading off the highs from earlier today, still below that 200-day moving average. But again, the stock could go in either direction. I can't say which way, but we have to play some positioning on both sides.
All right, a good example trade for us on Lululemon today. Shares up about 10% in trade off the back of this earnings report, a leadership change as well. 203 and change right now. Thanks so much for that, George Sillis. I'll check in with you a little bit later. Let's just check in with these markets right now because we've seen a little bit of a mixed picture across the major indices. We have actually seen the Dow now dipping into the red just briefly. So we've got technology under pressure today. It is a little bit of a more risk-off day than we'd seen yesterday, as we did see these records. So we are coming off on the S&P 500 as well, 0.8%. We still see some rotation beneath the surface, but an earnings-driven day, not a lot of macro data to work with. But of course, we are tracking these lines coming from various Fed speakers as well. Goolsbee, Schmidt, the dissenters. We'll be breaking down the rest of that throughout the course of the day. I'll see you on MOC later on, but thanks for joining us here on Morning Trade Live. I'm Sam Barnes. Download the Schwab Network app, available in the Apple App Store, and tune in 24/7 on schwabnetwork.com. We've got Trading 360 coming up next with Marley Caden. Have a great rest of your trading day.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you.
Well, we'll let that one go.
Of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education.
Tilray just had a little bounce.
It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy. From the opening bell to the closing bell, we've got you covered. Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
God, look at the SPY drop.
We break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand. Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
2025 kept investors on their toes. Now, get ready for the road ahead. Join Schwab's panel of experts on December 11th for 2026 Market Outlook, your guide to the forces shaping stocks, global markets, inflation, rates, and more. Hear from experts on where the markets may be headed, spot opportunities, and see what could drive your portfolio next year. Tune in on December 11th at 7 p.m. Eastern on Schwab Network.
I'm Sam Barnes, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network and SchwabNetwork.com.
Well, the only thing I can do now is recoup and start fresh. I've been on a damn roll for a bit. It's about to happen.
Good morning. We're 90 minutes into the trading day. Welcome to Trading 360.
We sure are.
Carly Keaton coming to you live from our Chicago headquarters. Here's what we have coming up in today's show for you. In our 360 Spotlight, we'll highlight Serve Robotics after the company announced it achieved its 2025 goal of deploying more than 2,000 delivery robots. And Coinbase is set to launch a prediction market and token.
I watched that video, Livid Goose, this morning. I'm going to watch it again, do some homework on it. If you go to Washboardjim's videos, there's a video in there of a different strategy that I'm going to kind of study and see how it works. I got to make back here. I'm still in this trade, but I'm going to try to salvage what I can.
of 0.9% at 25.6738. On the 10-year, we are higher today, up to 4.19. That's up almost 0.9. The dollar at 98.06, mostly unchanged. Gold is up 1/3%, 43.2590. Crude oil is falling today, down 0.5%, 57.28 a barrel. And Bitcoin still managing to hang on to that mentally important $90,000 round number threshold, but just barely down about 2% at $90,100 right now for Bitcoin. I do want to take a look at one of the top moving stocks today. One of the big stories we're talking about, joining us right now, Alex Coffey, our senior equities contributor here on Schwab Network, to talk about Costco after their earnings. We did see Costco hit a new 52-week low. Walk us through the report and why we're seeing this reaction.
Yeah, Costco under a little bit of pressure here today alongside the overall market, down about 1.6% on my last check. Marley, first quarter results from the company, largely better than expected, but again, this company, even with its pullback, has carried a premium valuation. Revenue up about 8.3% year over year to $67.3 billion. That was ahead of the estimate just slightly. If you were to break this out into net sales, just shy of
Jimmy said cost was a little overvalued yesterday.
Year over year gain, which was again ahead of estimates just slightly. Membership fees up 14% though year over year, driving some of the outsized revenue growth. Earnings per share, $4.50, was better than last year's $4.04 by quite the margin, and the estimated $4.28 that I saw in terms of where the street was. So beat expectations, quite a bit of growth year over year. On a comp sales base, whether you include gas and currency fluctuations or you take them out, beats across the board, not only here in the U.S., where comp sales were 5.9%. But also in Canada. In Canada, 6.5% was better than
800 would be
expected,
grand.
8.8%. The company plans to open 30 new stores over the next 3 years, and they're increasing their real estate team to support that operation. When you look at this situation, Marley, one thing that stuck out, Vital Knowledge pointing out that the solid EPS represents higher membership fees and a 16-cent tax tailwind.
Well.
Think about maybe that's partially why the street not reacting quite as favorably as maybe the numbers would have suggested.
Oracle's nose diving.
Where they've sued to ensure that they get reimbursed for any levies they've already paid if the tariffs are struck down. Was there any commentary about tariffs or the lawsuit or even how they're impacting sales during the holiday season?
Yeah, it's a situation that they're still ongoing, and there's obviously stuff that's going to take place in the Supreme Court that's going to ultimately determine that. One thing that did stick out to me that I think ties more to the investing nature of this and maybe less about the tariffs that I think is worth noting, though, Marley. Truist analysts coming out, they have a hold and a price target of 1,033, point out that the trends in this first quarter are very similar to the trends of the fourth quarter in terms of steady, continual share gains. But they talk about how they had downgraded the stock last fall, largely because it's just an expensive stock for what it does. But they think that they're slowly but surely growing into that valuation. So some of this pullback at some point might make this an attractive buy.
And Oppenheimer sort of echoed a similar thing in a note I saw saying that even though the results were generally in line with expectations, doesn't mean investors should be disappointed. But, seeing shares down about 1.5%. Thanks to Alex Coffey for breaking that down for us on Costco. I do want to welcome in our next guest, though, broaden out our conversation here. Joining us now, Chris Vermeulen, the founder and chief investment officer at the Technical Traders. Chris, thank you for being with us today. I, of course, focused on Broadcom's earnings. We had Oracle pulling down the markets yesterday. With these big AI names seeing these massive double-digit drops, can we sustain this rally, or do we need to be concerned about the AI tech trade?
Yeah, that's a good question, Marley.
Good question, Marley.
Aren't that magnificent anymore in terms of their price action. If you were to look at them as a basket as a whole, they have been struggling for the last couple of months, and we've got some stocks hitting all-time highs like Apple. We've got Nvidia, which is struggling. And
Magnificent Seven
coming out warning that, hey, the AI momentum might be stalling here, and if the Magnificent Seven isn't going to go a whole lot higher or higher at all, in fact, that is going to definitely hold the stock market down, because the majority of the stocks, they're not really all hitting all-time highs for the stock market. The Magnificent Seven has definitely dragged the whole index up because of the weighting. But we are definitely seeing a rotation kind of away from the Magnificent Seven.
We got a double bottom on the video.
Rotate into small caps and micro caps like the Russell 2000 or the micro cap stocks themselves, showing people want to take risk right now, but not so much in the big Magnificent Seven.
So as we see
Google's at my lower support.
Into the micro caps away from the Mag 7.
304.97, 305.
Or is this just a seasonal blip we're seeing?
I think it's a calendar, kind of a seasonal thing. I think we're going into that kind of Santa Claus rally. Momentum is definitely moving into the risk-on stocks. We are seeing a very diverse mix here. We used to see money just going into the Magnificent Seven, but now we've got the precious metal space coming to life. We've got the micro caps and the small caps, which are usually very volatile. And people are in that holiday season. They get bullish, they get excited.
Christmas stock, Amazon.
Trend still, and so people are moving into those aggressive stocks. So I do think it's
always
momentum, a bit of a sentiment shift. People generally are feeling good for equities into the end of the year, and they're buying it. To me, it's a little bit of a contrarian indicator. Generally, just as the small and micro caps come to life, usually we tend to see the overall broad market actually shows signs of weakness, which is what we're seeing. The Magnificent Seven.
Apple I traded yesterday, and there's Goog.
Some signs of weakness, but money's still kind of rotating into those growth stocks and individual sectors right now for the holiday rally, I think.
All right, you mentioned metals there, so I do want to talk about this. We saw gold hit a 7-week high this morning, silver hitting another record high. As we look at that, I know you have some ambitious
I got some silver.
For both metals, so I want to talk about it. But also, you just mentioned some warning signs. Do you also consider the metals trade and
not
the
stock,
performance we're seeing in
actual
metals
silver?
A warning sign as well?
I do. I think it's a very big warning sign. Gold, when it dramatically outperforms and the stock market in general for an extended period of time, which is very similar to the price action over the past couple of years of what happened just before the 2008 financial crisis, market top there. So we have the same scenario. When everybody moves into precious metals, it means people don't trust systems, they don't trust governments, they're worried about currencies, the economy weakening.
Been thinking about selling your silver?
It's a global barometer saying that something big and bad is probably brewing. And so, you know, right now money's been flowing into the precious metal space. I still see about a 15% move up in gold over the next potentially month or two. I think we could see gold rally to about $5,175. I think silver,
we're all silver
collectors,
collectors.
$68 and potentially go up into around $82 a share. So there's some really good moves here. Now, I do think they are going to be explosive. They're going to happen soon. But after that, I don't know if you're going to want to hold them, because typically if the stock market does start to stall out, then we could see the precious metals pull back. So I think there's a great trade here in the precious metal space going forward.
All right, you mentioned GLD.
She just got through saying it was at an all-time high.
Upside. I want to talk about last time you were here. We
Lying
talked about
bitch.
GLTR, which is a precious metals basket ETF. You called for a pretty significant rally there, and it has rallied. So, you know, let's talk about some of those plays. You also talked about copper miners, also up, not quite as much. I think you called for 17%, is up more than 11% right now. You know, as far as those metal plays, are they still in place here as we wait to potentially
No,
hit
it was
the
this
peak,
morning.
or would you be exiting those positions as well?
I think when we hit the peak, you're going to want to exit. pretty
Okay,
much
I take
all
it back,
precious
honey.
metals. We're in a sweet spot right now for the precious metal space, the whole complex. If it's a company.
You know, at first I didn't care much for Marley, but she's kind of grown on me. We're at yesterday's low on Meta. I kind of like the question she asked, and now, but at first I didn't. I think she's changed a little bit. Oracle's rebounded a little bit. Ascending triangle on that pullback. Well, I'm not going to have a red day today. I got to look for a good trade. Might go and cook my soup and have lunch while I'm waiting. So all the Magnificent Seven are red. And today's loser is Nvidia, with Amazon, Meta, Google, Microsoft, Tesla, and Apple. The high volumes are Nvidia and Tesla. Tesla had a real good run this morning, but I don't know why. They said the inventory was down, selling. So let's put that back over here. I want to go through my watch list. Which I got CRM on here. Let's see. They were pumping Salesforce yesterday. Well, shit. CRM's still bullish. AXIL. Pet's at 293, and what about that Chow, CHOW? Back to 105. Maps. MAPS. Array. GRWG is one I used to trade. I used to like this one. GRWG. Pot stock. OCG. Is that a pot stock? Oriental Culture Holding. Online platform affiliates e-commerce trading. Artwork, oh no, I don't like that. That's definitely a pump. Oh. I got an emergency. Got an emergency, I gotta go. I'll leave the TV on. I have an emergency, I gotta leave. Shit, that sucks. I don't think I'm gonna make up my loss now. I might be gone about an hour, depends on what the problem is. So, let it be said.
Right around 238. Meanwhile, our 63-day EMA in orange, that comes in here near about 210.41. So for the most part, our moving averages do still seem to be diverging farther apart from each other. If they start contracting and the distance between them...
I'm going to put the 5-minute chart up here, because I think we've hit that bottom. Oh, God.
One of the main goals of technical
We really went down big time today.
Trend change as early as possible.
So that was my last
Make sure
support.
it's not a false signal.
So that's going to become resistance.
Something like that here. So you want to be as early as possible when you're sure it's changing.
Dang, I hate to leave.
You could try to look for. We can also see RSI, kind of a curious situation here of bearish divergence mixed with repeated entries into that overbought area. So that can be a very challenging situation for newer traders to make sense of here, because even though we have strong price activity to the upside, the pace of the gains is starting to moderate a little bit here as we're at these highs. So for now, we do still remain above that 50 midline here. We're also still below our trend line though. So if we do start to break down, a push below the 50 midline would be noteworthy and could be another potential trend shift indicator here. When we look at our volume profile study, we can see that the nearest volume node lines up with our 21-day EMA there, so some extra emphasis on that as a supportive level. We can also see here our +1 standard deviation channel, which is 1 standard deviation up from our teal linear regression line there. That comes in at 255.50. That could be a shorter term upside area to watch for potential resistance.
Yeah, right now at 242, but just to highlight how impressive that steep move to the upside we've seen so far this year is, it's 188%, a little bit more than 188% for Micron. But a very interesting setup going into their earnings with some of these big tech names really under heavy pressure here. But now we're going to pivot to a completely different space, one that's been relatively under pressure in this sort of casual dining segment with Darden restaurants. They'll come out Thursday morning. You can see some of the choppiness here in Darden's chart. They've got some gaps in place here. What's their setup look like as they come into their report?
Yeah, gaps indeed. One of these charts where there's kind of two very distinct phases here, punctuated by earnings. I mean, you can see very obviously this was where earnings came in and did not go the way the bulls would have hoped for. Still, though, we do have some horizontal lines that remain relevant. 195 back here was a couple of our relative low points here. That's about where the high came after the gap down. That's about where we topped out a second time. You can often see that old support becomes new resistance and vice versa. Certainly, it doesn't mean this is an impenetrable wall that price is going to stop at if it reaches it again. Rather, we're trying to look for inflection points here where we have a chance of a breakout occurring at that level here. That would be the notable level that could trigger the cascade of orders that results in this energetic push to the upside here, or to the downside if we were looking at support. Similarly, the 180 level here, our green line, if you were to backtrack all the way over here, you can see a repeated low area once again at that 180, 181 level or so. It was our breakdown point here. It was about where we hit some resistance once again after things started to stabilize. So now we've got kind of this V-shaped price activity here. Our blue trend line has been broken. We're within the boundaries of this white shorter term channel here. What you could do, draw a trend line going across those lows, duplicate it, put it across the high point here. It gives you one area you could consider looking for resistance here. Again, not a guarantee it's going to stop there, but you could say, looking at this, well, maybe once we hit around that 190 level, 180, 89, 190, you might see resistance come into play again. Just something to consider. So when we do look at our moving averages as well, we have crossed above our yellow 21-day and held on above it. Today, we are crossing above the orange 63-day EMA. Not really making a ton of progress here, and we're backing off a bit from those highs, but 183.84 is where that particular indicator comes in. We also have our long-term purple 252-day exponential moving average, roughly in line with our upper boundary of our channel there. So 189, 190, 191, that general area gives us even more of a resistance area to consider here based on that. RSI trending upwards still. We can see that our green trend line is still in play. Our blue trend line for price matches the breaking of our red trend line here. Kind of the opposite situation from our last chart here. Repeated entries into the oversold area, the threshold below 30, typically a sign of weakness in a trending market. Indeed, it did play out to the downside here, but for now, 169 seems to be the low point that we've established here as a foothold for the bulls.
when we finally look at our volume profile study, point of control, the heaviest trading area comes in at 188.24. So this would be the congestion area that the bulls would need to break through on the road to retesting that 190 area here. And then just above, 195 matches up with our teal linear regression line and another volume node. So there's some potential hurdles here that the bulls would need to overcome. Meanwhile, to the downside, a very small node comes in right here. You can see that spike that's right around that 180 level once more.
You know, we're right above that right now, 184.32. But you mentioned this is a very mixed stock in terms of analyst coverage. We've got bullish calls from JP Morgan, B of A, Truist, Morgan Stanley, Evercore ISI, Barclays. Bearish calls, TD Cowen, Baird, Raymond James, KeyBank flagging higher food costs, smaller portion offerings. So will be a very interesting report to cover. The average price target right now is about $220, so still showing some upside from where we're trading for Darden restaurants in advance of their earnings report. Our last one is Nike. You know, analysts looking for, investors want commentary on anything around their turnaround plan and how effective it has been. Expectations right now are for EPS to decline about more than 50% and a drop in revenue also of about 1.5%. So as we look at the technicals for Nike, what does the setup look like?
Yeah, you know, in mythology, Nike was the goddess of victory. She's the winged goddess here, and they could use some help from there. It seems like this has been a pretty rough chart. Everything in the apparel sector has really had some challenges from the tariff news that we've seen here. A lot of the tariffs affect the places that make the apparel, so it's a difficult situation. It's a difficult environment, and we can see indeed right here was our tariff news shock event here. We established a kind of a high point there at our lighter green line near 59. We did not test it again during our most recent decline here. That was where we had about 60 was our low point here. 59 to 60 then stands out as a potential supportive zone. Sometimes it's not just one clearly defined line. Sometimes it's a general area that you'd be looking for maybe price to rebound. In this case, these things are not completely cut and dry. If you're looking for price to stop on a dime where you think it should, you're probably going to be disappointed very often. So when we also look here, falling wedge type shape between our two blue lines converging toward each other, that's where we bottomed out then. That gives us our new channel to consider. Just like our last chart, you can draw going along these low points here, duplicate it, put it where the high point was previously. Looks like that's about where we are today. So that area here, near about 69 or so, could be important to watch going forward here. But, you know, we're off significantly from those highs that we saw. We're down from the opening. Not the most encouraging setup here, but we still have earnings on the horizon here, which could change things significantly. Here we have our moving averages fairly close together, 65 to 66.50 or so, as well as 66, our green line that represents this old high point here. So we broke out above there. Now we'll see if that area becomes support. Once again, same concept I was discussing earlier here. If we were to move a little higher, 70, a high point right here, our red line, that's our relative highs. That would be the point the bulls would want to clear. RSI, longer term downtrend has been broken, so some improvement there. We are above the 50 midline. We're making new relative highs. So by that measure, that's a better sign as well. But RSI often really starts to drop off. Momentum starts to calm down the closer we get to earnings here. So that could be perhaps a little bit misleading given that we have this event risk situation coming up. Now, when we look at volume profile, we can see our point of control, our thick red line there comes in near 62.29. So that's the heavy trading area that could be supportive here. We also have another fairly large node in a narrow range right about here near 65. That lines up with our yellow 21-day EMA as well. So that would be perhaps another point traders may be looking out for to the downside. Most of the volume all the way up here, though, we can see that was around 71 or so to 75. That's where a lot of the heavy activity was, so that could be a notable upside boundary as well.
All right, Nike has an interesting setup coming in. You know, you can see how low it fell on the tariff news. You can see there in April, those bottoms on the chart there. Has really recovered, though, the last 6 months, you know, up 7.5%. But as we look year to date, that drag really did pull them. They're down almost 11%. But we did just get Lulu's earnings, and they are seeing a really nice uptick here. They're up more than 10% so far this morning, up about 10.5%. Also in the midst of their own sort of turnaround plan and reformulating their process. So another interesting setup there. But Rick, thank you for breaking down some of our big earnings reports that we have coming out next week. That's Rick Ducat, our lead market technician here on Schwab Network. Coming up next, we are going to spotlight Serve Robotics and take a look at how they've been growing its sidewalk fleet of delivery robots into the largest in the United States. That's next.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network. Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Welcome back to Trading 360. I'm Marley Caden, live in our Chicago headquarters. It's time to spotlight Serve Robotics. Joining us now is Ali Kashani, the CEO and co-founder of Serve Robotics. Ali, thank you for being with us, and I see behind you that you brought a friend with you today for the interview. Last we spoke, you had talked about some milestones that were important for the company. One of them was the deployment of 2,000 autonomous delivery robots by the end of the year. I hear you have some good news that you may want to share with our viewers.
Absolutely. I'm pretty excited to say today we launched our 2,000th robots, which is a huge milestone for us. We started the year with only 100 robots, so we have 20x our fleet size. We brought them to 5-6 new cities. As of yesterday, actually, we went to Alexandria, Virginia, so it's been a really exciting few weeks for us.
And Ali, what does this milestone say about where the future of autonomous delivery is heading?
Look, I think we're going to have 1 million of these robots in a few years. This is just the way delivery is going to be done. If you look at how much it costs, if you look at the way we do delivery today, it's just not very efficient. And I think bringing some level of automation to it is going to be really critical for us to be able to scale this service and this offering.
And we're talking about scaling. When we've talked in the past, you say that these sidewalk robots are the leading proven use case for robotics today. And obviously, this robotics conversation is much larger than just delivery robots. What makes this category that's scaling so rapidly while others, like humanoids, are still largely experimental? What's driving the move in this market?
Look, I think it's always better to focus on a specific application that has really large scale so that you can make a robot specifically for that application. There's a reason why, wheels were invented when they were. We've been using moving platforms like that for so long versus the human form factor is still new in terms of, creating machines that can conform with that and do that effectively. I think they're going to be here in maybe 10 years, in more broad applications, but usually with every market, with every technological advancement, it starts with, specific machines designed for specific applications that do that really, really well before you bring it into more kind of generalized use cases, which is what humanoids do. So they're all very exciting, but I think it always has to start with the more niche applications, which is what we are providing.
And Surf operates in these dense urban environments, big cities. LA, I see them around Chicago, Dallas, Miami, Atlanta. You mentioned Alexandria, the DC area. These are big, complex environments, not a training ground in the suburbs. What's the biggest technical problem that you face? Because I'm looking to see that you have a 99.8% delivery reliability. What hurdles have you had to cross to get that number so high?
I mean, if you think about it, before the sidewalk robots came, you had robots in your home doing vacuuming or in the warehouse floors. Those are much more simplified environments compared to a sidewalk. So the problem we had to solve was how to take that technology and bring it out into the unknown of the real world, where anything you can imagine is going to happen. We've interacted with ghosts on the sidewalk. We have seen everything you can imagine that happens in cities. So making a technology that's reliable day in and day out, that a robot can leave our warehouse in the morning, do work all day long, and then come home by itself. That was the problem we had to solve, and as you said, 99.8% kind of indicates where we are in terms of maturity. It's really working, which is why we are scaling it.
And with your scale and maturity, in just a year, you've gone from one metro area to 6 major U.S. markets. What allowed you to scale that quickly while still hitting those 2025 goals?
Look, it was very ambitious, but we had spent years basically preparing the technology for this moment. And we thought we were ready, and now we've proven that we were. We've been able to go to new markets like Chicago, and within weeks, reaching our SLAs for mature market basically, which means again 99.8% reliability, 18 minutes or so per delivery from pickup to drop off, that sort of thing. So it was a lot of technology that goes into this, from development of the AI to the hardware. We actually launched a new generation hardware at the beginning of the year. We called it Gen 3, which was a third of the cost of our last robot, but more capable in every way, from the battery life to the 5 times the compute to better sensors. All of that was designed over the last couple of years for this moment, and I think it lived up to the expectations.
And you've got some big name partners. You've got Uber Eats, you've got DoorDash, 2 of the biggest players in delivery out there. How central are these partnerships to your expansion strategy?
Look, it's really important to be able to go to a new city and immediately have hundreds, if not thousands of merchants turned on and actively using the robots, because look, at the end of the day, this is a fixed asset, and what you need to make the economics work is utilization of the asset. So if you were to go, signing one restaurant at a time, door by door, it's going to take months, if not years, versus with the help of the folks like Uber and DoorDash, we can do that almost overnight. And this makes it so much easier to launch robots. You asked me earlier why these robots now. Part of it is these platforms exist. They have built the application and the demand, the customers, the merchants, they're all there. Now they're all demanding a better solution, and we are helping provide that.
And you're seeing deliveries up more than 40% quarter over quarter since 2022. I see here in some of the notes that you sent over that you think the robots will become ubiquitous over the next 5 years. So paint a picture for me. What does urban delivery look like in 2030?
Look, I think if you go to LA, to many neighborhoods we've been for so long, or Miami, or Dallas, Chicago, they are normal now. Like, people walk around. One of the things that surprised me often is when people walk around and don't even look anymore. It's like a mailbox. Imagine when mailboxes were first introduced, it was probably very novel, and you leave your belongings in there and no one's going to take it. Now nobody looks at a mailbox. I feel like our robots are eventually going to be so normal that just like a mailbox, you don't even pay attention to them anymore. And that's already happening happening in some markets. Look, I think delivery is always going to be multimodal. You're going to have cars, you're going to have robots, maybe someday humanoids of different form factors, but ultimately you're going to need some level of automation introduced into last mile so that you remove cars off the street that are doing it today. As we like to say, why move 2-ton burritos in 2-ton cars? It's inefficient, it's expensive, it also is a safety risk to everybody on the sidewalk. So that, to me, is the only way this future is going to look like.
And Ollie, I don't want to end this interview ignoring the star of the show who's behind you that you brought with you. I can see that it says Montel is on delivery. Does each of the robots have its own name, or do they all operate under similar names depending on their purpose?
Oh, every robot has a name. We actually get suggestions from the community, and we usually try to honor it if we can. So robots have individual names. People call them by their names. It's actually really cute.
Well, Ollie, we appreciate you being with us today to talk about these important milestones that you're meeting. And I also want to thank Montel for joining us today, the Serve Robotics delivery bot behind you. That's Ollie Kashani, CEO and co-founder of Serve Robotics. Coming up next, we have the Disruptors. We'll be taking a look at Coinbase ahead of a reported prediction market launch. That's next.
To the markets in the Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com
and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Hey Bob. Hey Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable. Wait, I had a stroke? Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. It makes a huge difference when you have someone that actually cares.
Welcome back to Trading 360. I'm Marley Caden here in our Chicago headquarters. Let's head out to the New York Stock Exchange for a check on the markets. Welcome in Nicole Petalides, host of Opening Bell and the Watch List. Good morning to you, Nicole. I would ask what's caught your eye so far, but I caught in the commercial break that you may have gone to meet Montel, our Serve Robotics interview that we just finished.
I was about to tell you that was a great interview, Marley. Great job. And I made a new friend, Montella. I mean, it's behind me where you can see that it does that last mile of your delivery, right? It's the largest U.S. sidewalk delivery fleet. So really interesting, and really, I guess that's how it's going to be in the future, right? More of the Jetsons coming to us. In the meantime, you know, I'm seeing stocks really losing ground now, right? We started off with some up arrows. It looked like maybe we're going to have another record-setting day of the Dow. was higher in particular, but now we're really seeing weight on utilities and real estate and consumer discretionary, a lot of down arrows here. And when you look at the heat map, all Mag 7 or lower. This after we closed with records yesterday for the Dow, the S&P, and also we did see that the Russell had a record close, not the NASDAQ. I also was looking at the sectors, and it was really interesting. I was looking at the carrier, regional banks, XLF for financials, jets, right? When we look at those airlines, XLI, industrial. I was just going through sector by sector, and I'm seeing 52-week highs on all of those. You also have the equal weight S&P 500, which has been hitting record highs. But right now, it's definitely a risk-off environment, and some of the big laggards. I mean, we've talked about what's been going on. For example, Broadcom sold off, and Oracle's down over 30% in a few months. It's down 10% this week. Caterpillar, NVIDIA, Amazon, IBM are the big laggards. Tesla has some weaker sales. Lulu, which we're going to talk about in a moment, the outlook there is a little iffy in certain ways, but the big picture, I guess we're wrapping up the week here now, really selling off in the VIX, jumping out of 1759, and the 10-year bond at 419, it went up to 421. I think that's notable too.
Yeah, Kevin Green warned us that we might see an uptick in the VIX. We certainly are seeing it today after hitting a 14 handle yesterday. But let's talk about Lulu. You just mentioned them. Lululemon had their earnings come out. They are trading up more than 11% higher. Can you walk us through some of the highlights and also some of the guidance that you mentioned?
Yeah, I feel like there's good news and sort of less good news for Lululemon. I mean, the good news here is that they raised their forecast, they boosted the buyback by $1 billion, they upped the forecast for earnings per share and revenue where the midpoints are higher. I'm paraphrasing pretty much, but that's the big picture. I mean, the other thing is that there are some concerns going forward. I know we have an up arrow here today, and I love seeing an 11% gain for the same, but I mean, don't leave out that it's down 50%, right, in 1 year. Bank of America's concerned maybe about some tariff pressures, margin pressures, and also you have a changing of the guard there. Chip Wilson, who's the founder of this company, also a shareholder, they're having the CEO succession plan now. Calvin McDonald's going to be out. He's leaving on the 31st of January. And also you have Chip Wilson a little disappointed in the board that they didn't really have an efficient set up for who's going to be the successor in the lead role. So now they've looked to an outside company to try and fill this role. And Chip Wilson wanted some of the more independent directors who have really a lot of experience that they should lead the CEO search, and really someone who provides new skills and can build shareholder value. And Bank of America said whoever comes in, the turnaround's going to take a little time. So I do like that we're seeing some good numbers. You had a beat and a raise, but the longer term plan will really, a lot of it will depend on who fills that CEO role, and that has to be seen. In the meantime, Lulu is not a great stock, as you know. It went down as low as 159. Right now it's at 207. I'm seeing targets of 210, 190, 170, and as you know, 220, some of which are lower than where we are. 220 is higher. Bank of America has a neutral in 220. Marley?
Yeah, Nicole, thank you for breaking that down for us again. That CEO highlight and call out there, very important, who will be leading this company at what arguably is a very pivotal time for them, but shares up close to 11% this morning. Thanks to Nicole Penalese for breaking that down for us. And now it's time for the disruptors. George Tillis, our senior markets correspondent, is here with today's company. We're talking about Coinbase. Bloomberg is reporting the company is launching a prediction market and to tokenize equities on December 17th, so coming up here very shortly. George, what do we make of all of this?
Well, I think this is sort of a natural play for Coinbase and a lot of these exchange-based brokers. We know that the prediction markets have really taken off. They've actually cut into the market share of traditional gaming and gambling outfits. That includes companies like MGM Bets, even the DraftKings. But nonetheless, this is a market that is expanding. So Coinbase is naturally moving into this, or is expected to move in this. They're going to be showcasing, as you mentioned, on the 17th, some sort of product to talk about their app ecosystem, which includes, of course, their technologies associated with crypto trading, collateralized lending, but also off-exchange investing in cold storage. The company itself has been growing quite profitably, I suggest, compared to the last 5 years. Net income margins are over 40%, and gross margins over 80%, because it's really a technology firm. But nonetheless, the stock itself is trading to the downside today alongside if you look at the crypto markets, Coinbase is down significantly since July by about 40%. So it is following suit with the rest of the crypto space, using Bitcoin as a proxy as the dominant coin in that regard. But if you consider what they're going to be doing, it's going to be expensive, and that may be why we're starting to see a little bit of a drift to the downside. It could be also market momentum, which is fading, considering the market is also down today. And Barclays, I think, also suggests that this may be a little bit more expensive. And what they're doing here is reducing their price target. They actually have underweight rating or equal rating on the stock, forgive me, which is basically a whole rating. But they reduced their price target to 291 from 357. And the reason being, again, is a weakness in the crypto ecosystem, as well as the fact that expanding into the prediction markets in-house, not using partnerships, is what they intend to do, is going to be expensive.
Yeah, and it's really interesting, too, to look at sort of the analysts. Not a lot of commentary yet on this news because it's very new, but the average price target for Coinbase is $379.50, right now trading at $263.92. But we are seeing some of these price target revisions to the downside here with Coinbase, especially how under pressure we've seen Bitcoin and how closely they're tied. And as you mentioned, this news not moving the needle for them today. They're down almost 2%. So with that setup, and they've been pretty beat down the last month, down 13% alongside Bitcoin. How would you structure an example trade here, George?
Yeah, if you look at, the price chart, it did hit some lows corresponding in November that also go back to May and June of the year as well. These are roughly areas around $237. So the challenge right now for Coinbase is, from a price action standpoint, is it's still trading below the 200-day moving average. So that's going to be a barrier. So the stock itself may retrace back to those support areas. But at the same time, the news and their showcase coming up might actually be really good, so the stock could breach above that. So I'm going to play this in a bullish condition with the potential or qualifier that the stock may pull back to that 237 area. So I'm going to go out to July and sell a put spread. I'm going to sell the 240 put and then buy the 230 put below that. Now, altogether, this will earn you about $2.50 a share or $250 a contract. So again, looking at the strike price that's selected at 240, it's about $25 lower than the current price, approximately speaking. The delta on that 240 put that we're selling is 25. So it implies a 75% probability of profits by expiration. But your break even, ironically, is right around that support area that I mentioned at 137.50. And then just in case it just gaps lower and continues, you got to consider the risk, which is 750. And that only manifests if the stock hits 230 or lower by expiration in 35 days.
George, we appreciate you being with us to talk about Coinbase today. Again, shares down about 1.5% right now at 265.07. That's your Tillis. Thanks again. Coming up, we've got our 360 round. We're going to bring in our panel to break down Broadcom's earnings, which were boosted by AI chip sales, but shares are under pressure. And in reaction, we'll break down the numbers next on Trading 360.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren, planning for their college educations. Someday it'll be their turn.
This is Fast Market, built for traders who want more than just headlines.
We walk you through trade ideas with structure, risk management, and a focus on execution.
From options to earnings to volatility plays, we bring decades of trading experience to every segment.
With real-time insight across products and sectors, we deliver what active traders need to stay ahead. Fast Market weekdays at noon Eastern, live on Schwab Network at schwabnetwork.com.
Welcome back to Trading 360. I'm Marley Caden. It's time now for our 360 round. For that, let's bring in our panel to discuss Broadcom. Joining us now, Kim Forrest, founder and chief investment officer at Boca Capital Partners, and William Kerwin, equity analyst at Morningstar. Kim, we'll start with you. I'd love to get your thoughts just on the report that we got yesterday and also the response that we're seeing since getting those numbers.
Right. Well, initially it looked like, things were bon marché. Everything was great. They surpassed numbers. Demand looked good. It's all good, right? And then, the earnings call. And I guess there was a little chill there. There was some product that hadn't shipped. The backlog was larger than people had anticipated. And there was some qualification around some items. Most margin is one area that, the current chips would have a slight 100 basis point decline in the next quarter. Didn't sound terrible. But what I think is happening here is the whole, if you didn't exceed greatly, then you didn't really, satisfy the investing public in AI. Because we think it's big.
And we've seen that too. William, what's your thought there? Is this just another case in this earnings season where we've seen if it wasn't the best report of all time, it just simply wasn't enough?
We really liked the results, and we were frankly a little bit surprised about the reaction after market last night and today. And really what we see is that AI demand is accelerating. It's already at an extremely high growth rate. Broadcom expects that to accelerate next year, potentially double again the year after that. And they have this multiplicative benefit here where their existing customers, like Google with its TPU chip that it co-designed with Broadcom, is seeing immense demand. And we have these new customers like Anthropic layering in next year. So we saw everything extremely positively. We're bullish on the name. We raised our forecast. We raised our valuation up to $480 a share. And we think this sell-off is missing the forest for the trees with this larger positive AI picture, and it's an attractive entry point today.
So Kim, you both agree that this sell-off from both of your perspectives is unjustified here. So what is driving this market overreaction? What was the primary driver to move us down so significantly?
Well, I think people are very, very fearful that the current scenario, which is large language models, are the AI delivery unit, and that we need tons and tons of data centers and thus tons and tons of chips in perpetuity to support them. You probably don't know this, but just like 2 minutes ago, something went across the wire that Oracle is delaying a data center from 2027 to 2028 at the request of OpenAI. So I think this is everyone's fear, is that the rollout isn't going to happen in the next 15 minutes, that demand isn't going to grow to the sky, and that a lot of these names are already what some would consider overvalued. Now, I'm a longer term bull, but I also doubt that today's AI is the thing that's going to win. We'll put it that way. And that data centers will cover the earth.
And Kim, you bring up a really important point, and one that we've talked about in the past as well, that everyone has this expectation that the AI revolution is going to move at the speed of light, and they want everything to happen now, and they want to see profitability and growth now, and it's just simply not possible. So William, coming over to you, seeing Hock Tan not give AI revenue guidance here, in your opinion, how significant was that? Was that the right thing to do here, to say, I simply just don't have enough information to do it, knowing fully well that we could get a reaction like this?
Well, we also focus on the long term, like Kim, and really, I think Hock Tan, even if he's not giving explicit guidance for the full year, he's laying the trail of breadcrumbs for us to understand what's going to go on. They talked about one $10 billion purchase order from Anthropic for the second half of the year. Now they announced a new $11 billion purchase order on top of that last night. They onboarded a new customer where they expect $1 billion purchase order this year. So really, we're expecting this surge in second half growth. We think that there's enough there even outside of explicit guidance to call that out. And I would just comment on the OpenAI Oracle data center delay. This was not a surprise to us. Broadcom announced this 10 gigawatt deal with OpenAI for capacity over a 3-year period. We really don't think that that's possible to build out in such a short-term fashion. We think about supply constraints, we think about power constraints in building out these data centers, but we see it as a signal of intent that this capacity will get built out, even if it's not in the next 3 years. As Kim was saying, over the longer term, we see this as very constructive.
Well, I appreciate you both being with us to walk through Broadcom's earnings, and also for breaking some news with us today. Oracle delaying several data centers for OpenAI now to 2028 from 2027, a very important point there. Thanks to Kim Forrest, founder, chief investment officer at Boca Capital Partners, and William Kerwin, the equity analyst.
Well, this kind of I didn't expect this kind of pullback today. I expected one, but not this bad. So I'm trying to figure out how I'm going to make up my money back. Looks like one of them end of the day things. I sold my contracts. I had to. So I was like, YouTube, as I left, I had to hurry up and leave. And I'm going to show you what I did. I put two of my favorite pair of shoes on. I have the Brooks Glycerin right here, and then the Max Brooks 2 right here. And I didn't realize I had the wrong shoes on, or a mismatched pair, until I got to the job site. Everybody sat there and laughed at me. Woo! So,
Smart insights, actionable.
I think I'm just going to go over my watch list here. Start with volume high. Let's see if I can find anything. Oracle looks like it. I'm going to call him right now. Wonder why they dropped the bucket on us. Because of his rhetoric. We got an inside, we got a hammer, and we got a green candle here on the 30-minute on /ES. And we got one on the hour. I think this is the hour. Tweezer bottom on the hour. Tweezer bottom on the 30-minute with a hammer. And we broke the 63 on the SPY. in 6860s. We broke the 63. And we broke the 63 on the /ES. We've got 2 or 3 resistance levels to break. Randy, 6860s, 31,000 contracts. We got a cup and handle, or at least a cup. $3. I'm gonna go put my soup on. We're at 350. Damn. Got a hold here, I get out. We're at the 9.
The outlier at this point in terms of how much debt that it's accrued on its book, or at least percentages. So I don't think that that's necessarily a fair comparison with Broadcom, but I do think, though, that once you kind of paint that broad stroke across the entire space, it's one of those, as you said, you sell first and ask questions later. I think that's what we're seeing today.
And yeah, I just want to stay with this, especially the Oracle piece, because now you have shares of Oracle extending yesterday's slide. Now today down another 5% today, and they've managed to kind of stem some of the losses by the end of yesterday's closing. But today, now they're moving the completion of the data centers for OpenAI to 2028. So it looks like investors do not like this timeline, and the patience is wearing thin. Kevin, I want to get your take on that.
Well, Oracle pushing back these timelines to 2028. Here's the positive thing if you're trading Oracle. If you're dialed in on Oracle and really paying attention, when they came out with their original timelines, they didn't seem realistic. And a lot of people that were dialed in on Oracle said they can't make those dates. They're going to have to push them out. So all Oracle's really doing here is putting the dates where they probably should have been in the first place. Now, market doesn't like that. They don't like surprises and they don't like uncertainty, but these dates out to 2028, where delivering some of these data centers isn't really a surprise to people watching this entire sector. That said, it's not good news, right? They didn't surprise us on the positive side. They basically put it wherever a lot of people thought it would be in terms of delivery. So yeah, 2028, I think you should get used to things like this. These data centers, getting the power, getting everything they need, I don't think this is going to be a fast build for any of these. So this headline that you're seeing from Oracle today, I think you should get ready for more of that, Diane.
Okay, that's a good point. And then, you hear that these things do take time, and it's starting to seem like that is the case. Joe, I'm curious if you have
6826 is my support. If I don't hold that, I'm out.
And you tell me, is that there's a better place to park money for the next couple of years?
I got the 6860s at $3. They keep going back and forth here from 3 to 360, 350, 370. Now we're back to 320. Kind of slow. But if I don't hold this trend line, I'm going to stop right out, get it right out. That's guarantee. Because I got hurt in my first trade. That's 4 red trades this week, which is way above average. Monday had 3. Today I had 1. I had a good week still, but I was down pretty big on Monday, but I made it back at the end of the day. And it could be one of them kind of days. Boom. And somebody pushed the boat. Just don't tip it over. We're at 380 right now. 370, 380. So I'm up 240. 390. I'm a quarter of my way back. A little over a quarter. 3/8. Quarter. I'm going to put my soup. 390. There's 4. If he had 68.55. It's taking baby steps. There's 3 of them right there and then 3 more right there. Actually 4. Let's get to, it'd be nice to see $6. $4.60. $4.70. I have a feeling I'm pushing my luck right here.
Talk about your take on Amazon. When I was going through the Mag 7 today, I was like, okay, let me make a list and see who. I already knew who was at the top of the leaderboard, but I thought Tesla was still at the bottom. It's not. It is Amazon. Joe, I'll start with you. Your take on Amazon before we get to the example trades.
So what did we talk about in the last segment that was important? Free cash flow, right, versus debt. And so what is Amazon? What are the expectations from JP Morgan for Amazon for 2026? It's free cash flow more than double to $59 billion next year. From the 2025 estimates of around $24 billion. And so they're expecting that from a margin expansion, specifically in the retail business. They've done a good job in terms of the advertising. But, so here's the thing, and this is where the debate comes. And not only is it a bull-to-bear debate with Kevin and I, but it's almost a bull-to-bear debate in my own mind to a certain extent, because fundamentally, I think the company could be positioned for a nice year in 2026. Technically, I think the setup right now is it's one of those almost like an inflection points, right? Because the shares are sitting basically right at that confluence of the 50 and the 100-day moving average. It's right around $227. You could see a couple things. You could see a retest of that 200-day moving average. That could be in play around that $215 level. Specifically, some of the oscillators that I look at, whether it's an RSI or a MACD, they're rolling over, and you're just seeing continued kind of downward sentiment on the charts. And with the stock only up 3.3%, as you were talking about, kind of the least is done the worst of all of the Mag 7s this year. I just don't know what that catalyst will be to push those shares up towards the end of the year. So that's kind of the way I'm looking at it. When I have a debate and I'm saying, okay, fundamentally versus technically. Fundamentally, I look at it and say, yes, I think this company probably has value that it can unlock. I think JP Morgan talked about the free cash flow. Technically, is it the right time? And as of right now, the way that I'm looking at the charts, I think that it's probably a better setup for a bit of a bearish trade than a bullish trade.
Okay, Kevin, your take on Amazon.
I look at this company and I think to myself, what are the key parts of the U.S. economy? What are the hottest parts of the U.S. economy? Is it cloud? Yes. AWS, largest cloud provider. Is it digital advertising with streaming? Yes. Amazon Prime, massive digital advertising, and coming soon, more sports, right, is coming to Amazon Prime. How about e-commerce? Well, how about this? They are not only, they can deliver you can now buy online used cars and fresh produce, which tells me, you know what you can buy online, Diane? Everything. Everything you can buy online. And by the way, coming to a balance sheet near you very soon, data centers. The next thing they're getting involved in. So this company, which is for the year to date of 2.3%, they are involved in every most important part of the current U.S. economy. And so it's just very difficult for me to watch a dip like we've seen and not try to be involved in it. It's just, they have, now the risk, sure. The market doesn't like when they spend CapEx. It never has. In the history of trading Amazon, they don't like when they up their CapEx spend, so they've got to be very responsible there. But once they slow that down and let the earnings come in, that's usually when the stock recovers. Just kind of waiting for that to happen, Diane.
They sell, I'm pretty sure I've seen that they sell little houses on there as well. All right, let's get into the example trades. Joe, why don't we, go ahead. Sorry, Kevin, your thought?
No, I was just saying, they literally sell everything online now.
It's true, it's true. All right, let's get into example trades. Joe, let's start out with yours.
And I think Kevin makes a fair point. So what you'll see on my trade is it's not necessarily a long-term bearish play. If anything, it's a short
back to the 63
calendar, selling the December 2025 26th day expiration, and then buying the January 16th 2026 expiration at the 215 strike. I think when I priced it up it was around 210. It's probably around 220 right now. It's probably expanded in value. But what it's looking for is it's looking for kind of a move back down towards that 200-day moving average. And it's really based upon the technicals. Like I said, I think fundamentally the company's probably set up for a good 2026. I would agree with Kevin, and I would agree with the JP Morgan analyst on that. But I think if I'm looking for a near-term trade, I'm looking for kind of a pullback. And look, as you can see today, Amazon cannot escape the AI trade. So if the AI trade is pulling back, which it is today, Amazon's going to be susceptible to that. So I'll pull back down to around 215. It's not a big move. It's about a $10 move on a $227 stock. It doesn't take much to get down there, and you don't need it to get all the way down to 215. And what I like about it is, as it's making its way down there, you can start rolling some of those front month options until you get down to that expiration in January 16th. And then you can make a decision whether you want to turn it into a spread.
Make a decision.
I love the calendars because they give you a lot of optionality, no pun intended.
There you go. Kevin, your take on this before we get to your example trade.
Well, Joe Mazzola knows that I do love my put calendars. If you are modestly or significantly bearish in a name and want directional as well as implied volatility coverage like long Vega, the put calendar is the way to do that. And the risk on a put calendar is the debit paid. That's it. And this put calendar will give you the ability to extend duration and chip away at that net debit. And so you've got a delta component, you've got a Vega component, both that would work if you get a downward move, which Joe Mazzola's right. It doesn't matter how good your company is. A global sell-off will affect a name like Amazon. So if this is a global sell-off, Amazon will follow the market. And this is a dual threat way to play the downside at Amazon, Diane.
And Kevin, I have a feeling based on how you spoke earlier that you're taking obviously a different approach. So what's your example trade?
So when I want the ultimate amount of exposure in terms of a paper money trade, and I want a delta, right? I look at the call diagonal. That's my go-to bullish play in a name. Doesn't mean it fits every situation, but if I want to just buy the dip without buying stock, a call diagonal is the way to do it. Same family as Joe Mazzola's trade. It's in the calendar spread family, but it embeds that call vertical in there that gives you a little more teeth directionally. In this case, I went out to the January 2nd and bought the $225 call basically at or a little bit in the money, and then sold next week's January 19th $235 call. I put that in for about $6.30, trading closer to $6 now. So it's trading a little lower as the market has sold off, Diane. But this is a call vertical that gives you about 35, almost 36 long deltas. And this is a way to, again, it's a 2-week spread, so you will get a chance to extend duration on this trade, but it's a way to get to simulate a covered call without buying the stock, and you do it for a fraction of the price. And
Boeing bounced back up.
Okay, Joe, your thought on this real quick.
Yeah, I think he did a nice job summarizing the setup and kind of the risk involved, because basically, yeah, you are simulating what would basically be a covered call without having to own the shares of the stock. So a much cheaper way to do it from a debit perspective, and in terms of how much capital is required. It's a slightly bullish play, and if Kevin gets that move within a couple weeks, it'll work out well.
All right, thanks, guys. That's a choose your own adventure bull versus bear take on Amazon today. Coming up, we got cash tags. The team from Lightfolio will be along with new sentiment data on another member of the Mag 7. That's Meta. But this is really about the consumer here. Keep it right here on Schwab Network. Fast Market will be back after this break.
Hi, I'm Alex.
I'm Jean.
And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Sam Vardis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more.
Technical analysis.
You can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
Welcome back to Fast Market here on the Schwab Network. I'm Diane King Hall alongside Kevin Haynes over at the SIBO. Time now for our cash tag segment. For that, we want to bring in our next guest, and that is Landon Swan, co-founder of Lightfolio, taking a look at Meta today in the context of consumer trends. And before we get into your data on Meta today, Landon, I was glad to see that it was going to be you, because I have to eat crow on Lululemon today. You were right. I didn't see that move coming. I mean, it is off the mat big time today, even in the context of a weak market. Kevin knows I told him earlier I was going to own up to it. All right, so let's get into it with Meta today. What's the broad strokes take from your data?
Hey, first, on Lulu, you weren't really bearish. You just said that a lot of people were buying, Viore and Aloe Yoga, but I got to tell you, credit to Kevin, that trade was unbelievable. Kevin, I don't think you could have picked better strikes. So well done on that. That was an awesome trade. So we're a good team. Let's keep it up. Shifting over to Meta. This is they're the leader of social media. And when you look at how well they've performed, their ads were up 26% year over year. They're really getting into AI spending, which is pressuring margins. Some people don't like that. Some investors think they're spending too much, but I'm going to make the other case. I think that they got to spend more. And I'll lay out that case here today.
They spend a lot.
And one of the things that they're doing is they're focusing on increasing the dollars per user as opposed to increasing the number of users, which, you know, we should all be so lucky to have half the world as users. So I think that's a reasonable shift for them. I mean, once you get to 3.5 billion daily active users, I think you need to start monetizing them more rather than trying to get to 4 billion, right? And they're Xing the metaverse thing. So, which is great. I think investors want to hear that. But on the AI front, I think that is really going to be their feather in their cap in a couple of years, because right now, there's a shift going on, and right now, or at least say a year ago, everything when it came to new product discovery was done through social search, right? It's social media, people talking about influencers or just friends posting things that they've got or found. And that's the way that most new products have been discovered. Now we're starting to see a big shift to go to AI, where maybe you're interested in a certain category and you hop on GPT or something like that, and you want to know, you know, what should I be buying? What products do I not know about? Or what's the best this type of product? What's the best that type of product? And you can see the growth here across the sector. Yes, Facebook is down significantly. Instagram is up a decent bit. I say significantly compared to the rest. But you'll notice the top one there, GPT, is off the charts. It's doubled over the last year. And actually, when we measure the influence, the traffic coming from AI on Black Friday, it was about 7x year over year. So GPT and all the others are really pushing people into their purchasing decisions. In fact, about 1 in 5 purchase decisions around Black Friday, Cyber Monday were made using AI. So starting to get really big traction there, and I think that's only going to increase. And so as we move towards this new world where instead of social interactions, or less so anyway, people are looking at AI and asking it for recommendations, Meta has to have that strong AI platform, and they're building it. They're doing a great job. And what's interesting about AI, a lot of people forget about this, is the entire value of AI is driven by the data, the source data, how it's trained, the training data. And you couldn't ask for better training data than all of Facebook and all of Instagram combined.
Oh, yeah?
People clicking on, when they watch this, what do they do next? Which people do they follow? Are they likely to follow that person? What do they do when they see this ad? That is an unbelievable gold mine of data to power and train an AI on. And so I love the fact that
CGC new high.
I think that's going to be
that's pot stock.
That makes them the winner over the next few years.
One of my top 4.
So, you know, hats off to them. I think they're going to do really well. They're doing pretty well so far, but they're positioning themselves for this shift that otherwise could really hurt them. If new retail purchase decisions shifted from social data, social search over to AI, and they weren't a part of it, they would really be left out, because ads are basically how they make all of their money. So their ad spending is up, or their ad revenue is up, but it would go down if they weren't as part of this AI movement. So I love where they're positioned, and the stock is, you know, it's kind of in the middle of their 52-week range right now. So overall, I think this is, you know, it's a pretty good position to get into Meta moving forward. But I really
SPX is above the 21.
How they're positioning themselves with AI.
Landon, Facebook shopping, Instagram shopping live rent-free in my head, because they can pinpoint what you're looking at and what you're looking for and fire shopping ideas at you. My children tease me because I shop via Instagram, and they want me to stop, but they like the little gifts I buy, but they want me to stop shopping. But AI is so tuned in to what you're interested in, Landon, and this is the future. You're looking at more and more, and your data shows it, how the traffic is just moving to e-commerce more and more. And I don't think there's there's always going to be some form of brick and mortar, right? But the trend going towards e-commerce, I don't know how you stop that, Landon. I don't know how it just doesn't keep getting better. And the Amazons, the Meta, Instagram, the Walmarts, another stock we're going to talk about today, even probably Target. You've got some other names up here. They're all going to benefit from this. This is where the trend is going. Am I wrong there?
No, you're right. I mean, it's just easier, right? I mean, it's just easier. Just discovery, physical discovery. Well, it definitely will always have a place, right? But I mean, that's how Five Below makes their money. That's how Costco makes their money. That's how pretty much every store in a mall makes their money. But it's just even easier if you want something fairly specific, even if you don't know exactly what you want, but you need some running shoes. You know, getting it online is much easier than it used to be. You used to go to Foot Locker, try on a few, talk to the guy, see what people think. Now, you know, you can just get on either social media or even better, like I said, get on AI and ask it, and you're going to get some recommendations. You can order it, boom, it's at your house the next day. So yeah, it's unbelievable. But you know, I do want to talk about this chart because
back to 360.
going into this quarter, I think a lot of people
We're
had
double
eyes
topping
on Black Friday, holiday shopping, and just overall what's.
So I didn't sell it, and I watched it hit like 210, and I'm going, not again. So I'm up 180. Does it have the courage to break the double top? I don't know. The value of it's dropped. Big time. So it's not holding its value.
Everybody, that's good for Meta, of course. And then going back to Meta, looking at their longer term, you know, if you look at where they're at now, yeah, about half the world daily active users, which is incredible. But they're positioning themselves. Think about where they're at now. They have 100%, pretty much 100% revenue comes from ads, and it's all like creator-led content that's pushing things. They don't have any native checkout. It's all like product tags and creator links and DMs and affiliate links and things like that. They have a lot of opportunity to get into the checkout part of things and really take advantage of some of these. They can get into the market, actually selling items if they wanted to. But again, going back to the AI angle, my goodness, having 3.5 billion people on a daily basis do things on your network, and you're logging all of it, you're figuring it out, you're tracking it, you're feeding that into an AI as a search, as a recommendation engine. This thing is going to know you better than yourself. It's going to have fantastic recommendations coming up for you over the next few years, and I think they're going to make a lot of money. And so everything that they're pouring into AI, I think, is going to pay off big time for investors. So anytime I hear an investor in Meta talk about they're spending too much, it's hurting margins, I strongly disagree with that. I think they've got to continue to invest more. They're positioned to be the #1 beneficiary of AI because of, again, that training data that they have. So I love where they're at, and I love the decisions they're making.
Landon, it's almost too easy now, I would say, to buy things on these platforms. If you had to finish this on a fine point, what would that be regarding Meta? Because I hear what you're saying, and I've seen some analysts who seem to agree with that viewpoint, but it's not where it was within the Mag 7 this year, and there's been a little bit of skepticism around it. What's the fine point that you want to finish this on?
I think the skepticism comes from what investors would consider overspending on AI, and I say, great, keep spending more. So any kind of sales, any kind of selling on the stock that comes from that concern, margins are down.
Tilray, boom.
Like, go ahead and sell more. I'll buy
Double
more
top.
at a cheaper price. So I think that you average in long term on this one, and you're going to be fine on Meta stock because they're making the right moves, and they have so much more that they can do. Again, it's not acquiring new customers, that's not our new users, that's not the big goal right now. It's monetizing those, and they are so well set up, and their strategy is perfect for taking advantage of that and monetizing people to the max.
All right, thank you, Landon. That is Landon Swan, co-founder of Likefolio. Have a great weekend, Landon. We appreciate the latest data. Let's get Joe back in here for the trading perspective on all things Meta. We'll call it a status update. All right, Joe, take it away with your example trade.
I mean, look, Landon's absolutely right. In terms of data gathering, I don't know of a company that does it better than I mean, think about 3.5 billion data points on a daily basis that they can farm. It's a tremendous advantage that they have. And I think the pivot that they made last week to kind of pull some of the funding away from the metaverse and moving into AI was smart. It's hard for me to ever bet against Mark Zuckerberg. He absolutely is a genius in the field and knows exactly what he's doing. Very shrewd in how he has used that data and monetized it. That being said, I'm looking at a chart that is kind of in a little bit of no man's land here. And, I talked about inflection point when we were talking about Amazon. I really see an inflection point here. And what I'm getting at is this. You have a stock that has pulled back from about an $800 high, traded down to around $575. Tremendous opportunity for investors to step in, and they did. It was one of the stocks that was on the top 5 of our stacks report last month in November, meaning that's the report that shows buying activity.
It's a 200 SMA.
They use that opportunity, that 25%, 30% pullback in the stock to step in. At that 575 level, now we've rallied all the way up to 675, and before kind of pulling back around 645 right now. It's a bit of what we call a bull flag from a technical standpoint. The other thing that is kind of working maybe a little bit against that bullish case is the fact that the 50-day dropped below the 200-day, so you have a death cross. So there's a couple different technical setups right there that may be at odds with each other a little bit. So when I don't know what direction, or I don't have a strong feeling about the direction of where it's going to go, I look to maybe employ an option strategy that can make money in
That's on the daily
directions, but it's got to move. And in this example, and to be honest with you, Kevin, I don't think I've ever brought this type of trade on the show. It's buying an iron condor. We've sold iron condors before, but I don't think I've ever bought an iron condor on the show. So I'm buying the Meta January 16th. Buying the 660 calls, selling the 680 calls, buying the 620 puts, selling the 600 puts. So it's an iron condor with
380
movement. So you have to
390 now.
If you do that for $11, which is
I could exit the trade, but I just want
you need it to either move beyond 660 up to 671 for the top side break even, or below.
We broke my resistance level, and we've got these other two moving averages.
So it needs to move, and
So it's really hard to say. Should I sell it at 420? Then we hit the 200 EMA, 410. Or I'll hold a couple. I mean, 420 is pretty good. I mean, it depreciates the longer it sits at a resistance level. It's 420. If it dips again, it'll be worth less because it's not really holding its value. I can take a nap. May get out of it. Back down to 3683923. Well, you got to sell them.
Trade in Walmart. What's the approach you're taking?
Oh, Walmart.
Well,
that'd have been one to look at today.
Tricky one because it doesn't trade big premiums on their options. And the stock has run an incredible amount if you compare the chart to like Costco that has struggled. That said, historically, this PE ratio
Everybody shops at Walmart.
For a company like Walmart. So here's what I want to do. I did something relatively passive, which is I went out to the January 9th expiration and bought the 110 put, and then I completed my Joe Mazzola put calendar spread by selling the December 26th 110 put. Only paid 40 cents for it, Diane. Like I said, very low premiums. But if you do get that move down towards $110, a little correction from where we are now, not very far, this spread would widen out quite nicely, and you do have a chance to chip away at that net debit when you extend duration. So 40 cents, relatively inexpensive price for some downside protection of Walmart. You've got the Delta and the Long Vega component, Diane and Joe.
Kevin brought the Joe special for lunch here. What's your thought on this?
I didn't know we were calling it, but hey, I'll take credit for that one. Look, the stock's up about 13% from earnings. I think George made some great points about the fact that they've seen a 90 basis point increase in their margin. However, how much of that's already priced in? And I think that's probably what Kevin's questioning. you know, if I look at it from a chart standpoint, the stock got overbought on the RSI for a little bit. It's starting to roll back down. You know, once again, it's another one of those interesting setups because it could be something where it continues to break out. It's at an all-time high today. It could continue to go to the upside. If there's continues to be this rotation away from tech, a little bit more into discretionaries, or I guess this is probably more of a staple. You know, Walmart would be one of those companies that would do fantastic if that rotation underneath the surface continues for the staples because they are a relative strength leader within that field. Now, I think what Kevin's probably getting at is, once again, how much of this is already baked in? Could we see a bit of a pullback? If that is something that occurs, if you get kind of a bit of a grind back down towards that 110 strike, given the fact that these are fairly cheap or fairly inexpensive calendars that he put on, you know, this thing could expand in value and could be a good trade for somebody who's mildly bearish, isn't necessarily expecting this thing to fall completely out of bed, but is expecting a little bit of a retracement back towards the mean.
All right, there's your lunchtime Joe special there on that one, brought to you by Kevin Hinks. We've still got pressure right now on markets, but we're off the lows that we were hitting earlier in the hour. You got the S&P 500 off by just shy of 1%. We're up 2,000 under some pressure as well. Our data populating off there is off by 1%. NASDAQ, the weakest of the bunch of that rotation out of tech continues. Dow off by 1/3%. Thank you for joining us today. That's going to do it for us today on Fast Market. I'm Diane King Hall alongside Kevin Hinks and Jill Mazzola. Download the Schwab app, network app. It's available in the App Store and tune in 24/7 on schwabnetwork.com. Stick around. You've got Next Gen Investing coming up.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate schwab.com, thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy. From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. schwabnetwork.com.
2025 kept investors on their toes. Now, get ready for the road ahead. Join Schwab's panel of experts on December 11th for 2026 Market Outlook, your guide to the forces shaping stocks, global markets, inflation, rates, and more. Hear from experts on where the markets may be headed, spot opportunities, and see what could drive your portfolio next year. Tune in on December 11th at 7 p.m. Eastern on Schwab Network.
I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at schwabnetwork.com.
Welcome to Next Gen Investing. I'm Jenny Horn alongside Alex Coffey. And Alex, as we check out on markets here, we are seeing some pressure that's been pretty much consistent throughout today. I will say that as far as
It's been very consistent.
is concerned this week, there was a lot of positive developments. It doesn't really feel that way when you look back at the week that it was, though.
Yeah, all things considered, though, if you're going to have a down move, in some ways, you'd prefer to have it on decently strong information as opposed to the other way around. So perhaps this is, just some repositioning, some adjustments, some rotation, because even under the surface, Jenny, you still have about half of the S&P 500 names higher on the session. It's just a different group of names. We're going to speak, obviously, about Broadcom today. That's a big part of today's story, as one of the biggest companies on the planet. But also the ripple effects you're seeing from
AVGO.
tech peers. So all that to be said, the losses have been cut by about a third intraday, and down 0.9% from an all-time high close. As long as this doesn't escalate into a 2, 3, 4, or all of next week type of selling, this is just markets. They don't go up every day.
That is very true. And, I guess also right now recovering off of lows we saw earlier is also helpful. But you look no further than NVIDIA and some of the price performance of this week, and it's been pretty lackluster. As we do tend to check in on NVIDIA for a good read on our overall markets. But Broadcom, we'll dive into those numbers later on, really was one of the key catalysts that sent a lot of the tech names and AI exposed names lower. And that's sort of what I see. It's always how you depict the market, of course. I tend to see the market through the eyes of tech, which I'm
watching SPX again
right now, but that has been disappointing this week.
Yeah, and in many ways, it's the right way to think about the market, right? Because it's such an outsized portion of it. But there are other things in the market, and depending on where you're positioned today, you might be having different performance. But it's not the only story. I know we don't spend a lot of time talking about yields, but we got a Fed rate cut, and we've gotten the longer end of the yield. So your 10, your 30 years actually move higher throughout the week. So some interesting dynamics playing out when you look at kind of the entire gambit of financial markets. But all things considered, what does it all point to? It points to growth and productivity and everything remaining stable, not falling apart. And so if you're going to choose, hey, reasons for the market to go down, recession is like the absolute worst one you could pick. We don't have information that leads us to believe that that's on the horizon. It's always on the horizon in some way, but like right around the corner, I should say. Yeah,
and I think a good point there as well. And as always, I know we don't dive into the macro super heavy on this show, but great summation of what we're seeing with some of the overall turbulence in this market. So we'll kick things off here on our show today with some of these movers to keep on your radar. We will also then be diving into some actually earnings that are still ahead, as we do have about 99% of the S&P 500 companies have reported, and I think it's probably even closer to 100, but we do have a few names still left on the docket, Micron as well as Nike. We'll also be discussing, as promised, the Broadcom numbers and really what sent a lot of the tech trade today lower. Gross margin guidance is pretty critical to this report that was, I will say, all things considered, actually still pretty strong despite about a 10% contraction today. We'll also look at some factors that are really contributing to the slight decline we're seeing in alcohol consumption amongst Americans, but specifically young Americans. And we'll discuss some broader trends we're seeing in Tesla with EV sales slipping, as well as closing things out here with Rivian, which has had actually some positive development as it does push into the world of autonomy with development of its own chips. So a lot of developments from them yesterday was when we got a ton of that sort of updated focus from Rivian's, of course, management.
Yeah, there's a low-key just a lot of company-specific news this week. It seems like we're late in the earnings season, but there's like this final wave that we've gotten, and many of the names we're going to discuss here at the top of the show are earnings-related movers. So let's jump into those. Looking forward to that Rivian conversation though later on with George. Lulu, it seemed like it was starting to maybe turn a corner. Maybe it's continuing that with new leadership, Jenny, because we not only heard the financial update, but we also heard CEO stepping down.
Yes.
And I think that's really what's driving, I mean, the 10% move today to the upside, because we have not seen positive momentum in Lulu hold throughout the entirety of this year. I mean,
Correct.
It's been a pretty disappointing name. And it was, I mean, that way definitely going into this report, a 10% move is definitely helping. But as you can see from just the yearly pricing activity, it's been disappointing in the world of retail. But I think that the CEO, Calvin McDonald, stepping down is hugely driving the optimism today that will be effective on January 31st. But their board of directors, they said, is working with
I'll be right
this
back.
leading executive search firm to right now to identify their next CEO, which will hopefully be a positive development. But McDonald will stay on as a senior advisor through at least March 31st. But did say that on a call with analysts, the timing is right for a change. And he said he's described being CEO of the company as a dream job, and it's truly lived up to all of his expectations. But this is not, I think, necessarily the best of circumstances, because it follows more than a year of underperformance, and also does follow its founder and its largest independent shareholder, that being Chip Wilson, making pretty public remarks about how the company was in a downward spiral. He did take out a full-page ad in the Wall Street Journal just about 2 months ago, saying the company's in a nosedive and it needed to stop chasing Wall Street at the expense of its customers. So some drama there. I think interesting, though, that it obviously seems like some of this way of thinking that you need a new leader at the helm of your company was agreed upon by the street, because we're having a 10% jump on what was
I do like garlic sauce,
guidance was a bit,
especially with butter on my shrimp. I put garlic in everything, especially my chicken soup that I just had. Powder and garlic. I love garlic.
summer colors that were like horribly resonated, and they came out pretty quickly and apologized. So they came out and said, we are not resonating with what our consumers want. I will say that going to Lululemon's recently, it's a different environment than it used to be in
they have
a
all
good
different
way.
types of stuff now,
Yeah.
so it definitely seems like a store where you're not just going to get active wear anymore. You can get, you know, relatively nice everyday wear clothing, whether you're you know, male, female, whatever. That it started as this athletic wear driven by yoga. Now they're sponsoring PGA Tour golfers and selling stuff you can wear to a nice restaurant on a Friday night.
I know, my dad always calls it the wearing around side of Lululemon, because it's not, you don't wear it to work out, you wear it around town, which I think is a huge way to compete with the, I mean, looming competition that has threatened their true dominance at athleisure. I mean, the Aloes, the Vioris, the list just goes on and on of these companies that have really redefined streetwear mixed with athleisure, which now Lululemon, a little bit late to the party, but trying to recapture some of that market share. But our next name today, Costco. Very different type of story. Costco did surpass the street's expectations on a quarterly basis, posted year-over-year sales growth, as well as, I mean, 8% year-over-year sales growth as they attracted more of these customers and opened new locations. They do not provide a full-year outlook, but I will say that digital sales jumping 20% year-over-year was positive. Traffic on their website increasing 24% year-over-year, and traffic actually on the app shot up 48%. Well, they did mention that delivery services through Instacart, DoorDash, as well as Uber did help drive internationally, but also just their overall digital sales. So they said they also have had a very positive start to this holiday season, and they've attracted more and more new members, as well as higher sales at their clubs and online, as they continue to seek, I mean, right now, consumers that are seeking their value. I mean, this is seen as more of a bulk retailer. You obviously pay a yearly subscription, so you are more drawn to then go and shop at Costco. But this has, I mean, one of the highest customer retention rates of any company, any product really out there. I mean, it's like 93% plus is their customer retention rate, and that's been the same way for decades.
Yeah, and some of it's due to that sunk cost fallacy with that membership. You feel like you've already spent it, you might as well get some use out of it. And they do that particularly with the gasoline sales, the return customers there. But this isn't, to me, a story of any disappointment. It's more of, this is a story of, you were paying a lot of money to buy this stock at, at its highs for what it was in terms of a premium valuation because it's been so consistent. And in times of uncertainty, it's proven to be relatively resilient. In a little bit more of a picky marketplace, where
it's a little bit overbought, buddy.
That valuation is more of a sticking point. And so that Truist put it well. Last year they downgraded it.
SPX hit the 200 EMA twice.
The business is strong, and they think that it's
I sold it both times.
Valuation, of which this update is more.
And we're back down to 250 again. And I've got in that thing down here at $3.
But when you're an investor, that's not the only part of the equation. The other part is how much you want to pay for this business, and objectively, it just has not been cheap, and it still arguably is not.
It's not, and
it's not.
That's a good point. And also,
it is a good point.
It's a difficult environment right now for even grocers because, well, they can be seen as more of like a store of value and more of that higher customer retention because it is a different type of business model where you have obviously a subscription base.
Low margin though.
Low margin, and also, I mean, grocery like food costs are still elevated, and they have exposure to that, especially with a bulk offering as they do tend to have. Although I will say Costco memberships are a great Christmas gift, so they have been on my radar more than ever as of late, as this is always a good thing to get in terms of a gift. But our next name today, RH, also a great gift to get in a very different type of world. RH actually looking pretty strong here on the back of its earnings as we were looking at this name yesterday, and for example, trading purposes, we were like sort of leaning into more of the same. This name has been so lackluster on the year, so disappointing. It was down almost 60% into this quarterly report. And I will say that obviously able to clear the relatively low bar. We were seeing a nice pop today on the back of an earnings.
Oh my God!
Rising excitement over some of their strategic partnerships that are helping to promise hopefully some more forward-looking growth. So, I mean, very mixed picture as far as still outlook. It wasn't necessarily like, a surge.
Oh my geez.
Growth trajectory right now. And adjusted earnings per share actually did slightly miss the mark on revenue that also just barely topped. But updated revenue guidance is at least.
Ladies and gentlemen, 250 to 650. Thank you very much, Lord. That just made my day. Unbelievable, that's what you are. Can you believe that? I mean, I've been sitting here fucking bummed out, scalping for pennies. Well, not pennies, but this last one was at 250. That's what you are. How's he do it? Boom a chicka, boom a chicka, boom a chick chick. That's what you are. Nothing makes sense.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl.
Schwab, a modern approach to wealth management.
I wonder what happened here, Brandy.
Whether you're a bull or bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
There's no news.
Welcome back to Next Gen Investing. It's now time for our chart master, and today we are looking at two names with earnings still next week. Micron as well as Nike, and joining us, of course, is our chart master, Rick Ducat, to help us look at some key technical levels. And I will say that all of my enthusiasm really is tied to Micron. I mean, this is one of the most spectacular charts of this year.
Oh,
It has
spectacular.
not been a clear shot to the upside, as it never is, but 190% nearly gain this year so far.
Oh, God, she's
One of
wearing her
the
black leather
overall
skirt.
best performers, not only in AI, but in the broader market now.
Yes, as I said earlier,
Pants.
if you were looking for
Whoa,
Broadcom to swoop in
Jenny.
and save this kind of struggling tech sector here, you were disappointed. But
Jenny Horney's dressed up to the tilt, like a rock star today.
storage chips rather than high-end computing chips here. So
What do you think about a woman that wears black leather pants?
kind of always in demand, it seems like, going forward here. When we look at this particular chart, as you said, Jenny, very strong upward sloping trend line here going across our lows here and here. Then roughly when you hit this same point, once again, you can draw this more steep trend line in blue here going upward. We did make new highs recently. Our closing and intraday highs here. Topped out 264.75, the intraday high. We crossed above those previous highs, so that was a good sign for the bulls. Additionally here, despite our intraday dip, we've held on to some of our higher closing areas here around 246 or so. That was our initial intraday high before our gap up. So that was also an encouraging sign that we have thus far managed to hang on to our trend line as well. When we do look at our other studies here, exponential moving averages, we can see that our yellow 21-day EMA here is roughly where we found our low point for the day so far. That comes in at 238.42. Below that, our 63-day EMA, here in orange, 210.54 is where it's at right now. That could be a further supportive area if we do start to break below this green line here. A couple of low points that we had, 218, that we did breach very quickly here. Then we found further support near 193. Those could be some other downside levels to watch, 218, 193. Notice that RSI, our measure of momentum, has been declining much of this time here. You can see that despite our bearish divergence where price was making higher closes, but RSI was trending down, we had repeated entries into the overbought area. That threshold above 70, that's typically regarded as a sign of strength.
11.30 inches of drop in Broadcom's gross margin guidance.
Regardless, the trend line
sell off in technology
above the 50 midline now, but earnings could rewrite that story very quickly. We can see now that our volume profile study lines up with our 21-day EMA here in the form of a volume node near about 235. So a little bit extra emphasis on that area to the downside based on that. But to the upside,
okay, get ready again.
+1 standard deviation channel is pretty close to our previous highs. That's about where we got stuck here. That comes in near 255.50. Could be an area to watch.
We got the 200 EMA here, the 200 EMA here, and the 200. So that's called a pivot point. For this thing to stay bullish, it needs to stay above the 200 EMA.
Bandwidth memory, which is really where it operates, and it tends
And
to
these
drive
are now at $3.20. They were at 10.
For example purposes, I mean, earnings will be a critical test. We know this was not the test
$3.20.
that bulls wanted in names like Broadcom and Oracle this week. Micron's obviously different. Next week is a different week of trading activity, but something to consider. Earnings can rewrite a lot of this upside.
It really can, and I also think the fact that you've had those other earnings not perform.
Sue didn't answer my question.
Led to some of this downside that you're seeing in a name like Micron today, and as a result, perhaps you may not have that same impact when we get Micron's numbers. Neutral to bullish strategy, though, short put vertical that expires at the end of next week. So December 19th, Jenny, we are really, really close to this new year now. But with that 220, 217.5 now. This, I think, directly goes to your point about earnings being disappointing in this space. It's a $2.50 wide spread, so it has risk definition. If you collect 50 cents, you have a chance to make $50 on this example on $200 in risk. How do you make that $50? Well, in this example, if it stayed above 220 by the end of next week, that's where the max profit zone is. You see that here. Risk down to 217.5, then it caps out at 200. Break even theoretically would be 219.5, but what you're really hoping for with this, Jenny, is a relatively quiet earnings report, or if there's noise, it's about how Micron is at all-time highs because things were so great.
You are right that we are getting, I mean, dangerously close to the end of this year, but also that you want hopefully just a different narrative than what we've unfortunately been discussing this week surrounding Oracle and Broadcom and there's a bubble because of two companies.
We're at a pivot point.
Next week. Now
200 EMA.
But they actually have traded with some close correlation, but I mean, Nike's also been pretty disappointing this year, Rick.
Yeah, a difficult sector right now. This apparel sector has been impacted by our tariff news.
Sue's doing the opposite that I'm doing.
The garment industry,
so I better be careful.
A place that's been of specific disadvantage here for some of these new tariffs here. But you can see now things have changed quickly here. This was kind of where we formed some highs after our tariff news shock event here. That was around where we had the lows come in as well, 59. Notice, though, that we didn't quite hit that level during our most recent decline. 59.
Sue's doing the opposite that I'm doing.
59 was our intraday low point that we saw there.
The bet's on.
We can see that price has broken out to the upside from
I think I should sell if she's in puts.
This is often viewed as being more of a bullish setup here. In this case,
I'm scared.
It did play out to the upside. It could have certainly gone down. It's not a guarantee here, but we can see now that after we hit our initial low, we formed a series of successively higher lows. You could then take that trend line and duplicate it, put it at this high. Turns out that's about where we've topped out so far today. This is a tool you can use to project potential resistance. Again, like the other thing I just mentioned, not a guarantee, not going to pan out every single time here, but a useful way you can try to at least consider potential resistance here. We are above our 21-day EMA and our orange 63-day EMA there. 65 and 66.56 are where those two indicators come in. The next stop to the upside potentially could be these old highs here near the 70 level, and from there our longer term moving
case it
average,
dumps.
our purple 252-day EMA
I'm nervous.
is about 71. RSI trending upwards here. We broke through our downward sloping trend line, kind of the opposite picture of our previous chart. In this case, repeated entries into the oversold area, which is the 30 threshold, signaling weakness.
Well, I'd like to know what caused that.
We did see a little bit of bullish
That one candle to move up, unless it was a fat finger or something.
Close, RSI trended upward. We panned out to the upside for now, it seems. Finally, when we look at our volume profile study, our heavy trading areas, one is right here, lining up with our previous highs and our 21-day EMA near about 66. So that's one area to watch out for. Point of control down here near 62 also stands out to the downside. Things start to pick up again near 71.
Yeah, and the name that is also seeing, actually, we're pretty much unchanged now on the session, but not really getting a lift from some of the momentum surrounding Lululemon today. And we'll be watching for these numbers as they, of course, release. To me, Nike typically really marks the end of earnings season. But as we always say, it's always earnings if you're a believer. So there's always earnings to talk about on a weekly basis here on Next Gen Investing. But as we do think through now trading Nike
$3.80.
How do you think through things with, of course, for example, purposes?
Very different stock, very different performance, but a very similar
Was that what it was?
strategy. Kind of shows how a lot of these strategies can be ubiquitous across different types of names, different types of performance, with different types of reasoning. So with that short put vertical again, a credit spread neutral to bullish in construction expiring at the end of next week. Now this one though, Jenny, is a
They're now
$3
$4.
spread, the 66.
Jim, have you ever thought about selling?
And is looking to collect a $1 credit. So changing that risk-reward relationship just a little bit, it's now closer to 2 to 1.
You're up 33%.
4 to 1. So a little bit lower probability.
Have you ever thought about selling?
But a little bit more favorable risk-reward. Can make $100 on that same $200 in risk, so twice the profit potential with a break even of 65. So what do you need to happen here? Same thing, stability through the earnings through the end of next week, stay above 66, and this example has a chance to make $100.
And hopefully seeing some of this further, I think, guidance rewritten to the upside as Lululemon was at least able to give some upbeat tone for the rest of this year. We'll have to see if Nike can do the same. We'll leave it there, though, for Chartmaster today. Now, coming up next, it's time to dive into FOMO. We are looking at, unfortunately, a name to the downside. That is Broadcom, with some margin concerns for their guidance. We'll dive into the numbers coming up next.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks.
Got a head and shoulders right here.
Follow me on X at @NPetalides and connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Dad, I have a question for you.
Dad, can I ask you a question? How come Grandpa doesn't sleep with me anymore?
There were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
Welcome back to Next Trend Investing. It's now time for FOMO, and we are looking at
I think I'm gonna
Broadcom
turn the heater
today
up.
with some downbeat price performance after its earnings.
Because
Joining
we're
us
at
now is
420, now they're at
host for the
350.
Schwab Network for some more insights on the earnings snapshot. And I think it's a lot about what's to come and their guidance. But Marley, what are these numbers?
Yeah, it was a very interesting response for Broadcom. We saw shares move higher, but then we saw them whipsaw, and now obviously they're down more than 10%. They're having their worst performance in months after what you just mentioned, some lofty expectations that perhaps weren't met. Although depending on who you ask, there are different feelings about this report. So let's talk through some of the numbers. We are seeing the biggest intraday drop since April right now, following what some felt was unsettling commentary from CEO Hock Tan on the earnings call. He said they have a backlog of about $73 billion in AI product orders. Those will be shipped over the next 6 quarters. Now, that number was disappointing to some investors. But Tan did seek to clarify what he felt was, quote, the minimum number, saying we do expect much
billion?
more orders come in for shipments within that next 6 quarters. So our lead time, depending on the particular product, can be anywhere from 6 months to a year. The conference call followed this run-up in Broadcom shares. We are seeing Broadcom still with today's decline up more than 56%, but there was a vague timetable. And as a lot of these AI questions linger, and we're coming off the heels of Oracle and their downward move following their earnings, I think that more specifics were wanted, and there were also some concerns about potentially tightening profit margins just by a small amount. Tan did say that the company received an $11 billion order from Anthropic in the 4th quarter, but did warn that the margins might narrow there because of AI product sales. They also then refused to give any guidance on that AI product revenue, and I think that that is part of why we're seeing this move to the downside. Hock Tan said, it's hard for me to pinpoint what 26 is going to look like precisely, so I'd rather not give you guys any guidance. That's a direct quote.
Oh, God.
The analyst I spoke to on Trading 360 today felt like
You just
that was
gave
actually
guidance.
the right call. They said that Broadcom is a long-term play. It's not a short-term play. And to say, I just don't know in the near term is acceptable because they believe that there is a long-term growth strategy in place for Broadcom. They both,
It don't make sense to me.
Irwin, both very bullish on this name.
You got $76 billion back orders, and you can't give a guidance?
The price action we're seeing.
Yeah, and so that's the tough part, right? Because in the end, what
mean,
does it all matter, right? When it's the price. That's where the investment is. That's where the gains and losses come from. But if we're to believe that whatever these stock shares or derivatives of them are to mean, which is ownership in a company, if the company's doing well, that's important too. So I guess it's encouraging for investors today that they're still believers, but how do we rationalize that with a 10.5% decline? Because it's not like the stock is unchanged
I
or
don't know
gave
about
up
these guys.
gains. This is a huge haircut.
We're at 310.
Forrest brought up a really
I'm
good
at
point
320.
this morning to me from Boca Capital. She said that she thinks that people want this AI race to move in the next 15 minutes. They want answers right now. They're not appreciating that we're in early innings or whatever metaphor you want to believe. We're in the beginnings of this AI revolution. She said people want the answers now and they want to see results right now. And she thinks that that's why we're seeing this outsized response today. She did not feel that it was justified, and a lot of other analysts don't either. I mean, Mizuho raised their price target to $450. Piper Sandler raised theirs to $430. They said they think the company is, quote, on a roll. They called the results blockbuster results. They felt really strongly about it. Morningstar felt really strongly about it, raised their fair value to $480. They also said they see Broadcom seeing sizable growth in its AI business at Piper Sandler. JP Morgan raised their target to $475, saying that the results and guidance were, quote, solidly ahead of street and buy-side expectation. Bernstein raising their price target to $475. They said that the angst they see continuing as it's trading down following the report. They're frankly not sure what else anyone could desire as the company's AI story continues to not only over-deliver, but is doing it at an accelerating rate. So every analyst that covers, a lot of the analysts that cover this company is saying they're not understanding the sell-off post-market. They think it's short-sighted. They think it's tied to this AI bubble conversation. A B of A calling it undue concerns as to the move to the downside. I didn't find a single note where somebody said they thought it was warranted.
That's really interesting because I mean, like, a brief snapshot of the numbers, I would have said this was a great report. I will also say that Oracle, to justify some of their price activity, I know they're different companies, but I even thought Oracle gave some pretty strong numbers, but there was much more clear evidence of what
AI bubble
like. Broadcom was very different. It seems like it's more speculative on gross margin guidance and what that means for the broader AI world, which I completely agree. It does feel like there's an impatience in general just for like this appetite for AI build. It needs to happen tomorrow or it's not happening at all. Your efforts are wasted, which I think is a little bit ridiculous.
And it was interesting to be talking about Broadcom too at the same time that
this was incredible.
Where they're going to delay some of their OpenAI data build out because Kim Forrest
I
brought
can't
up a
even-
good point there. That is
Came fast what just happened. I said, I sold mine double top here, and then I shouted out 250 off to 63, and it wasn't even 3-4 seconds. Boom! I'm going. I was just getting ready to go into the. Now I'm back down here. Now I'm down $1. I mean, off the 200. I should have grabbed a couple more right there off that 63. I was down $1 just a second ago. This is a bull flag here. So that's the fourth time now we've hit that 200. 200 here, 200 there, 200 here, 200 there. Now we're breaking out of this flag. This is a bull flag. What? How do I say that? I'll show you. I like to educate. But a day like today, you never can tell. So that's your flagpole. And then it comes down. Then usually on your 3rd or 4th time at the top up here, it breaks out. You had your 3 in the bottom. Well, I got some old resistance lines on OCG. These probably go back to 2018. So when I used to trade this back here. 22? Seemed like it'd be going back farther than that when I used them orange lines. Yeah. I'm still holding on to these. We broke out of the flag on the triple top. Actually a quad. Slash ES is at the support orb. Well, I got $5, $5.60, $4.97 to $5.60 on OCG if we break this resistance. The CCHH bounced up a little bit. You did a double bottom when I was watching it. It's up about 80 cents now. God darn it. SPX. I don't think Putin will stop until he gets some territory. Unless he gets shot. But I heard it's very hard to poison Putin. Well, we're back down here at my support level again. 683923. 86683923. Well, I'm in these calls. On his bull flag. pulled back to the pivot point. I gotta watch my number here. We hold this support one more time. Please don't cross the line. 68, 39, 23. Dadgummit. Man, this has been one heck of a day. All these China penny stock, is that what this OCG China? I think it is. Yep. You can pull back to that line. What was resistance now becomes support, Chris. What are you going to play? Randy? OCG? China? It's been bouncing off that 63. I'm in the SPX, I'm down. Now it's starting to reverse back up, but it's got to break that resistance, that shoulder line. Get back up there. I don't know what kind of ending we're going to have today. They keep saying bubble. Oh my God. These things drop so fast. Well, 5 to 1, which is 5 to 2 Eastern time. We're getting close to that period where you just don't know what's going to happen. receive the King. Let every heart in heaven and nature sing. Joy to the world, the Savior reigns. Let men their song joy. Dadgummit. $6,800 puts didn't do much. Dang. We should have. Okay, I'm at 110. Are we going to hit the 200 or are we going to hold here? I'm about ready to give up the day. I'm barely green. I like the 222, Randy. It's like a triple top breakout. On OCG. SPX. This really sucks. They were arguing about Obamacare this morning. They're saying all the things that went wrong with the bill. And Becky Quick says, well, there's one good thing. It insured more people. It drove us into bankruptcy, but it insured more people that didn't have insurance. You know, that never had insurance. Probably the ones that don't work. Well, we're going to see if we touch the 200 here, and I'm going to load back up. I'm going to load on. There we go, right here. Now, am I too far out of the money? No. Getting close. Okay. Got a hold right here, 80 cents. We got 12 contracts at 120. Hey, Sue wins. Come on, baby. I'll be right back. Oh.
Poopy.
So there's going to be a lot of opportunity. There are going to be billions, even trillions spent. I sound like Bernie Sanders all of a sudden. We're going to see trillions of dollars spent, and maybe there are opportunities here.
OCG hit that 200.
Going to go and to buy those stocks because those earnings are going to go up a lot.
So what's the
takeaway here? I mean, I know there's a lot of details about debt or worried about PE ratios. Some of the PE ratios are not terrible, particularly for names that are doing, I mean, like an NVIDIA, for example, just got more, you know, now there's talk about them printing more, making more H200 chips because they're seeing rising demand. That seems like real money, real story. It's not like speculative or, in an idea of something. And the PE ratio is not bad on a name like NVIDIA, like it was in the tech bubble when things were 100 times plus in the PE ratio, right? I mean, so is tech
when the stock price
still
goes down,
a
the
thing?
PE ratio goes up. Yes, it's true. Look, I think you're right. These companies, some of these companies are generating not just profits, not just cash flow from operations, but actual free cash flow. Now, the money they're putting into CapEx reduces free cash flow, but it's amazing to me right now in this week, in the year of our Lord 2025, in the 50th week of the year, all of a sudden the market cares about tech companies' free cash flow. That is not an area where tech investors have typically focused. Maybe they should, maybe they always should, but that is a unique moment right here, the concern about CapEx spending from Oracle.
Well, I'm at my third support now, 68.26.
Maybe some of the data centers build-outs are going to be pushed out a few years. Look, Oracle didn't give us specific data center dates because they know this is construction. If you've ever built anything, you know the construction takes longer, costs more, and is going to be open to surprises. And that's certainly going to happen with the build-out of these data centers. But when you look over the long term, when we are sitting here in 2030, God forbid you, Nicole, you and I are sitting here in 2030, but it may be the case, we will be sitting here and looking back at what happened over the previous 5 years. We are going to see that trillions were spent in data centers. And we could have made decisions today about where we want to invest, whether one quarter is up or down, whether those companies are going to be the real builders of this future world of AI.
And look, I mean, we saw NVIDIA coming down on the news that some Oracle data centers for OpenAI were being delayed to 2028 from 2027, and that was something that weighed on NVIDIA stock today. Corey Johnson, Chief Market Strategist at Epistrophe Capital Research, thank you so much.
Thank you.
Coming up next, Options Corner, and Rick Ducat is standing by. He'll highlight the unusual options activity from the day and how investors are looking to trade on recent news of Broadcom, the Triple Qs, and Citi.
Broadcom down $46. Tech's taking a pretty big hit today.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to the watch list. Time for options. Options Corner, where we analyze unusual options trades that we're seeing throughout the day. And a lot of times it's on some big news or some heavy trading that's going on. Of course, Broadcom came out with its numbers. Rick Ducat, lead market technician, Schwab Network, is taking a look at AVGO and a trade that you found. If you could explain. Hi, nice to see you, Rick Ducat.
Yes, you too. You know, Broadcom is kind of the story of the day here. Very disappointing price movement here for the bulls. Last time I checked, they were down about 11% or so.
Yes, they are.
Despite earnings being pretty good. We saw price target raises today from Bank of America, Goldman Sachs, Rosenblatt, and Benchmark. The targets came in from 450 to 500. You know, and the results were good. As I said, they beat on the top and bottom line. The $73 billion backlog beat the expectations of $69 billion. Guidance was also good, well above expectations. So, you know, what is going on here? It seems like, you know, perhaps just profit taking in an overheated market. We've seen this extraordinary AI boom here, but at least one trader seems to think that we're still in for a bit more trouble here. The trading question, plus 6,000, February 26th, 310 strike puts at a $6 debit here. So a $3.6 million debit paid here for this bearish opening trade. We would have 70 days to expiration here, and this is an opening trade as well. All three of our trades today are opening trades. I try to find opening trades rather than closing trades typically. This would be, you know, obviously just a simple bearish play. $3.6 million max loss is our debit paid here. You know, we can see that at the time this was done, you know, the expected move here was about 16.9% plus or minus by this time horizon here. So a pretty big swing. The break even comes in at about 304, which is very close to the edge of that expected move range here. So this trade would need a bigger than expected move to really make some gains here. So perhaps a bit more of a more negative view here from at least one trader here about the prospects of this in the next few months.
Okay, well, this is the big story of the day, as you noted. I mean, there's still a lot of mixed. I mean, Rosenblatt had a 450 target. I mean, there are some that are out there. 485 for Benchmark. Citi had a 480. So there's some on board, but certainly a wild stock today. And I'm so glad you brought us this because it's down 11% right now. I mean, that's huge. Then I was looking at the triple Qs down this week. Some of your thoughts on just that tech trade.
Right, you know, so this one's an ETF, not really any specific news on this one here, but to kind of just piggyback off of our last trade here, overall picture has not been super great lately. You know, Oracle had its own very significant decline earlier this week. These two names are a big part of this sector here, and the broader scope is kind of this overall pair back of these explosive gains that we saw. If we could pull up our chart here, you can see on the chart that the QQQs hit their all-time highs near the end of October here. So then we saw another rally from that point here. It didn't make new highs from the end of early November, in early November. That was our high point previously. Now in our most recent rally, we failed to make any new significant highs. Now we're starting to see a bit of a pullback here. So another trader here has a similar bearish viewpoint. It's kind of the same type of trade, but on even bigger scale here. Plus 10,630, January 30th, 560 strike puts at a 460 debit here. So this one is a $4.8 million debit paid. Quite high numbers here that we're seeing. Again, an opening bearish trade here. The break even 555.84, a good bit beyond the expected move. In this case, the expected move would be about 6.6% by this expiration here. That would be 571 to 652 roughly at the time I calculated this. So the break even is about 9% to the downside here. So perhaps they don't plan to hold till expiration. You know, perhaps they have a different type of strategy here. But that would be a pretty big move that we would need to see even a break-even point on this particular trade here. Max loss, once again, debit paid about $4.4 million. A shorter-term trade as well, 49 days to expiration for this one here. And in terms of our sizzle, our activity, 5.7, so 5.7 times today's option volumes 5-day moving average. So elevated activity in this name as well.
Understood. Okay, you know, it's amazing because people are loving what they're seeing, big picture for the year in tech. We've had 3 years of a bull run. but you know, it's on track for the 4th losing week in 6, as you noted. Let's take a look at Citigroup. I mean, I saw some positive comments too about the banks overall. What's going on with Citi and your thoughts?
Yeah, so this is kind of the counterpoint to this tech weakness here. Financial strength seems to be what we're seeing here. JP Morgan upgraded Citi 124 from 107. They upgraded to buy. Basically, the note said that they would benefit from
the double bottom there
and related markets activity. The revenues are looking good, and other factors came into play here. We also saw this month price target raises from Piper Sandler and Goldman Sachs. In all fairness, Goldman Sachs was only a $1 boost from 113 to 114 here, but William Blair also initiated at a buy earlier this month. So the analyst coverage seems more positive once again here. And this trade is our biggest one of all by far here. This is a very large trade, plus 5,256 September 18th, 72.5 strike calls at a 42.10 debit. So buying very deep in the money calls here. This trade, the debit paid is $22.1 million. So very large, as I said. Again, an opening trade. Break even was pretty close to where we were trading before here. We would only need to move up to about 114.67 for this trade to start making money here. Now,
CG didn't hold it to 200.
280 days out here, so this one is the longest trade by far, the longest time horizon here. Max loss, once again, $22.1 million. Our debit paid. Break even, pretty close here. The expected move range is plus or minus 23%. So this could be quite a large amount of money if Citi keeps performing as these analysts are hoping. So one thing interesting too, I saw a very large closing trade was paired with this trade here. In this case, it was a $23.1 million debit paid for the same amount of the June 18th 70 calls. They were buying to close, it seems like. The initial opening trade, they sold for $32.07, so they got a $16.8 million credit. It seems like just kind of back of napkin math. So a $6.3 million loss on the closing trade. Yeah, not exactly a fun experience probably, but we never know. This could be paired with some kind of other strategies. There could be other things here. It could be any number of things that we don't really have the incomplete picture of. Just wanted to point out some very large numbers here in this name.
Okay, I mean, pretty amazing here. And it's at the highest level since 2008, and that's so great for the financials. As I was saying, the XRE, the regional banks, the XLF, also at 52-week highs. Good to see financials here doing well. Thank you. You know, so many people are invested in that group. Thank you so much. And of course, the overweight rating on Citi today from JP Morgan that you mentioned. Rick Ducat, thank you. Options Corner, we have that every single day, and we're talking about some of the big trades that you need to watch. Coming up, Wealthfront goes public at the NASDAQ. The profitable fintech managing more than $90 billion in assets. It's making its market debut, and it's betting on the next generation of digital investors. We'll explain. We'll be right back.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade. giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to the Watch List. I'm Nicole Petalides, and we're live on the floor of the New York Stock Exchange. It's our pleasure to bring in Alan Imberman, CFO of Wealthfront. Went public today on the NASDAQ. We're looking at the ticker symbol, Wealth, WLTH, great ticker symbol there. Let's talk about this because you have more than $90 billion in assets and some sustained profitability that you could tell us about too. How's it going today? Good to see you, Alan. Tell us a little bit about the story here of Wealth.
Yeah, thank you, Nicole, for having us. Yeah, so Wealthfront is a tech-enabled platform built for the digital natives. These are typically folks born after 1980. And as you mentioned, we manage over $90 billion for almost 1.4 million clients, and we've been profitable for the last 3 fiscal years. And yeah, we have a really good cost structure that allows us to not only be profitable, but share savings with our clients, which has been a real key to the growth that we've also produced.
So you price at the top end of the range. You must have had a lot of demand for the company. You know, this is like the days of old when we used to sort of go to our Fidelity or Vanguard or, of course, Charles Schwab. You know, how do people find out about Wealthfront, and what makes your company so different for young investors?
We actually grow mostly with referrals. So over half of our growth in new clients the last 2 years has come through referrals, people telling friends, family, coworkers about the product. And then the reason why is because the product is so great. So we offer both investing products to help people save, both with automated solutions that do rebalancing, tax loss harvesting, all for 1/4%, or high yield cash account that also does all of the checking features that one could get with a bank, but a 3.5% rate today. So, you know, the way people can find us obviously is on mobile or web, and the newer generations, they expect to do all of their day-to-day lives using mobile. They'll order their food on mobile, they'll get an Uber on mobile, and the financial services are no different for them. And that's where we come in with really just a digital first product that has always been built like that. No branches. People tell us they pay us to not talk to us, but we do have really great customer support if someone does want to talk to us. But you know, if people are writing in, that's usually a product problem, and we fix that. So that's kind of our ethos, and our clients really love that.
I do want to talk about the IPO market, particularly in fintech, but how are you profitable and sustaining profitability? I mean, you're sort of a younger company, I guess, but you're doing it. How are you doing it? As a CFO, you know the answers.
That's right. Yeah, I think we're one of the most profitable IPOs this year. The way we've done that is a really disciplined strategy from the beginning. Over half, or just about under half the company is software engineers. We've traded variable costs for fixed costs throughout our history by building stuff internally. And that has allowed us to really reach scale. We became profitable in October of 22. We've had 55+% EBITDA margins in our history. Today we're a little over 45%. And that's just really building a scalable platform where an incremental dollar of assets on our platform doesn't cost us much to manage. And we'll continue to do that in a way that also helps our clients have really great financial outcomes, which is the thing we're focused on most, is great client experiences and great client outcomes.
It charges, you charge typically 1/4% annually on assets under management. For the investment advisory service. How would you compare that to other fintech companies or other wealth advisors?
Yeah, I'd say first on the other fintech companies, most other fintech companies are using transactions which monetize when people make behaviors that may or may not be in their best interest. We're different. We're aligned with our clients' success. We only succeed when our clients succeed. And so we charge 1/4% for our investment products. So when our clients are doing better, we're doing better. A typical advisor can't afford to have a client of our account size. Our clients on average have $70,000 with us. That's also different than a typical fintech. We cater to a higher end of the millennial and Gen Z demographic. But in general, you can start with Wealthfront with as little as $1 in a cash account or $500 in an automated investment account. So we also really have brought sophisticated financial products down so that anybody can access them today.
You noted how millennials, Gen Z Americans are actually due to inherit trillions of dollars from baby boomers and Gen X parents, and that this is a digital generation and they're ready to do this. The money is protected up to a certain point, I guess, like many of the other places where people like to keep their money.
Yeah, that's right. So we offer $8 million of FDIC insurance and up to $500,000 of SIPC insurance, SIPC insurance. But one point you made too is the wealth of this generation. And actually our estimates are that they'll have $140 trillion by 2045. And that's without including this generational wealth transfer. Our clients, those generations, they're going to be successful on their own, despite the media narratives that they're not doing so well. We actually see them doing well and are very excited about that.
Other fintech companies are similar to you or not at all?
Yeah, like I said, I think that we really don't have anyone similar to us in our category. Most fintechs are growing with high marketing, high churn, and transactions in order to incentivize growth. We're product-led. We have aligned incentives with our clients and how we monetize our, the assets under management. And we think that that's a unique approach that has lent us to be a more trusted brand, which is why we think people keep their real money with Wealthfront. And why we have a much higher client size than other fintechs.
I wanted to know how the lending is going. I know you launched socially responsible investing portfolio, also automated bond portfolios and securities lending. So as you're offering more lending products to clients, what kind of demand are you seeing?
Well, actually, one of the lending products we just launched is our home lending product, which we've actually been seeing our clients do a lot of mortgages in a 6 to 7% interest rate environment. So we're very excited to roll this out as rates come down. And really, the thing we're most excited about is our clients are buying houses today, and we're going to be able to evolve with them as our clients get older by offering them this great product, which we think we can price better than the national average, while also offering that great digital experience that our clients have come to love.
Understood. Alan Emberman, thank you. It's great to chat with you about the CFO of Wealthfront. So keep an eye on WLTH. Thank you for joining us on the show. He's there live at the NASDAQ. All right, coming up next, looking at AI and why AI's power needs are exploding, turning the grid builders and clean energy suppliers into some of the market's most closely watched stocks and names. We'll be right back.
Boom, boom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardis and connect with me on LinkedIn or Instagram for more.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to the watch list. I'm Nicole Pedalides. The Dow right now down 213 points. The S&P's down 1%, down 71 points. We welcome in Carol Weibel, CEO of Domini Impact Investments, to talk about some of the action we've been seeing in the markets. Definitely want to get to AI and some of those obviously hot topics. How are you feeling lately? Before I get to the real AI story, how do you feel lately about the market overall? Where's the path to least resistance?
Yeah, I think we're seeing a nice broadening out on the AI trade. So where it started off really in the semiconductors and on some of the larger IT players and the hyperscalers, we're really seeing that broadening out now to the needs on the data center and the electricity.
Yeah, it's amazing how we've seen, we've seen nuclear and electricity and utilities.
What's a hyperscaler?
Interesting story too. But as we see the AI story here, and I had said earlier that there was a report that some Oracle data centers that were for OpenAI were being delayed and NVIDIA went down. However, Oracle spokesman came out and said there are no delays in Oracle's meeting all its commitments to the OpenAI data centers. So I wanted to add that in. At the same time, I mean, what
Hyperscaler is a large cloud service provider.
Yeah, sure.
AWS, Azure, Google Cloud.
AI trade, so building out those data centers requires a lot of energy, so very energy thirsty, creating a bit of a supply-demand imbalance, and really looking to
She sounds like she needs to be married to JFK.
Grid, provide more power. And you were mentioning some of the sources of power at the start. But what we're really seeing now in, the life cycle of renewables is with the solar and those utility scale onshore wind, they're now the cheapest and sort of
OCG just went to 95 cents, Randy.
So really seeing the AI and the data centers tailwinds for renewables, but also, as you pointed out earlier, a lot of the other infrastructure.
Did you just type that in before I said it?
Everything from real estate to building to cables. So, for example, one of the names that we're really excited about in the industrial arena is Quanta Services. In fact, ticker symbol PWR. So, short for power, really focused on
I was watching it.
Grid hardening, but working across not only deep into electric utilities.
This girl is hard to listen to.
Companies and government entities, with that recognition that with the supply demand.
Are you okay, honey?
That's been created through the build out of the data centers is really something that's been critical, and multiple parties focusing on.
You should have stayed home today.
That not only to serve those data centers, but also to serve the communities that those exist in. So this is a stock you can see here is up 41% year to date, but also has had 22% year over year earnings per share growth, and continuing that success with a backlog in the high $30 billion range.
I know so you just mentioned Quanta, which is a great one there. You talked about, aging infrastructure and how Quanta fits in. And then you have names like Sienna and Corning, because the investing landscape is continuing to develop. Where do names like Sienna and Corning fit in?
Yeah, so those are both really interesting stories. We start off with Corning, and this is a company that's 174 years old. I think a little bit of a surprise to investors as they continue to reinvent themselves and continue down the road of innovation, up 87% year to date. Looking at their history, starting with light bulbs back in Thomas Edison days, and then moving forward with Pyrex cookware and Gorilla Glass. but now really leveraging that expertise that they have in optical solutions and specialty glass as a way to position themselves as a key player in that data center build out, which really requires those optical solutions. Not just resting on their laurels there with the data center, but really
SPX broke some major resistance levels.
Renewables as well. So they've just built a massive facility in Michigan, and the goal there is to produce solar wafer. Just as sort of a side note, we have not produced solar wafer for
I can't
solar
stand listening to
panels,
that girl
here in
anymore.
the U.S. in over a decade. And
Oh, it's hurting me.
currently, China produces about 97% of that supply. So Corning now has made it possible.
She'd be a
for
tough
us
one to work with.
Fully produce a solar panel here in the United States, and could really be their next big business. So looking at this, what some people may have considered a 174-year-old, sort of sleepy company, but watching it capitalize on that opportunity and really leaning into.
I've been
data
faked out so
centers,
many
but
times
also,
today.
that shift to renewable power as well.
Right.
And
I know you also had First Solar and Next Power and Comfort Systems.
It's one of them days where I should trade the opposite of what I'm calling, but I'd still be about where I am no matter how I looked at it.
So these are all services that are going to be critical.
See, right now I'd want to take this trade off the 21, off his head and shoulders.
I mentioned Corning with the optical expertise. So if we think about that as the highway, then Sienna,
The 84, 8640s.
signaling between, a company that is in the IT and the communication equipment.
And once I jump in that sucker, it'll dip on me.
162% this year with almost 70% year-over-year.
Snake breakout pulled back into an inverse head and shoulders. I mean, I really like this trade.
The AI and the data center infrastructures, because they have that high-speed optical network and are able to connect those data centers, boost performance within them, and enhance reliability. Comfort system, typically you would have thought of as an HVAC, and
Watch what happens.
making the connection between
240.
AI and data centers with what previously we thought about as, an air
Watch the sucker
conditioning
reverse on
company,
me.
But with the high density of computing power in these data centers, there's really a need for not only cooling, a lot of cooling, which comes through energy and water usage. And when we look at a company like Comfort Systems that has expertise in mechanical, electrical, plumbing services, you can see how they would be a major beneficiary of this AI.
Honey, I
and
gotta
data
let
center
you go,
build-out.
man. You're
They
bumming me out.
very innovative and have this nice mode in that they have unique technology where they're able to
SPX Lotto 6840s at 240. If you want to lose money, don't follow me today.
bring it to the data center as a wall, really installing it more like a module and bringing that data center online much more efficiently. So looking at that stock up 128% year to date, but also with over 100% year over year earnings per share growth. And no wonder with those certainly greatly needed services inside of the build out for those data centers and AI technologies.
Okay, Carol Leibel, thank you, CEO at Domini Impact Investments. Thank you so much. It was great to see you, and thank you for all those specific names. I mean, I think that it was really great you took time to give us each of those names. Good to look at for 2026 investing. Appreciate it. Thank you, Carol. Coming up next, and happy holidays, Carol. Coming up, our panel's ready to break down the athleisure.
God damn it.
What's going on? Is it going to stay hot? Lululemon gives us some good numbers for the quarter, but are there worries ahead too? You have price pressures, getting rid of inventory, competition. So how does AI also help? We'll be right back.
The final 90 minutes of the trading day That's when markets make headlines and traders make decisions.
From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day. This is Market on Close, live weekdays 3 p.m. Eastern, only on Schwab.
Come on now, let's get back up here.
Opportunities don't stop when the market day ends.
MSOS is running nicely.
Schwab gives you round-the-clock access.
That's
to
another
over
pot stock
1,100
that does
of the
real
most
well.
Stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving,
I'm still in
spending,
this thing.
or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Sam Vardis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Welcome back to the Watch List. We bring in our panel to talk about what the consumer's been doing, a little Lululemon and more. David Swartz, Senior Equity Analyst at Consumer Equity Research Investment Research Morningstar. And Senator Shamis is with me, CEO at Return Pro. So I'm so glad you're both here. And if you could just tell us a little bit about what Return Pro is, Senator, so you could tell us so that we know a little bit about where you're coming from in this group.
Well, thank you very much for having me. Return Pro manages returns for major retailers and brands. The idea is basically to solve returns by eliminating every part of the post-purchase experience, making sure that we tie everything in from the original sale all the way through the final disposition.
Come on, baby.
So how hot would you say athleisure is based on what you see people buying and or returning? Is athleisure still a hot area? Because we did hear from Lululemon today, and they had a nice quarterly beat. They raised the guidance, but they are in search of a new CEO, a bit of a turnaround.
So I think sales right now in terms of macro sales are basically higher on the general merchandise categories. What we're seeing is definitely a better holiday season, but from a returns perspective, usually the highest return categories are apparel, but not necessarily the highest price points. Retail returns are expected to be above $800 billion, which represents around 16% of everything purchased in the United States, which is a massive number and a huge problem to solve.
All right, and look, sometimes we see international better than the U.S. Or David, what are you watching here, and how confident are you feeling?
Companies that I cover have issued pretty positive guidance for the fourth quarter. Of course, the holiday period isn't over yet. It really extends well into January as companies hold their post-Christmas sales. But generally positive outlook. Now, in terms of Lululemon specifically, Lululemon is facing a pretty difficult fourth quarter here. The company did raise its guidance, as you mentioned, but it was primarily due to the beat in the
Back to
third
even.
quarter. The fourth quarter is likely to be pressured by significant discounting, as Lululemon has a lot of excess inventory that is trying to sell ahead of new merchandise releases in 2026. It also is facing high tariff costs, which it hasn't been able to fully offset yet. So it's going to be probably a difficult holiday period for Lululemon, but I think a lot of other retailers are much more optimistic about this current period.
Waiting because Calvin McDonald will be stepping down January 31st, and the founder of the company, also a shareholder, Chip Wilson.
Well, it did come down and do the right shoulder the second time.
Board overall, because because they didn't
Left
really
shoulder,
have an
left shoulder,
effective
right shoulder, right
succession
shoulder.
plan for him, and now they've turned now to outsiders, to these sort of headhunter type things.
We're at 250, 260 now.
Pros,
I'm at a resistance level.
real, experience to have and pick the CEO, because the leadership is such an important part. Just quickly on athleisure.
Oh, you did it, Jimmy. You did it.
Lulu, Alo, Athleta, anything from Macy's, David. I mean, is Lulu still a highly respected name? Because the concern here is that a turnaround plan going forward may take time, according to Bank of America. Quickly.
Yes, I definitely think it is. It's certainly outperforming Athleta, which is owned by Gap and has been in a significant downturn. Lululemon has been holding up better against competition like Alo and Ferrari. The market has become much more competitive in the last 2 or 3 years, though, and that has been reflected in Lululemon's results, especially in North America.
And then you're talking also about behaviors. You have how people are shopping, secondhand markets, and also tech adoption. I'd like to start with the tech adoption. Why is that such a big story right now?
I think just from a perspective of
I hope so.
a lot of companies are just looking for places where they could save and add value to their supply
Just
chain.
at 270 a second ago.
For most
Now it's back
cases.
down to,
From a returns perspective,
well, it was 210, now it's
the faster you get the product on
225.
the shelf, the faster it hits that particular season. It's extremely important to adopt proper tech on the supply chain side, on the marketplace side.
I think the market's trying to make a point today about these AI stocks.
And get them up to that secondary market so you can recover as much as you can on those returns.
So, I mean, the AI part of the story, you said 52% of consumers have used AI-powered shopping.
That one girl gone, she was driving me batty.
Customers are using AI, but you're saying how the companies are using AI, I guess, to get the inventory out and get it back in and get it back to where it needs to be. What about shopping behavior for this holiday season?
So I think, with returns...
Good question, Nicole.
At least 50% of consumers indicate that they won't shop unless there's a favorable returns policy. Additionally, we've seen these habits turn towards AI tools where they don't just want to buy through AI platforms. They also want to return through AI platforms. So it's extremely important that technology that we have for returns management starts adapting to the behaviors that consumers are showing today, which is shopping through AI.
You also noted that a lot of the returns in athleisure are actually because of the size or the fit, and they're using AI to try to guide the sizing a little better, using virtual try-ons and more improved product descriptions. You have that in your notes. I think that's a really important point. David, you're covering Lulu closely. I mean, I don't know what other names you cover in retail. We're expecting retail sales next week, but what are your thoughts on Lulu? Because obviously, it's a tough go of it right here because we're just not sure about the future. I mean, what's your rating on this stock and any others that you follow in retail?
I do think that Lululemon stock is quite undervalued. My fair value estimate is $295 a share. So I actually think even with the stock up about 10% today, it's still quite undervalued. And there was a time when I thought it was very overvalued. As far as retail goes, there are some opportunities out there from companies that have really been struggling, such as Capri, for example, which owns Michael Kors and Jimmy Choo. The stock is quite undervalued, in my opinion. Another one that I would highlight is potentially Kohl's, which was up a lot after its last quarter and is trying to has brought in a new CEO, like Lululemon is about to do, and is trying to turn it around. And I think Kohl's stock is quite undervalued right now. And so there are some bargains, but you really have to look for companies that have been struggling, because others, like, for example, Ralph Lauren, their stocks are already up so much that I'm not sure that I would want to invest at this level.
All right. Well, thank you for that. And I'll give you the final word.
So from an athleisure perspective, I think it's really important to mention that most CEOs right now are trying to increase the amount of models. The demand from the consumers that they want more SKUs from an availability perspective. More SKUs you have, the faster you have to be able to resort that product as it comes back and get that product back on the shelf. And it's a very important thing. The supply chain for that particular retailer or brand may not be set up for it. So it's extremely important to have that infrastructure in place to be able to support these new initiatives that the CEOs who are trying to revitalize these brands are going to come and deal with.
And you noted that 60% of the retailers admitted to raising prices to offset inflation and the rising returning costs. I mean, the margin pressures are always evident. It's great to see you both. Thank you. Sender Shamis, the CEO here with us, and David Schwartz. Thank you also for being with us. David Schwartz of Morningstar and Sender Shamis of Return Pro. Nice conversation. I enjoyed that.
285.
All right, keep it right here because I'm Nicole Petalides. This was the watch list, and you have Market on Close next.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders.
Well, it don't look like we're going to get a short cover in there.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
2025 kept investors on their toes. Now, get ready for the road ahead. Join Schwab's panel of experts on December 11th for 2026 Market Outlook, your guide to the forces shaping stocks, global markets, inflation, rates.
We have 1 minute to power hour.
Experts on where the markets may be headed, spot opportunities, and see what could drive your portfolio next year. Tune in on December 11th at 7 p.m. Eastern on Schwab Network.
I'm Nicole Petalides at the New York Stock Exchange. Live interviews, market and real-time coverage right from the floor. Subscribe now at Schwab Network.
Yes, ma'am. I'll do it. We got to break the 200, I think. And back to even. It was just 170 a bit ago, 160. 170.
Good afternoon. It's 3 p.m. on Wall Street, and this is Market on Close.
Jim, you're hot.
Caden coming to you live from our Chicago headquarters.
Happy
Yummy.
Friday to you, Marley. I'm Sam Barnes, coming to you live from the floor of the New York Stock Exchange. Let's take a look at what is coming up on today's show. In our CEO Spotlight, we'll check in on the state of the commercial real estate market with the CEO of Marcus Nguyen. Later in the show, we'll also focus on robotics and how AI and robots are helping logistics and shipping warehouses to meet consumer demand. And in Options Corner, we'll also look at Rivian after a report saying it's entering the autonomous driving race. But for now, Marley, take us through
Rivian.
what's on your radar today.
Broadcom, one of the big stories today.
People have been
Sam
talking
shares
about it.
falling despite posting a beat on both the top and the bottom lines, alongside better than expected guidance for the current quarter. The record quarterly revenue was not enough to keep the stock in positive territory following comments from CEO Hock Tan on the conference call following earnings. We'll break down what he said coming up. Also, Oracle is denying reports that it's delaying some of its data center projects with OpenAI. Bloomberg is reporting that the company is pushing back the completion dates for some data centers it's developing back to 2028. That's a year later than planned due to labor and material shortages. And Lululemon stock rising double digits today after posting a strong earnings report. The retailer said that its performance came from the international markets, also announcing that its CEO will be stepping down. We'll talk through those numbers in just a moment, but let's see how the markets
Whatever I've been into is very hot.
The end of the trading week here. We are entirely in the red across the board. The S&P trading down 1% right now at 68.30.13. On the NASDAQ, we're trading about 1.8% lower, 25,226.56. On the Dow, we're about 0.4% lower, 48,499. We've given up more than 200 points today. And the Russell 2000 down 1.25% at 2557.47. The dollar mostly unchanged, 98.01. Gold is ticking up to a 7-week high, 43.2820. That's up 0.25%. Crude oil down about 0.33%, 57.41, and Bitcoin is trading 8.75% lower at 90,395. I do want to check back in with Sam though and see what top stories caught her eye today. Sam?
Well, some of those stories that you just mentioned, Marley, having a bit of a spillover effect. Look at memory names. They are under pressure today. Western Digital, Seagate, SanDisk, and Micron, all among the worst performers today on the S&P 500. And those come amid these concerns about the tech trade, and memory stocks, of course, closely tied to that, and AI and data center demand forecasts. Now, these stocks have had a good run up this year. Stifel actually raising the price target on Micron today to $300 from $195 and keeping a buy rating on the shares. It says further strengthening in AI right now, and infrastructure demand has proven a tipping point for these memory prices, and they're rallying hard into year end right now. That could be the reason behind the move and this price target boost. But the analyst also expects Micron to report and guide meaningful upside when it reports next week. Now, the other thing I've been watching, Marley, is this 10-year yield. Take a look at that. It's back up to 420 today, and that's where it was the morning before the Fed.
Well, we're dropping. This is my support line right here on the 5-minute. Goolsby. But they sure can switch it quickly. We've got to break to 21 on the 5-minute. Yep, I am. At 240 and 150. Let's hope they do. I need a big old bounce. I got a headache from today. There we go. Jimmy's looking better. Or it was. Marley and Ginny Horney are speaking with their black leather pants. Oh. Sorry about that, folks. We got to break the 21 here. I like get it like for $3 or $4 a contract. There's 270. Come on, baby. Give me $5 a contract. Right now I'm up 600. Oh, 340. Now when I get up nice, I hold on to them and they end up dipping on me again. I need a chicken train because look, see? 340 to 245. It's
Our next guest saying we're in the middle of perhaps hitting the pause button today, but we'll talk about it. That's coming up next on Market Uncovered.
Hey, investors, you know the market moves. Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
AI bubble.
I'm Nicole Pedalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Welcome back to Market on Close. I'm Sam Vida from the floor of the New York Stock Exchange alongside Marley Caden in our Chicago headquarters. Let's welcome in our next guest now, Stephen E. Orr, CEO and founder of Quasar Markets. Hi to you, Stephen. Thanks so much for joining us. I guarantee it's me. I sound different. I'm losing my voice, but it's still me. You say we're in the early stages of a Santa Claus rally. We've hit the pause button today. What does that tell you about the sensitivity of these markets, particularly when we get headlines like we got around Oracle and OpenAI?
Well, it's good to have you, and thanks for having me on, Sam and Marley. But, when I say Santa Claus rally, that starts the day after Christmas, and it'll go into the first week of January. But we're getting to the beginnings of that part where we now know what's going to happen and what's going to happen.
This guy looks stoned.
Right now, and institutional traders starting to make that move. And that's why you're seeing some heavy volatility going into that. That tells me that there's going to be a big thing called window dressing. That's where they take some of this thing off the balance sheet, put cash on the sidelines, or take the cash that's on the sidelines and start to put it to work.
It's 217.
There's out there that's seeing heavy volatility, and that volatility is a great chance for to pick some of that up. And I've done that with Broadcom today. I picked up AVGO.
You did.
I've been trading Tesla to the downside, right? So there's a lot of cool things that have been happening when you
Why'd
see
you pick that up?
rotation. Take advantage of that, right? We've seen AI stocks getting beat up. We saw AI stocks getting pushed to the upside. We've seen silver pushing up to the upside, taking some off today. So rotation is happening and quite frequently right now. But wait till the end of the Christmas time, that day, that first day of trading, right after that, get ready because we will have that Santa Claus rally going in January.
And what do you think makes this year's setup, if anything,
125.
different from our usual and typical late December melt-up? Is it a different setup than normal?
Yeah, it's a whole different one because we have a whole lot more cash on the sidelines, and we've seen a lot more volatility, and we've seen markets at all-time highs. So that to me tells me everything. It tells me, hey, we're going to see a Santa Claus rally. People are still okay with it. And the volatility, the VIX is
Can we get you back on the show a little bit later?
Telling me that at the end of the year, we're going to see some transformation in the markets. And that transformation is, the AI bubble is no longer a problem. The economy is not so long a problem. You're already hearing it from some of our Fed members saying, you know what? Jobs aren't that bad. You know what? I don't want to front run some of these rate cuts. So they're not doing it for a reason. So yeah, I think there's a difference in the past Santa Claus rallies, especially now that you're seeing it, especially this week as you saw the markets moving on. A little profit taking does not mean that the rally isn't going to happen. It just means that we're starting to do a little bit more rotation. That rotation in the AI stocks, that rotation in tech, okay, a little bit of profit taking. But I don't see that going into the close because quite frankly, when the close of the year happens, you're going to see a lot of institutions going, you know what, I need to have a Microsoft, I need to have a Google, I need to have an Apple on my balance sheets to show my customers. So that's why I see we're going to see a Santa Claus rally in the end of the year.
Obviously, this Santa Claus rally, as you mentioned, the records we saw yesterday has been driven by not just the leadership that we've seen this year, but as you mentioned, that rotation into other parts of the market, even some unloved parts of the markets as well. Do you think this broadening out can continue into 2026? And then if it does, what do you look at? I mean, where looks attractive right now as far as some of the opportunities?
That's a great question. I mean, the biggest problem we've had, and you talk about yourself, is that this whole market has been held up by the Max 7 all year long. Well, guess what? The broadening is happening. And about a month or two ago,
OCG, 40 cents.
I was moving into materials. I thought that was a great sector to move into. I also believe that nuclear and energy was also a good sector. You see oil down, but nuclear has been a great sector. I love that sector, especially the energy with AI going into great states like Texas. And you're starting to see natural gas as it was getting colder and colder in the Northeast. We all know that. So those sectors I really liked. I can also tell you that I picked up Costco. I like that. And look, I like Disney going into the end of the year as we start to see people going into the parks again, especially for Christmas. So there's a lot of cool things going on here.
Disney sucks.
Apple, obviously, we're going to see some huge numbers come out of the iPhone 17 Pro Max. We've already seen a little bit of that with some of these chip sectors. But when we talked about Broadcom earlier, AVGO, I thought the numbers were good. I think the only thing that was wrong was the CEO kind of not telling us the last customer that they've got. Tell me who that customer is. And I think a lot of
numbers were good, that's for sure.
Earnings season need to tell us what they see for the future. Make it a little more clear to us. That picture needs to be clear, and I think that then we have smooth sailing going in 2026. I think 2026 will be a great year. I'm excited about the future.
Stephen, you made an argument in the notes that you sent over that skepticism is actually powering this market higher. Now, you called it oxygen, that doubt is oxygen for this rally. You know, how long can that dynamic really last for?
Yeah, we are climbing a wall of worry. That's an old adage on Wall Street, right? And this wall of worry that we're climbing is because when people are nervous, great. But guess what? When you have all that amount of money on the sidelines, they've got to put it to work somewhere. They do not want to have cash on the sidelines. So that cash
we got higher lows
somewhere. And we're not putting the things that are working. So the things that were working in the past have been AI. The things that were working in the past have been tech. And I think you're going to see that consideration pushing the upside going into January, February, and March as we start to see the next earnings season. And I think we're going to be very surprised of how good we will see the numbers coming out, especially out of companies that are doing to the retail sector.
Stephen, you also talk about the broader backdrop and all the other things that are going on in the world too. I mean, we've got this sort of media soap opera playing out with what's going on with Warner Brothers Discovery. Obviously, that's a micro story we continue to track here, but elsewhere, I mean, we're looking at what is happening in the oil markets with Venezuela, Ukraine, Russia, obviously what's happening between China and Japan. That's been impacting Asian stocks as well. We've got the yen carry trade unwind conversation also been bringing back into the conversation as well because of the BOJ. I'm just wondering, with all of that in mind, what are you paying the most attention to? What has the potential to move markets the most, do you think, into 2026?
And that's right. You know, look, Sam, the problem is if all of those geopolitical issues are happening and the market's still making new highs, then traders and investors don't really care. Now, the one thing that I am concerned about is Venezuela. And if we escalate that and have boots on the ground in Venezuela, that escalates a little bit. If China and tries to invade a country, that's a problem. I always call it the fifth fleet diplomacy, right? Where's the fifth and seventh fleet? That will kind of determine it. But right now, this wall of worry, these geopolitical issues, it seems that traders don't care. And if they don't care with all of this going on, then the future is going to be awesome. So I'm excited about it.
And Sam just brought up a good point there. We have been sort of covering this, made for Hollywood drama surrounding this Warner Brothers, Paramount, Skydance, Netflix story. I'd love to get your take on this and sort of what kind of inflection point you feel like this means for media, but also the potential for broader consolidation we might sort of see across the entire space.
That's a great question, Marley. I mean, Barbarians of the Gate 2.0. I mean, we're going to see the next Nabisco possibly, right? With other companies trying to take over Warner Brothers. They have a huge Harry Potter, Superman, you name it, Warner Brothers has pretty much created it. And that's why I think Netflix wants that. They want a studio. I want a bigger one. I think that's why Paramount wants it. They're struggling. So there could be other actors coming into this, pun intended. But I do think one thing is important to understand. There's a political aspect of this, right? Paramount's CEO is the son of Larry Ellison, who has spoken to the president, and the president has already stuck his nose into this one. So I don't think Netflix is going to get Warner Brothers, and that's why I've also now owned Netflix. So I think there's going to be other players coming into this, looking at Warner Brothers. I'm not really sure who yet, but there are other players. But when it comes to streaming, when it comes to eyeballs that are watching it, that Netflix and chill feel to things, you've got to ask yourself one question. What is it that they want to do with it? What are they going to do with Harry Potter and Superman? Are they going to create more series like Disney did with Star Wars? If that's the case, do they have the money to do those series? It's very expensive. And just ask Disney with building up the Star Wars franchise. But I think that right now, honestly, Netflix has the more of the capability because they have more cash on the sidelines than Paramount does. But I don't think they're going to get it. I also think there's some antitrust issues going on that that seem to be a question mark for the DOJ. So right now,
woo! There's the knife.
In that. But right now, I think Warner Bros. Is a good play. $30 billion seems a bit steep to me, but you know, to the spoils go to the victors. So here we go.
Stephen, what else do you like? I mean, what else gets a look at now? I mean, do you look at healthcare, given that that typically has a pretty good outperformance as far as midterm years? Do you look at financials because of the steepening of the yield curve? I mean, are you dipping your toes into the speculative stuff at all?
Absolutely. I love biotech. I think with lower rates right now, biotech is hot, hot, hot. Why? Because, quite frankly, it's cheaper to borrow money so we can build new drugs. And I think with AI coming, that's very simple, right? Using AI products to be able to build out new drugs, just ask Pfizer. They're doing it themselves. But I have one stock that I really do like, and that's CRISPR, CRSP. I like that. I like what they're building. But biotech stocks as a sector in general, you should see a very hot 2026, especially if rates continue to come down, money becoming cheaper, and money in the sidelines. We're going to have a great biotech boom probably for the next 5 years. We're starting to see the baby boomers as they're getting older and then leaving and coming in. I also see robotics in that biotech sector. I mean, could you imagine a robot doctor? It's happening right now. We're seeing the neural side of Tesla with Elon Musk's Neuralink. So biotech is going to be one place that I am definitely keeping my eye on. I'll be more than happy to bring more stocks like that to the Schwab Network.
Yeah, I'll have to get back to you on that one, Stephen, the robot doctor. I mean, I suppose it depends on what they're doing there, but yeah, it's definitely a conversation for another day, but really love your insights. Thank you so much for that and getting us across the markets. Happy Friday and a great weekend, Stephen. Stephen Orr there, Quasar Markets. Coming up next, we will check in on the state of the commercial real estate with the President and CEO of Market on Post. We'll be right back.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
Boom, boom, boom.
Sometimes, you know, you could have done better.
You could have done better. Instead of burning that steak.
For where you invest. Level up and invest smarter with Schwab.
Welcome back to Market on Close. I'm Marley Keaton alongside Sam Bottis in New York. Cannabis stocks are rallying today as President Trump is expected to sign an executive order to reclassify marijuana. This move would allow cannabis companies to fall under different tax regulations and encourage investment. So let's take a look at how they are performing right now. Tilray trading up almost 42%. Curaleaf up 36.5%. Cronos up 12.8%, and Aurora Cannabis trading almost 20% higher on the anticipation of this executive order getting signed to reclassify marijuana, which would completely change some of the investment opportunities and tax structures for these companies. Now, I do want to send it back to Sam in New York here, change gears, and have a conversation about the outlook for commercial real estate.
Yeah, thanks very much for that, Marley. So let's welcome in our next guest to do just that, Hassan Najib, President and Chief Executive Officer at Marcus & Millichap. Thank you so much for joining me here today.
Thanks for having me. It's great to be here.
Give us just an overview of what you're seeing out there in the commercial real estate space right now.
It's a very interesting time because we really believe that we just came through another Fed miss. And by that, I mean the messaging from the Fed that is so reluctant to acknowledge the slowdown in the economy, especially the labor market, which has slowed down much more dramatically than expected, should be one of continued accommodation.
More drama.
But of course, they've been resistant to do that, which creates a lot of uncertainty and hesitation among investors in commercial real estate. It's a very interest rate sensitive asset class because it depends so much on leverage. The majority of transactions that happen in commercial real estate use leverage to make the deals happen. And for that reason, there is an unnecessary degree of uncertainty at a time when this property sector is absolutely healthy. It's not being overbuilt. The construction pipeline of new office buildings, which have not at all been the problem, offices had a demand problem, or shopping centers or other property types, is declining. So we're building less assets. And the demand is very correlated to the economy, which has done very well. So net, it's a healthy asset class with really solid returns and great advantages from the tax bill that just got extended or passed a few months back. Yet here's a bit of a headwind created by the Federal Reserve in not acknowledging how much the economy is slowing down.
Well, look, they are data dependent, so I suppose they have to see what that tells them about, how things are going in the job market and inflation too. They put 3 rate cuts into the system this year.
Right.
Obviously, they're penciling in 1 more next year. With that in mind, as you mentioned, obviously an interest rate sensitive sector that you work in, would you characterize then 2025 as a good year then for commercial real estate?
It was an improving year, but under potential.
Okay.
What we're seeing is the time that it takes for prices to readjust in reaction to the Fed's sledgehammer that they took to interest rates, 500 basis point increase in a very short amount of time is the worst financial tightening our industry has experienced since 1980. And the valuation of real estate, because of the leverage component, is so dependent on the cost of debt that it was badly disrupted. Thankfully, enough time has gone by where prices are adjusting to the higher interest rates. And I don't think interest rates are due to come down significantly. Therefore, the market has to adjust to the reality of a 4% yield on the 10-year Treasury and therefore plan accordingly. We're seeing a price adjustment in multifamily apartment buildings that is already happening, in shopping centers and retail that is already happening. Office buildings are badly affected by the post-pandemic demand issue, which is now starting to...
I've had better days, that's for sure.
Today versus a year ago,
I'm green
I would
for the
consider
day, but
the office sector
barely.
as a recovery sector, and one that offers a lot of, diamond in the rough.
Yeah, look, I want to talk about that because it's a double whammy for you, wasn't it? Because, I mean, throughout the course of the last 5 years, it wasn't
You're
just
like one of them
interest
opposite-
rates, but it was the fact that people weren't in the office.
Opposite attract
Tell us about
today.
that rate of return. I mean, we all have friends in certain different sectors. Some are mandated.
Didn't get off to a good
some are allowed
start.
to come back at all. Some are saying come back full time as you were pre-pandemic. Where is that at right now?
Companies have become a lot more aggressive about demanding a return to office. A year ago, 57% of the traffic that was being kind of registered was you're really back to normal compared to 2019, pre-pandemic. Today, the daily attendance is about 80% of the pre-pandemic levels in 2019. I don't believe we'll ever get back to 100% because even with the return to office mandates, it's 4 days in the office, 3 days in the office. There is a degree of tolerance for hybrid lifestyles and work setup. And I think that's actually productive for the workforce. But where we were at just 2 years ago was less than 50%, of pre-pandemic levels of daily attendance. So the improvement is significant, and we're up to 80%. By the end of 26, I anticipate we'll be close to 90% of pre-pandemic office attendance. And that's why office buildings in some ways are a diamond in the rough for investors.
Okay.
Prices have come down, recovery is coming, and it's already happening. Therefore, it might be a good time to come back and invest.
So there are opportunities, you know, when you look at real estate, particularly as an alternative investment, as you say. Where have you seen the most improvement? What's driving that demand? Office, industrial, retail?
Well, I've actually been in town in New York for the past 4 days because of the ICSC convention, which is the largest retail convention and really an interest group for shopping center owners, tenants, all the retailers in the world attend this conference, talking about their plans and networking with landlords and advisors. The vibe from this conference is the best I've sensed in the last 2.5 years since the recovery began. Retail is actually outperforming all the other property types because e-commerce created such a disruption and reimagination of obsolete older shopping centers, which are a lot easier to demolish and rebuild than office buildings are. So it's gone through a massive reshaping as a product type. And now, because of the consumer demand, fitness, food, and fun, the 3 Fs that are attracting new demand to retail shopping centers, it's doing extremely well.
Wow, okay, so retail outperforming. Hesam, we're going to have to wrap it up there. It's been a lovely chat. Thank you so much for joining me here and coming into the New York Stock Exchange. We'll do it again soon.
Great, thanks for having me.
All right, have a great weekend. That is Hesam Najji, who's the President and Chief Executive Officer at Marcus & Millichap. I'll send things back over to Chicago with Marley.
Thanks so much to Sam for that one. Coming up next, we've got Options Corner. Rick Ducat will join us here in our Chicago studio to take a look at Rivian, which is rallying after it announced it's entering the autonomous
238.
race. That's next on Market on Close.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action from Fed policy
Coming down to a double bottom
growth to inflation prints
on it.
and geopolitical risk.
Could get it into the play upside here.
Always live from Wall Street.
I mean, the setup's here. It's one of these kind of days where you go like, wow, I wish I was in that into close.
10 a.m. Eastern on Schwab Network.
The 6825s.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast.
I'm going to give it a shot.
Do you like using
I'm not going to go in a lot, but
our technical analysis webcast series breaks down different charting techniques like trend analysis.
we're going to find out real fast.
Moving averages, oscillators, and much more. Best of all, you can ask questions directly.
Let's look at the 1 minute before I do this.
It's interactive learning at its finest. Tune in live or on demand.
Could drop just a little bit more and hit that shoulder line.
And start learning today.
SPX 6825s at 140.
And I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Here they are right there.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to Market on Close. The shares of EV maker Rivian are rallying today after a report from the Wall Street Journal. The company is doubling down on an AI-centric approach to develop fully autonomous vehicles. Rivian has also developed its own chip to enable its vehicles to quickly process data from the road and feed the AI model that powers its self-driving. So, of course, that means it's time for Options Corner. Our focus today will be Rivian. Joining us, Rick Ducat, our lead market technician, to take a closer look at Rivian and this big move to the upside. You know, just looking right now, up more than 12% for Rivian. But Rivian has been a very interesting company to follow, especially as we look at it against Tesla. But just looking at it against the broader market and the sector, you know, how does it shape up? You can obviously see it's had some erratic moves.
Right. So, I mean, that's the first thing is the volatility of this name here, but a strong outperformer versus the XLY consumer discretionary ETF.
I got mine.
Not a great comparison, though, because it's a very broad sector. There's all kinds of things in it. It's better to maybe perhaps look at the EV makers so we can see outperforming the likes of Tesla, NIO.
Francisca!
Its rival Lucid is probably the best comparison. Lucid's down almost 50% during the past year, but XPEV, XPeng, that is the outperformer of the group here. So Rivian still doing
210
solidly. This autonomous day gave it a nice boost here. We got a price target bump from Needham to 23 from 14 today. They maintained their buy rating, and it's kind of interesting because it's a very big difference between what Rivian and Lucid are choosing to do. Rivian is trying to do this vertical integration approach where it's controlling its own supply of chips here. Meanwhile, Lucid is taking kind of the opposite
Come on,
approach.
give me
They're
$5.
partnered with Uber to provide the robo-taxis to an existing and well-established company. So kind of a safer play versus a riskier play is kind of what you see in this sector.
And you know, interesting you point out it is a higher
250,
risk play
60,
for
come
Rivian,
on.
especially when we look at the volatility in their chart. But they are seeing a move to the upside. You know, they like the possibility, the street likes the possibility of this at least reflected in the price action. As we look at Rivian just on its own, you know, what is the chart telling us? You know, I can see
My biggest problem today is I've been wanting to hold him for the big bank, but here we are with three white soldiers, double top.
The lines are starting to converge more. A rising wedge is maybe how you would describe it. This type of characteristic is what you see here. So we have our low point here. Once again, we have our progressively higher lows. From here, though, we went from our best close to our intraday high. And notice that we did make intraday highs beyond that point pretty significantly, but we are on pace for a close below that level here. 18 is the standout level. That's our red line here. That's about where we did have our best close. Had a bit of a struggle maintaining above that area during our last rally. Today could be the final push that makes it above that level, though. You can also see 1579 right about here. That was our best close from this area. That's about where price had some stopping points there a couple of times. It was also the low point yesterday here. So once again, that level came back into prominence. Old resistance became a new support. When we do look at our moving averages here, our 5-day exponential moving average in blue there, we have crossed above that one. Today's low point came in at our 21-day.
There we go, 270.
Turquoise color there. Notice that RSI is compressing in a triangular shape here. We have our green longer-term trend line along the bottom. We have our shorter-term red trend line going across the highs. However, notice as well some bearish divergence taking shape here. RSI still trending downward even as price makes new higher closes. Not exactly what you want to see if you're bullish in this name, a sign that the momentum is not behaving exactly as you might hope, but we'll have to see if we can break above that level on the back of this strong push to the upside. We can also see here volume is the heaviest right around here, closer to current prices. Not really a very distinct node, but that's where things start to drop off rather sharply above that 18 level. To the downside, things start to get
In
much
6
heavier
minutes,
once again
we're going to see which way this thing
15,
wants to pop.
this general area right here with the point of control coming in 1326.
In that 16 area, about where we started the day today, you know, we are trading up a little bit more than $2 higher on this move to the upside on this news. But as we talk about the options activity, did we see an uptick in Rivian? You know, I can't imagine it's a heavily traded options name, but sometimes we get these headlines and then we do see some movement in the sizzle.
Oh, quite the contrary. 700,000 options today. So
wow.
Pretty high volume here. Remember, though, that, you know, this is a name where you would see probably quite a bit of speculation. So the sizzle 3.2 today, 3 times the average typical figure we would see during that 5 days. 2/3 of the options traded today were calls. If we were to look at December 19th, 7 days out, that's our monthly expiration. That's the closest. That's our orange box right here. You can see that about an 8.7% move in only 7 days is what the market's looking for. So quite a volatile name, as we said before here. The options market for that series, open interest was too widely dispersed, too all over the map to give you a clear range. But the highest open interest on the call side was at the 15 strikes with 36,000. The highest on the put side, 16.5 with 28,000. 25,000 here. So a pretty interesting market to say the least.
Certainly an interesting market. In that market, did you see any notable trades?
Can we make it up here to the
Yes,
200?
There was one large
Make
trade,
it
the
$5
largest in terms of volume and dollar amount, minus 25,000 December 12th, 18 strike calls at an 83-cent credit. So a closing trade today. And it looked like the
It's
opening
$3.
trade was December 19th. Hard to tell exactly how much it was for.
330.
Roughly, they bought the calls for around 50 cents or so. If we were to make that assumption, they
Jim,
cleared
sell 'em.
about 800,000 or so, 825,000 based on that kind of back of napkin math.
There it
So
is.
A rough estimate, but very, very large quantity trades.
$4.30.
Trading up 12.5% right now at 18.49 on the news of its potential autonomous driving future. I do want to check back in with Sam though and find out
Give me a
what
big
stocks
fat
are we talking
candle.
about for overlooked stocks today.
Should I sell them, Randy? 420.
Well, coming up, Marley, we're going to be hitting the tables as Alex Coffey has his eye on gaming and leisure
Take some
products
profit.
into the close. He'll break
You're
down
up to
the news
63.
on that name and what you need to know about the company coming up next on Market on Close.
Whether you're an experienced investor or just getting started,
Come on, give me
Charles
5.
offers a web
There's 490.
right for you. Are you an active trader? Our active trading webcasts
Uh-oh.
are designed to help you develop a deeper understanding of
Watch it. Don't. It ain't going to do 5.
options, futures, and more. Best of all, you can ask
Oh,
questions
there it is.
by chatting directly with an education coach.
Yeah, that made.
Its
Woo!
finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start.
Woo-wee. Woo-wee.
I'm Jenny Horn. We go beyond the headlines, tracking the
Can I tell you how happy I am?
sector moves and
That made my day. It
fundamentals
made it worth the day after all.
This is Schwab Network. Subscribe at schwabnetwork.com.
All I had to do was wait.
First day, so sometimes you know. Next.
Francisca!
You could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management.
Yay!
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your
And
own.
watch this thing go to 15.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl.
Schwab, a modern approach to wealth management.
Stay connected to the markets with Schwab Network.
Welcome back to Market on Close. I'm Marley Caden coming to you live from our Chicago headquarters. It is time for overlooked stocks. We are seeing shares of gaming and leisure properties on the rise after JP Morgan upgraded the company. Joining us now to discuss further, Alex Coffey, co-host of Next Gen Investing here on Schwab Network. Alex, walk us through, JP Morgan's note and why they're upgrading this.
Yeah, what I think might be most, ideal to start with what is this company? And, what does this company do for, because I'll be honest, this is not one that was on my radar before.
I struggled all day today. I had 2 trades that went my way perfectly. And I had about 3 of them that did not. But I still, and there was a couple that I could have got out of with nice gains, not real big ones, but, and didn't do it. This last one of the day made up for all that other crap. And I mean, 8 hours of work in the last 8 minutes was the funnest part of the day. You tell me. You tell me. You recognize these bad, ugly days like this. and know to stick around right there. I mean, if you like working all day long and you're saying, oh man, this market ain't for me today, then that last power hour, jump in here and do your homework on real bad days. I mean, these things dip down to 120. I should have added on. But always clean, may I help you?
Hello?
Yes. Baby,
Reaching out as the state of Missouri has recently announced a free subsidy program for its residents. So for that, can you please confirm yes or no if you are under the age of 65?
yes or no? I'll be changing. I'll be over 65 in about a month.
Sorry, it looks like you don't qualify for the device. Have a great day.
Well, that ain't fair. I wonder what kind of device it is. A sperm detractor? $0.22. Woo! We should have bought it, Randy. You did three, but sold it real fast. Well, China. Oriental Culture Holdings. I'm very fond of the Asian people. I really am. Asian women, they're very independent. And the both Asians I dated, I loved them. I remember when I was a kid, I think I was about 15, I knew this Asian guy that lived over here in the projects up the street from me, and he invited me over. He was an older man. He said, come upstairs with me. I said, okay. And he would take a little bit of cannabis and a little bit of tobacco and mix it together and smoke it. I'd come out of there, I didn't smoke cigarettes, so I'd come out of there so high off of a one hit or two hits. You ever have anybody do that? Just put a little bit of cannabis in with tobacco and smoke it? I thought it was nuts. That's about the only time I ever done it like that. I said, I don't want to do this stuff. It got me too high. Because I didn't smoke cigarettes, and cigarettes, I wish I could remember what kind of cigarette he used. But I didn't like it. I did it a couple times. I went over there. I said, "No, I can't do this anymore." Okay, we got 5 minutes left. That last trade really made my day. Five contracts at 140 and sold them at 6. $2,300 in 6 minutes. So what was a rookie day for me today, when profit-wise turned out to be a professional. Belch. JYH, did you set last trade? A rough day like today? Kind of remember when the days are really, you can recognize really hard day. That last half hour, that last hour could be a game changer. You already probably know that. That happened to me twice this week. Monday and today. And Monday was worse. Today was bad. I mean, it felt like every trade I got in, it just knife on me. Then I'd have to weasel my way out. And then that first one, I couldn't. It's a big sell-off day today. 6,900 to 6,800. 98-point sell-off. And if I had the patience, let me show you something here. If I had the patience today, what in the hell is that? Run your trend line all the way down. One, two, three, four, breaks out, pulls back. Yeah. It's not what I thought it was. There's a head and shoulders there, but you could barely tell it. Now, I don't know if I'd have called that out or not. I thought this was going to hit this trend line. Oh well. That's an ugly thing. Well, I want everybody to have a blessed weekend. I'm going to go check on that leak, see if it, well, there's a little bitty puddle, probably about 12 inches around, and nobody has no clue where it come from. And I looked all around, I couldn't find any leak. So I figured somebody had spilt something. And you can't get in this hallway unless you're an employee. So I'm going to go back and check it and see if I'll put a little thing down, see if it's wet. See if it come from the ceiling or what. If it got bigger or... I'm going to call it a day. It's been a rough week. Very volatile week. And, you know, one minute you think you're in a bubble and another minute you're not. Fat cats are determined to call it a bubble because they want to see results from this AI. They want to see results. And I think Powell was forced to give us the rate cut this week. Because if he had any other, because he was out, I think he was outvoted not to. And I would like to see the rates drop so so people can buy houses, you know, instead of at these high interest rates. Get them down, you know, 5% at least. 5 to 4%. So for the. But I think when we get Powell out of there, we're going to have a whole different reaction. And you don't know. I don't know. I mean, Wall Street likes that printed money, and they're not getting it like they were. And then they're going to be fighting about Obamacare. They wanted a 3-year extension on Obamacare. So if the Democrats won next term, they could play around and do their stuff like they like to do. A lot of my liberal friends, these are interesting times, they say. I said, so you didn't think Biden was interesting? One of my liberal friends posted a diagram of Trump sitting in a chair sleeping, and he had people wrote stuff on his face. Biden was standing around, whirling around him. I thought it was just funny. I remember when I was partying, we had a kegger, and one of the guys passed out on the floor, and Mark Brown, and we turned around and drew a lot of funny stuff, crabs and stuff on his belly. When he woke up, boy, he was mad. Black magic marker, colored markers. He was pissed. Okay, well, I gotta go. Everybody have a nice weekend. Don't drive drinking. I had a rough day today. I don't know what the deal was. I wasn't sitting on the right side, that's for sure. These extended sell-offs, I gotta be in the now a little bit better about that. I could have made a ton of money if I just bought puts today. But I got stuck in that trade and I didn't know what to do. I should have went straight and covered myself with a couple puts, and I think that would have been probably the thing to do. I might have to start think about that when I'm stuck in a trade like that, and just selling just keeps going and going and going and going. Just get out of it and get into the put and quit playing around. So I want to get out of here. Be safe. Christmas is coming up. Make sure you get something nice for the lady. Don't overspend. I might take me a vacation. Bug, hope you get your car situation took care of. My insurance went down on me. I've been a customer for them for 21 years. And it went up during the Biden years. It kept going up and up and up and up. And finally it went down. I don't know if it's because of the age of my car, but they gave me the reasons. Not being in an accident for over 2 years, being a client for 21, and something else. Outstanding driving record. No tickets. We'll catch you later.